Good morning, ladies and gentlemen. It is my great pleasure and honor to welcome you to our inaugural conference of the ChaMP network, here in the press room of the European Central Bank and all of you out there in the live stream. The purpose of this conference is to make the ChaMP network, the ChaMP research initiative, known to the broader economics community and the interested public. In the next 3/4 of an hour, you will, among other things, receive presentations or characterizations, descriptions of what the ChaMP network, actually this important, large project on monetary policy transmission in Europe does. Then there will be a number of sessions where we feature external research and internal research from the ChaMP network about the priorities. Also, please pay attention to the poster session here in the lobby, where additional research from the ChaMP network will be displayed. But before that, let me introduce Mrs. Isabel Schnabel from the ECB Executive Board for the opening speech. As you know, Isabel Schnabel joined the European Central Bank from a research career, broadly speaking, to the ECB board. In her previous position, she published in top economics journals like the Review of Financial Studies, the Journal of Economic History, the Journal of International Economics, among others. Now here at the European Central Bank, she is in charge of monetary policy implementation, research, and statistics. She is one of 2 board members who regularly makes the presentation to the monetary policy meetings of our Governing Council, which is the main decision-making body, alongside with Philip Lane. Therefore, I'm very pleased that Mrs. Schnabel accepted our invitation to deliver this opening speech, and appropriately for our undertaking, the ChaMP network, it's on the topic of the state contingency of monetary policy transmission. Please, Ms. Schnabel, make your way up to the lectern. The floor will be yours.
Good morning, everybody, and thank you very much to Philip for the kind introductory words. It's a great pleasure for me to give the opening remarks at the inaugural conference of the ChaMP network. And you will hear much more about the ChaMP network later, but let me just already now mention what the goal of the network is, which is to enhance our understanding of how monetary policy transmits to the European economy amid unprecedented shocks, structural changes, and shifting inflation dynamics. So I think it's fair to say that we've learned a lot about monetary policy transmission over the past years. And if I had to summarize what we learned in just one sentence, I would say that we learned that monetary policy transmission is state contingent. So what I want to do today is I want to go through the 3 stages of transmission, and I would like to answer the following 3 questions, or attempt to answer. So first, what affects the speed and strength of transmission of monetary policy to financing conditions? It's the first stage. Second, how sensitive are firms and households to changes in financing conditions? And third, how are changes in demand transmitted to changes in inflation and output? So let me start with the first stage of transmission, which is from policy rates to financing conditions. So one way to summarize what has happened to financing conditions is to look at loan and deposit betas. And if you look at those, what you can see is that there has actually been quite a strong path through to loan rates, Whereas when you look at deposit rates, you can see that the transmission to overnight deposit rates has been relatively weak, whereas the transmission to the term deposit rates has been somewhat stronger. And you can see on the right-hand side that, of course, also the term deposit rates went up much more than the overnight deposit rates. So one explanation is competition in banking, which matters for transmission. And if you look at these charts, you can see that for deposits, there is actually a stronger path-through in more competitive markets, whereas for loans, shown on the right-hand side, there is stronger path-through in less competitive markets, which is probably also what you would have expected. At the same time, we see that over time, bank concentration in the euro area has gradually increased, implying lower competition, and this may explain the stronger path-through in loan markets than in deposit markets in historical comparison. Looking at volumes, we have seen quite strong transmission to loan volumes, and that is shown on the left-hand side, both for loans to firms and to households. So you can see that net lending flows have almost come to a standstill at the end of 2022, the beginning of 2023. On the right-hand side, you can see what happened to deposits. And there we have seen a massive shift from overnight to term deposits, which of course is not very surprising given the rising interest rate differential. Our bank lending survey, and here I'm showing loans to firms, but actually the picture for loans to households looks pretty similar. We have seen a tightening of credit standards. You can see that on the left-hand side, and you can see this is mainly driven by the yellow and the red bars. So this is risk perceptions and risk tolerance. And at the same time, as shown on the right-hand side, there has been a sharp drop in demand, mainly due to higher interest rates. Importantly, both of these seem to be fading out, which could be an indication that we are now past the peak of the transmission to financing conditions. Fortunately, banks' balance sheets are relatively strong. So banks are profitable, banks have high capital ratios, and this implies that there is little risk of financial amplification. And this is a very different situation from what we've seen at other times, especially, of course, around the global financial crisis. Moving to financial markets, you can see on the left-hand side that long-term risk-free yields have tightened significantly, but the term premia, and these are the yellow bars, they actually remain quite compressed. And one of the reasons could be the stock effect of the still very large monetary policy bond portfolios. Stock markets now stand higher than they did in June 2022, so just before the tightening cycle started. And as you can see on the left-hand side, in the red area, this is to a large extent driven by compressed risk premia. And the same is true in credit markets. If you look at the right-hand side chart, you can see that credit spreads have actually come down quite a bit since the start of the tightening cycle. So from this side, we've actually had an easing of financial conditions. Let me now turn to the second stage of monetary policy transmission, which is from financing conditions to firms and households' behavior. And I will argue in this section that there are good reasons to believe that the transmission to firms and households may be weaker or slower than it has been at, or than it was at other times. So one factor is leverage. So leverage is actually quite low compared to other periods. So look at the left-hand side chart. So there you see firms' leverage, And I think it's quite remarkable to see that since the global financial crisis, there has been a downward trend in firms' leverage, which then implies that higher rates are going to have a lower impact. If you look at the right-hand side, you see data from our household finance and consumption survey. And there, at least if you look at the bottom 50% regarding wealth, you can also see that the debt-to-asset ratio has come down. There are sectoral differences. And one important feature is that services have gained importance in the economy. Services are less capital intensive and less interest rate sensitive, which may again weaken monetary policy transmission overall. On the right-hand side, you see the results from a survey that we conducted among larger corporations. And what you can see there is, I find quite striking, namely that the services firms reported that they're basically not affected. A large share report that they are not affected by higher rates, at least not directly. So normally, one important channel of transmission is the labor market. However, this time, the labor market has been very resilient, which again tends to weaken monetary transmission. At the same time, households in the euro area are saving a lot, and you can see that on the right-hand side. And this is actually, I find this quite striking. So maybe it's not surprising that savings ratios, this is the blue line, that they soared at the beginning of the pandemic. But what we see is that even though they have come down, they still stand below pre-pandemic averages. And this is in spite of the high volume of accumulated excess savings shown in yellow. And it's also quite striking to compare this with the US. So in the euro area, we currently have a savings ratio of around 15%. In the US, the savings ratio is below 4%. And of course, the flip side of that is that consumption in the euro area is much weaker. Another factor is cash buffers. So we're seeing that both firms and households are holding high levels of liquid assets. And when you have a lot of liquid assets, there is less need to borrow at high rates. Of course, over time, these cash buffers may be depleted. And if you look, for example, at the left-hand side chart, what you see is that there is this kind of trend in rising holdings of liquid assets. Of course, it went up a lot during the pandemic. It has come down a bit, but it still stands before pre-pandemic levels. So far, there are no signs of a depletion. And these high cash buffers could slow monetary policy transmission. Another factor that could potentially slow monetary policy transmission is the prevalence of fixed rate loans. And as you know, there is a lot of heterogeneity across countries. So in the euro area, we have some countries where mortgages are mainly at fixed rates, others where mortgages are mainly at variable rates. But there's also, of course, some heterogeneity over time. If you look at the left-hand side, which shows corporate bonds, you can see that if you look at the blue line, and this is the high yield segment, you can see that around 2020, the share of corporate bonds maturing within the next 3 years was relatively small. I think you can, maybe you cannot even see it because it's too small, but it's around 15%. But it has actually gone up quite a bit, and it now stands close to 40%. So eventually, the loans will need to be refinanced at higher rates, and in that sense, the tighter monetary policy is going to have long-lasting effects. Let me turn to the third stage. So what is the impact on economic activity and inflation? And it seems that there is a consensus emerging that we may be facing a quite bumpy last mile. So this shows you the evolution of HICP inflation in the euro area. And in fact, the first part of the disinflation was quite impressive and faster than many of us had thought. But this was largely driven by the reversal of previous supply-side shocks: energy, food, bottlenecks, whereas domestic inflation has proven much stickier. And of course, this is where monetary policy transmission is biting. There has been a lot of research, including within the ECB, using micro price data in order to analyze the impact of large cost push shocks. And I think this type of research is incredibly important, and I know it's also going to be part of this network. A common finding, as shown on the left-hand side chart, is that the frequency of price changes has increased quite significantly, and according to this data, which is coming from Banque de France, it has by now come down and more or less normalized. So this higher frequency of price changes is given as one of the reasons why the Phillips curve has steepened and has actually been much steeper than we had thought. I mean, remember not so long ago, we were all talking about the flat Phillips curve, but actually we have seen quite a bit of a steepening. The soft landing narrative relies on a steep Phillips curve also on the way down. And actually we have seen, if you look at the right-hand side chart, we have seen that initially the decline in inflation also has been here, this shows core inflation, has been quite steep. However, we also see a bit of a flattening out, and so this is something that needs to be watched. I believe central banks should not take credit for the disinflation caused by the reversal of supply-side shocks. But I think we can take credit for keeping inflation expectations anchored. And this is shown on these charts, and there are many, many others you could look at. So anchoring inflation expectations is a crucial channel of transmission, and here monetary policy has worked very well. Some risks remain. One aspect that we are looking at very vigilantly is the development of unit labor costs. And so here you see the two components, nominal wages and labor productivity. Wage growth remains relatively strong, but it seems to be gradually easing in line with what we have in our projections. The more concerning part is productivity growth, which is shown on the right-hand side. So we've had negative productivity growth now over several quarters, and the important question is, what part of that is cyclical, meaning that it's just going to vanish over time, and which part of that could be structural? If you look at the GDP deflator as a measure of domestic inflation, you can see that unit labor costs continue to contribute strongly. So these are the green bars, whereas the contribution of unit profits has come down quite a bit, which seems to point to a higher absorption of higher costs through profit margins. But this is certainly also an area to be watched, because our projections assume quite a bit of absorption of higher costs through profit margins. The biggest concern is clearly services inflation. And if you look at these charts, you can see why. So on the left-hand side, you see non-energy industrial goods. On the right-hand side, you see services. And you can see that for services, still around 90% of goods have inflation rates above 2%. So we haven't seen the same reversal as the one that we've seen for goods, shown on the left-hand side. Staff analysis from the ECB has shown that the wage price pass-through is much stronger for services, and one of the reasons could also be the quite resilient demand. And on the right-hand side, you can see the PMIs, which have moved clearly into expansionary territory again for services, not for manufacturing. And so this is clearly something to be watched, because the whole story about absorption of higher costs via profits relies on the fact that demand is dampened by monetary policy. But the question is whether the dampening effect on services is as strong. So finally, we need to look at the potential risks stemming from new supply-side shocks, and one of them is geopolitical risk and energy prices. If you look at the charts here, you can see that so far the reaction of energy prices to geopolitical risks has been relatively mild. But this, of course, remains to be monitored. The second potential new supply-side shocks is coming from extreme weather events and food prices. And here we have seen quite large increases recently, as you can see on the right-hand side. There's a part of it is related to cocoa, which suffered a lot from droughts, but there's also a more general upward move. And this partly seems to be related to the strong El Niño episode that we've been experiencing. So to conclude, in order to understand monetary policy transmission, we need to look at all three stages of monetary policy transmission. We know that monetary policy is state contingent, but we need to learn more about the factors affecting transmission. And this is why this research network is so incredibly important. This is why I'm so happy that all of you are here and are contributing to us learning more about monetary policy transmission. So thank you very much for your attention, and I would be open for a couple of questions if you like.
Hi, Diego Comín from Dartmouth College. Let me challenge one of the claims that you made about the role of the frequency of price changes on inflation. I think that the big question is, why do firms change prices more frequently? And that's clearly the driver of the higher inflation. Okay, and in my view, the reason why they are changing prices more frequently is that they are facing these capacity constraints that push producers to readjust their prices, because now demand conditions are completely different and their supply is constrained. So the optimal response is to change prices. So the frequency of price changes, in my view, is just a consequence of something that is the true driver of inflation, which is the fact that producers face these capacity constraints. What do you respond to that?
May we connect 2 or 3 questions?
Benoît Maujon, BIS, very impressive and insightful presentation. One thing you said about the anchoring of inflation expectations as somewhat independent from the effect of supply shocks on aggregate inflation. I mean, you kind of hinted to that, but to some extent, with the initial hump in inflation, which came to some extent from supply shocks, what it becomes and whether it goes to the general price level and, monetary inflation as we know it, their inflation expectations play a very critical role. So Can you elaborate a bit on how you see these spillovers across sectors and the role of anchoring inflation expectation in this context?
Yeah, maybe one more question there in the back.
Hi, Carlo Boffa from Politico. I wanted to ask, you talked about mortgages, but what about the transmission to prices of real estate? Do you think would you have thought that would have been more forceful, both residential and commercial real estate? Thank you.
Thank you very much. So I think we have to stop here because we need to move on later. Okay, so let me try to answer in reverse order. So on the real estate prices, I mean, first of all, there has been a lot of heterogeneity across Euro area countries. So there are some countries where real estate prices have come down quite a bit. Others where real estate prices are still rising. So a lot of heterogeneity. In general, I would say the decline in house prices has been smaller than at least I would have expected. And my explanation would be that this is coming from a lack of supply of housing, that we kind of have a structural lack of supply of housing, which kind of limits the downward moves. So the second question was on the role of supply-side shocks on inflation expectations. And of course, we all remember that when we discussed about the supply-side shocks initially, I mean, there was kind of this more or less standard view that this is something that we could look through. And I think it became clear that that was not the case, that we had to respond. And one of the main reasons was the need to anchor inflation expectations. And so it seems that, I mean, I would like to stress that it's actually quite remarkable that we had inflation moving up to double-digit numbers and still inflation expectations remaining. I mean, of course, they did move up, but what we did see is that we were able to convince both markets, firms and households that we were determined to bring inflation down again so that the longer-term inflation expectations never really seriously moved away from our target. I mean, they moved up a bit, but we were able to contain that. And I believe that was one of the big successes of monetary policy. And then on your question, I mean, there is a lot of research ongoing about the factors determining the high frequency of price changes. Also here we have, at the ECB, we have quite a bit of research. And so the standard argument seems to be that different from the type of like Calvo pricing, we have state contingent pricing, where when the desired price moves away far away from the actual price, then you get this higher frequency of price changes. But I'm not entirely sure that relates to your question, but maybe we can discuss bilaterally. So thank you very much. It was a pleasure talking to you, and I'm looking forward to the following sessions. And I think now Philip and others are going to give an introduction to the ChaMP network. Thank you.
So hello again. In the next 20 minutes or so, Emmanuel Dün from the National Bank of Belgium, Diana Bonfim from the Banco de Portugal, and myself give you an introduction to the ChaMP network. The ChaMP network is one of these large networks that we do every few years. This time it's the European system of central banks together, so the scope is European Union wide. And the speech we just have seen and the Q&A couldn't illustrate better the importance of the topic of monetary policy transmission right now, not only for the ECB, but also for many central banks around the globe, even, I would argue. It's not the first network. The Prisma network on price setting was just mentioned several times. There has been, after the great financial crisis, one on the macroprudential research, MARS it was called. There was some, other years, there was one on wage dynamics. And actually the very first one, and Benoît Maujean will remember the best because he was the secretary of the MTN, the first monetary transmission network, was actually the first Eurosystem research network. So ChaMP stands for Challenges for Monetary Policy Transmission in a Changing World. As many of these networks, it has a horizon of about 2 years. The motivation was already touched upon very briefly by Isabel's first slide. So the combination of events over the last decade and a half really warrant revisiting monetary transmission in the euro area and in the European Union. Shocks were unprecedented. Structural change is going on various fronts. The monetary toolkit, the monetary policy toolkit has changed substantially, and we have experienced the recent inflation wave and its reversal. Against this background, the core issue of ChaMP is how these factors, more recent ones, but also the ones after the great financial crisis, have affected the strength, the speed, and the heterogeneity across member states of monetary transmission, of the ECB's monetary transmission, but also, since it's ESCB, also in the EU, of non-euro area central bank policy transmission, or whether there are even some new channels to be paid attention to. In doing so, we have the ambition to play and to put enough emphasis on price setting and inflation. We divide our work in 2 work streams, one a financial one on the financial transmission channels, and another one on the transmission through the real economy. The work program that we have established and are pursuing distinguish 2 types of projects. One are individual research projects proposed by single researchers or teams of researchers from all over the European system of central banks. And the other, so-called coordinated cross-country projects, which are with a multiplicity of countries managed together to enhance robustness by having results from many member countries and to foster collaboration. Impressively, the number of projects with which we start stands at 196 individual projects right now, of which 111 are currently in workstream 1 and 81 in workstream 2. And then we have a few of the bridge projects which are straddling the 2 that we try to increase over time. Overall, at this point in time, 287 researchers from the ESCB are engaged in those projects. And the continuation of the presentation by Diana and by Emmanuel will give you insights about emerging results. Because don't forget, we are pretty much at the start. The whole undertaking started in the fall of last year. So this is the inaugural conference. So the results are just starting. The true conclusions are going to come at the end. So let me move to explain to you how we run ChaMP in this one chart. An important feature of the ChaMP network is that 4 national central banks, the Banca d'Italia, the Banco de Portugal, the Austrian National Bank, and the National Bank of Belgium have joined forces with us, the ECB, to run this together for the whole European Union. And the 5 people that you see on the screen are actually compose the board that is guiding all this. Myself, my name is Philipp Hartmann. I'm the deputy of the research department of the ECB. I've already introduced Diana, I have already introduced Emmanuel, and you will see as chairs in the program also Maria Valderrama and Margarita Botero. We are supported by a range of advisors from other national central banks, experts in various aspects of our work program and of our priorities that I tried to briefly sketch before. And I will not go through all the names here. You can see them on the screen. They are from central banks that are not involved in the coordination and also from the ECB. Then we are supported by a range of consultants from outside academia. Again, the list is a bit too long to go through all of the names, but they range from the University of Chicago, as far as that, to Tilburg University or Leuven University, and you see the names on the screen. And then, of course, we are supported by our back office. We are standing on the shoulders of Melina, Papuzzi, Gonzalo Paspardo, and Raquel Gil, who keeps us going every day. At the end, we're gonna report via the research heads of the European System of Central Banks to the Governing Council our results in 2 years plus time. And that is the point where I hand over to Diana.
Thank you, Philip. So let me talk a little bit about Workstream 1, where we have the goal of looking into the transmission of monetary policy through the financial system. And so our mandate here is to look into 3 main areas of interest. The first one is to think about the transmission to non-financial corporations, mostly through banks. And here, of course, this is, I guess, where the literature on monetary policy transmission through the financial system has already more extensive contributions, but for sure, there's a lot that we still have to explore. And here, some of the things that we want to highlight is to think about the role of country specificities, to think about the role of competition in shaping this transmission of monetary policy through banks to firms, and also to consider portfolio composition of banks. And to do that, one of the things that we have in our mandate is to encourage the use of AnaCredit more widely. So AnaCredit is a data set where you have the loan level information about almost every loan across the euro area. And so a lot of very good quality work is already underway using this data set. There's for sure much more that we can do with this very powerful tool, and we're working with that direction through ChaMP. Then the second area of interest where we want to advance knowledge is on the transmission of monetary policy through banks and non-banks to households. And this is an area where, for sure, a lot has been done, but clearly not as much as on the transmission to firms, and to some extent due to the lack of available data comparable to these credit registers that we have on firms. And so indeed, at European level, we do not have anything similar to AnaCredit for households, at least not yet. But what we're trying to do with ChaMP is to go deeper on the use of national credit registers that have this household data, and hopefully with these uncover new findings that are relevant for the understanding of the monetary policy pass-through. And then finally, we also want to go deeper on the role of non-bank financial institutions in monetary policy transmission. And here it's important to look, for instance, into the substitution between banks and non-banks, to look into portfolio recompositions of non-banks, so there's many questions out there. And then there's one line at the end, which is actually a very crucial line, which is, we want to think about how bank and non-bank lending to firms and households is going to affect monetary policy transmission. But this does not mean looking only into lending outcomes. It means going all the way to the impact on prices and inflation, because ultimately this is what we have in our mandate. And so what you have on this chart here is the distribution of these many projects that Philip described that we right now have on Workstream 1. And you see, as you would expect, that the vast majority of them are in the first 4 blocks that are about monetary policy transmission through banks to the firms. But then we also have an encouraging number of projects on non-banks. We have much fewer on households, and so this is an area where we want to work much harder. And we have even fewer on the impact on prices and inflation. And again, this is where also lots of work is underway. So the network is starting. This is the inaugural conference, but I think we already can share some initial results, some things that are already underway. And so let me do these around 4 blocks. And first start with the more challenging one, which is precisely this full transmission all the way to prices and inflation. And so one thing that we can already say to you is that monetary policy shapes prices through bank lending. And to support this claim, there's evidence coming from Sweden showing us that quantitative easing led to an increase in producer prices, and this works mostly through the firms with higher levels of leverage. Then, on top of this, one project that we're working on is to try to understand how banks' market power and consumer price elasticities are going to affect the transmission of monetary policy to inflation. And here what we want to do is to think about the firm as being squeezed in between the pressures exerted by the bank's market powers and the demand elasticities of consumers. Then on non-banks, there's also interesting work underway. Let me highlight these results coming from Denmark that show us that the rise of non-bank financial institutions affect the transmission of monetary policy. So these non-banks increase credit supply after monetary policy tightening, and this is both relative to banks, but even in absolute terms. And then the authors of this paper show that this has real effects on investment and on household consumption. So then we have a block on transmission to firms, and this is, as I said already, this is a block that could be 10 slides, and we would have many exciting results to share. Let me just highlight a few of them. And so, for instance, there's a paper that's going to be in the program of the conference, so you're going to be able to see it later, showing us how the green transition affects the transmission of monetary policy. And so what the authors of the paper find is that when monetary policy tightens, lending is relatively less constrained for the green firms. Then there's also evidence coming from Italy about the role of cash holdings, and so this is an aspect where there's clearly more research to be done. And so for Italy, what the authors find is that banks lend more and with lower interest rates to cash risk companies, and so this has important effects for monetary policy transmission. Then, as Philip mentioned, beyond these bottom-up projects where researchers have contributed with their ongoing work and early ideas, we're also leading these coordinated cross-country projects where we want to really steer research to address some of the questions we have in the mandate. And so in this field, we currently have underway a project about the transmission of monetary policy through banks in smaller euro area countries, where the transmission seems to be somewhat weaker. And so here there's a team of researchers from different central banks across the SCB looking into two possible reasons, at least, for why this transmission can be weaker, and the top candidates are market power and the role of foreign bank ownership. And then finally, on households, there's evidence on, for instance, how different characteristics in mortgage markets and housing markets are important to shape the transmission through bank lending. So, for instance, when we have more variable rate mortgages or a higher rate of home ownership, this is going to amplify the effects of monetary policy transmission. And also here, as I told you already, we really want to push more research in this area. And so here we also have coordinated cross-country efforts to work on the national credit registers that have household data. First, to establish a set of stylized facts that allow us to better understand the transmission, and then to go deeper on understanding some differences in this transmission.
So let me move on to the second work stream on transmission of monetary policy through the real economy. Here our mandate is really putting forward the analysis of transmission through production networks, especially in a time of reorganization of global and local value chain. And a second area of where we want to invest a lot is the interplay between structural changes that are ongoing in our economy and monetary policy transmission, either looking at how these structural changes are affecting monetary policy transmission, but also how monetary policy can affect those structural changes. You also see on the right hand side of the slide how our projects are distributed among the various topics. Naturally, because data is more easily available on structural changes, a large fraction of the projects that are ongoing in our work stream are on the interplay between monetary policy and those structural change. But you can see that a very significant fraction of our ongoing research is also about the transmission through production networks. This is due to the fact that more and more countries in the euro area and outside and in the EU more globally have access to either detailed firm-to-firm transaction data that allows to characterize in a very precise way the way the production networks of our economies are organized, or also using more detailed input-output analysis. So there is a lot of work also on the transmission through production networks. And I would like to as Diana also highlight some first emerging results from our analysis, and focusing first on the production network dimension. We have already a very interesting analysis based on firm-to-firm transaction data that was looking at how firm transmitted their cost, the change in their input cost into their own prices through firm-to-firm linkages. And what was emerging from this analysis done for using Belgian data was that firms were passing those only partially those input cost increases into their own prices. And because of the network structure and the input-output linkages, of course, those incomplete pass-throughs are accumulated over the production network, which may dampen and delay the transmission of monetary policy. An interesting result of that research was to show that, however, if in normal time transmission is incomplete, when firms are facing common shocks like the recent energy price increase, even if that period was not covered by the analysis, they tend to see that their firms tend to more fully pass on cost change into their prices. Let me also say a few words about the global supply chain pressure and the impact on inflation. We also have evidence that shows that these global supply chain pressures have played a role in recent euro area inflation development, and that these pressures tend to have a persistent and unshaped effect on inflation due to the nature of those pressures, which are by nature somehow persistent, but have also cumulative effects over the value chain at the various stage of productions. In the setting of production networks, I want to mention two initiatives that is ongoing in the ChaMP network to have coordinated exercise. So, as I said, more and more countries have access to detailed firm-level B2B transaction data. And in the context of ChaMP, I think like 6 countries have this type of data set available, and that will allow us to better understand which firms are the most affected by monetary policy shock, for instance. That's one. So it will increase our comprehension of the heterogeneous transmission of monetary policy in the economy. In complement to that micro-based analysis, we also plan to develop some new Keynesian model using multiple country data with multiple sectors and input-output linkages. Basically, what we want to do with the help of one of our consultants, Elisa Rubo, we want to bring our econometric model to the euro area data. Can move. Let me be quick on the other two types of results that we have. We have some papers that are already documenting some interesting real effects of monetary policy in European country. We have evidence that accommodative monetary policy tend to somehow have positive effects on on potential positive effects on productivity growth by first improving capital allocation, efficient allocation of inputs, and also by increasing competition among firms, because accommodative monetary policy stimulates the growth of small firms compared to large firms. We also have evidence that monetary tightening, on the opposite, may affect negatively competition by increasing concentration among large firms, especially because they are reducing entry rate. It reduces entry rate of firms in the economy. Another results on the real effects of monetary policy is related to labor markets, which was mentioned in the introduction speech. We have evidence that tightening of monetary policy seems to amplify employment fluctuations over the business cycle significantly more than an exponentially monetary policy shock. Finally, I think we have to say a few words about carbon transition. It's really an important topic in the current context. And there, without coming with definitive conclusions, let me mention one contribution based on a new Canadian models with environmental externalities that tend to indicate that conventional monetary policy is an untargeted climate instrument, and therefore it should focus more on price stability, but that there is room for like unconventional monetary policy effects through the corporate bond, some tilted corporate bond purchases that can accelerate decarbonization of the economy, even if that effect is relatively small.
So that leads us to conclude this short introduction of the ChaMP network. This busy slide that you see is the last one that shows you a bit the activities we are running. The skeleton of the ChaMP network is a series of workshops. We have around 3 a year. Then we do trainings, both on data, like complex data, like big data, like AnaCredit, or on methodologies, modern new methodologies to research on monetary transmission. We also have an online seminar series going on. And then, of course, there are these public conferences, which this one is the first. There will be a concluding one. We don't know yet whether there will be an intermediate one. So you have seen the people who run the ChaMP network. If you want to know more, you can have now very briefly, since we are pretty much out of time, the chance to ask a question or two. But otherwise, you can talk to us in the corridors, in the breaks. So while you are gathering your thoughts, whether there is any question, so if you have a question, please stand up and state your name and affiliation. If there no questions at this point, we've already congested a little bit with the long presentation, but that was it from us for now. And we wish you all success and pleasure in following all the sessions on the papers from outside and from within the ChaMP network. Thank you very much.
Yeah.
So good morning, my name is Christoph Kamps. Welcome to the first session of today, which will deal with supply chains, monetary policy, and inflation. Let me welcome also all our speakers, and I will introduce them when they present their papers. I mean, as we have seen also in Isabel's scene setter and also the presentation we just got, of course, supply chains and shortages and how they affect the economy, inflation, and also how they interact with monetary policy that is in place when shortages start to bind, but also how they trickle through the economy and impact on the setting of monetary policy is, of course, a most topical issue. And so I'm very much looking forward to the three papers, which take the question from different angles and as you will see, are very insightful for us and more broadly. So let me first give the floor to Diego Comín, who is a professor of economics at Dartmouth College, and he will present a paper co-authored with Robert Johnson and Callum Jones on supply chain constraints and inflation. In line with today's topics, supply chains constraints, you will have a constraint of 30 minutes.
It will be mine.
And then this will be followed by the discussion, and I will introduce Michel at that time. So please, Diego, the floor is yours.
Thank you. That's the one that works. I would like to thank the organizers for inviting us to this inaugural session to present the first paper and for allowing us to expose our research to the ECB community. As it was mentioned, this joint work with Callum Jones and Rob Johnson. And having some technical difficulties with the clicker doesn't work. Cool. Okay. So let me start by showing you some data. Okay. So if you look at this data, what you see is the evolution of inflation. This is all for the US. What you can see is that the last 4 years have been extremely unusual. There's been huge increase in prices relative to what we're used to, but there's been significant difference across sectors. The increases have been mostly concentrated in goods, and when prices start to decline, obviously they decline more in goods. Services grew more slowly, and now they are higher. Inflation in services higher than in goods. Okay. Now let's look for a second to the quantities. When we look at consumption, real consumption in goods and services, what you see is that after COVID, the consumption of goods went to the roof, and it remained very, very high for a long, long time, while the consumption of services took a long time to recover. This is consumption. What about production? When you look at output produced, the patterns are very different. For services, it's very similar to consumption. Basically, services, the production of services plummeted, and then it recovered slowly. But for goods, what we see is that the production of goods didn't recover until very recently. Okay, so though we were consuming an enormous amount of goods, we were not producing. There was like a wall, and we couldn't basically push our production to the level where consumption was. Okay. How is that possible? Well, that's possible because we were importing a huge number of final goods in the US. Okay? The imports of final goods, which are here on the right, you can see the solid line. 2020 plummeted, but then in 2021 they went to the roof. The import of final goods in the US clearly was unconstrained. There was a huge amount of containers coming full of goods to the US ports and flown in other ways in 2021, 2022. However, this is in sharp contrast with the import of intermediate goods, okay? Intermediates, which is the dashed line here to the right, the quantities follow much more the patterns of production of domestic goods in the US, okay? We hit a wall, we were clearly, like, we couldn't go over that wall, okay? Now, let me focus a little bit more on imports, but now let's look at prices, okay? So we have these different patterns for the imports, the quantities imported for goods and services. What about prices? Here, the patterns, again, are very interesting. If you look at imports, in general, the price of imports increased a lot. But when you focus on goods, which is this dashed line in the middle, basically, there was no action. The price of imported goods was roughly flat. The huge increase in import prices is entirely driven by the imports of intermediates, okay? And this is not energy. Energy, if you remove energy from the picture, you still have huge increases in the price of intermediates, okay? So when you put together this data, this very simple data, what does emerge? What's the smoking, who is holding the smoking gun here? Well, basically what this is telling us is that when you look at goods and for domestic goods and foreign intermediates, there is an increase in the demand for these goods, a cap on the amount produced, huge increase in prices, okay? So this seems like first order suspicious evidence that there is some capacity constraint that applies the production of domestic goods, the production of foreign intermediates, okay? You would like to produce more, you cannot, and as a result, prices go to the roof, okay? So the goal of this paper is to study this possibility, okay? To study whether capacity constraints were to blame in a significant part for this surge in inflation. And if so, what type of capacity constraints are we talking about? Are we talking about capacity constraints for domestic production? Are we talking about capacity constraints for foreign production? That's the first question that we would like to understand. The second question we would like to understand is why were capacity constraints binding? Were they binding because there were negative shocks to supply that reduced our capacity to produce? Or were they binding because demand was exploding and that was making the existing capacity insufficient to produce what we were demanding, okay? Those are the two main questions that we want to explore. And to answer these questions, we're going to develop a very standard framework. It's a plain vanilla framework. It's a multi-sector, small open economy, neo-Keynesian framework. Okay? This is the bread and butter model that most of you use. There's going to be a continuum of monopolistic competitive firms. Demand side, the preferences are going to be completely standard, CES. There's going to be some input-output linkages in line with the spirit of this ChaMP network. We're going to have both imported, so there's going to be a domestic input-output linkages. There's going to be imports of intermediate goods and final goods from abroad. Pricing is going to be standard. There's going to be dollar invoicing. There's going to be some price rigidities. Here we model them a la Rothenberg, but that's not critical. And there's going to be a standard Taylor rule, okay? So everything is very, very standard. The twist, the only new ingredient in our recipe, is that we're going to allow for the possibility that there are capacity constraints in the production of domestic final goods and foreign intermediates that could occasionally be binding, okay? So in normal times, this is not going to be binding, but eventually, if there are some negative shocks to supply or if demand is very, very large, this constraint is going to be binding, okay? What does this do to the framework, okay? So to illustrate that, let me show you the pricing problem of the firm, okay? So this is a standard pricing problem of a firm that is determining what's the price that they want to charge for the differentiated good, given the marginal cost, given the cost of adjusting prices, and given the demand they are facing, okay? So everything is completely standard. The third line is the variation, okay? There is potentially a constraint that is binding. Output cannot be greater that certain level that is going to evolve stochastically, okay? That's how we're going to conceptualize capacity constraints, okay? It's a constraint in the amount that you can produce. Where does it come from? It could come many places. Maybe you cannot find your intermediate goods. Maybe you have to shut down the factory. Maybe workers don't arrive to your factory. At some point, in some extensions that we have, we are going to separate some of these differences to illustrate what's the relevant constraint, okay? I won't have time to talk about them. That's in the paper. So the solution to this problem is given by these first-order conditions. And if, forgetting about capacity constraints, the solution to this problem is that the producer wants to solve this trade-off between adjusting prices to keep this constant markup over marginal cost and reducing the cost of adjusting prices. So he wants to, if there is a big increase in the marginal cost, he will not fully adjust the prices because that's going to cost a very large cost of adjustment, okay? That's the normal trade-off in these frameworks. The twist now is that when capacity constraints are binding, there's going to be a multiplier associated to this constraint that is going to show up in the pricing equation, okay? And what that means, basically, what that reflects is the fact that, this was related to the question I posed in the previous session, is that when capacity constraint is binding, the price is going to be determined by demand, okay? So I don't face any trade-off anymore. I basically want to raise the price until the demand curve meets my capacity that is binding, okay? And that's what this multiplier reflects. It's a reduced form for the fact that now the price is going to be demand determined, okay? So in other words, the price is going to go to the roof because the producer says, okay, I need to sell 10 units, which are the ones I have available. I'm going to give them to whoever is willing to pay more, okay? So the supply curve is going to be vertical, okay? Fully vertical. Now, how does this affect the Phillips curve, okay? So if you linearize the model, you impose symmetry, basically what this is going to create is Phillips curves, which take the following form. So this is Phillips curve, for example, for home prices, for domestic goods. In sector S, we're going to have multiple sectors. This is a completely standard Phillips curve, other than for the fact that now you're going to have this multiplier stick there, that when the constraint is binding, is going to push the Phillips curve higher, okay? It's going to make it completely vertical, okay? Now, if you look at it, you may say, well, this is just a cost push shock. This is, something that reflects a markup shock. The reality is that it's not. This has nothing to do with changes in the cost structure. This has nothing to do with changes in the elasticity of substitution across differentiated goods that provide market power to the producers. This is just a reflection of the fact that this producer is constrained and needs to set a price that clears the market, okay? So it's very different from the standard explanations that people gave early on to the increase in inflation from estimation of standard Phillips curve, okay? So they were estimating Phillips curve, and they were seeing like now that these error terms were bigger and bigger, okay? So one consequence of this framework is that because you are jacking up the prices and you are not affecting, basically because you don't face any trade-off between price and quantities, the profits per unit of output are going to go to the roof, okay? And this is something that we have seen in the data. If you focus on manufacturing, which is our, our proxy for good sectors, the profits have gone to the roof, okay? And that's consistent with our framework, okay? Okay. Now, what this allows us what this provides us is an identification strategy for these multipliers, okay? This tells us whether the constraints are binding or not, but it doesn't tell us why the constraints are binding, okay? To understand why the constraints are binding, you have to look at quantities, okay? If when the constraints are binding, you see that quantities go up, the answer is that they are binding because demand is going to the roof, okay? If when the constraints are binding, the quantities go down, then the reason why they are binding is that there is a negative shock to capacity, okay? That's basically how our exercise is going to work. Okay, so let me talk briefly about the other elements, okay? I've mostly discussed all this. We're going to work on two sectors, goods and services. In this baseline, labor is going to be homogeneous and mobile across sectors. There's going to be some exports that are going to be modeled as a function of foreign output. There's going to be some real marginal cost to foreign production that is going to be the same for final and intermediate goods. It's going to be sector specific. The constraints, as I mentioned, they are going to be potentially binding in the production of domestic goods and the production of final foreign intermediate goods. And the monetary policy rule is going to take the standard Taylor form, and we're going to have here at the end possibility of monetary policy shocks. Those are going to play a very important role. Okay, the shocks we're going to have are going to be shocks, two different shocks to demand in this baseline. There's going to be time discount shocks. There's going to be a shock to the composition in expenditure between, so it's a taste shock between goods and services. Monetary policy shock I already mentioned. Shocks to capacity in these two production places. Shocks to the marginal to marginal costs that take the form of TFP shocks and in each of the sectors domestically, and shocks to foreign production, to the marginal cost in foreign production. Okay. So let me talk a little bit about the model dynamics. Okay. So it's fundamental to realize that once you have binding capacity constraints, or the possibility that capacity constraints are binding, that's going to lead to very non-linear dynamics in this model. Okay. That's a reality that needs to be embraced. Okay, you cannot throw that under the rug, because that has humongous implications for inflation. Okay, and for the understanding of the drivers of inflation during COVID. So what that means is that the solution to this model, it's going to take this form where the coefficients on each of these in this policy function are going to depend on the state of the economy and on the shocks, in addition to the structural parameters. Okay, they are not going to be constant coefficients as we typically have in standard macro models in normal times. Okay, now again, the reason why this state of the economy and shocks matter is because they determine whether the constraints are binding and for how long agents expect that these constraints are going to be binding. Okay? And depending on how long the agents expect that the constraint is going to be binding, the dynamics of the model are going to be different. Okay? So that means that you can rewrite this general solution in this particular way, where this term D is a vector of durations, expected durations, that these constraints are going to be binding at each point in time. Okay? That's how we capture that. If D is equal to 0, it means that the constraint is not binding. If D is equal to 1, it means that the constraint, for example, the domestic production constraint, is expected to be binding for 1 quarter. Okay? So you can parameterize these matrices of coefficients in this particular way. And that means that you can approximate, in this context, you can approximate the solution with a piecewise linear solution where the coefficients are going to depend on the expected durations, okay? And you can follow, for example, the Gorilla-Jacobi algorithm, of Bean, to solve this model by which you make a guess on this matrix D, and then you solve the model under that guess, and then you verify that that guess is correct, okay? So this is how you compute the solution to the model. However, we are interested not in simulating the model, we're interested in estimating it, in backing out all this information, the shocks and the information about the constraint capacity, whether it's binding or not, from the data, okay? So how are we going to proceed? Well, first, as normal, we're going to calibrate a few parameters in the model. We're going to calibrate some standard parameters. We're going to calibrate the capacity levels in steady state, okay? That's not going to be critical for the results. We're going to estimate, as normal, the parameters, structural parameters that define, the elasticity of substitution and the production functions, as well as the shocks in the model. Okay. The critical difference with standard approaches is that we are also going to estimate these expected durations. Okay. Now, it's important to understand one issue here. Expected durations are an equilibrium outcome. Okay? Duration, whether the constraint is binding or not, is something which is endogenous. Okay? So our solution, our estimation approach, starts from the premise that these are parameters that you can back out from the data, you can estimate from the data, okay? However, you need to do something else to make sure that these parameters that you back out are consistent with the rational equilibrium solution of the model, okay? So how are we going to do that? How are we going to ensure that everything is correct? Well, we're going to write the likelihood function of this model, not just as a function of structural parameters or shocks, but as a function of these expected durations, okay? And these expected durations, okay, we're going to have separate priors for the structural parameters and shocks and for these expected durations. And what we're going to do is when we take a random draw of parameters and durations, we're going to keep only those draws for which the durations that we draw are consistent with the model dynamics, okay? And so in this way, we're going to implement a notion that we have invented. We have certainly invented the name. I think the notion we have invented it too. It's called rational expectations durations, okay? So the durations that we're going to use to estimate, so we're going to draw the estimates effectively only from the parameters are going to be drawn only over durations that are consistent with the rational equilibriums for the model, okay? Here, I describe exactly how we do it, but I won't have time. Now, very importantly, this is a process that works well, okay? So we have validated the approach by running some Monte Carlo simulations in which we have taken, 70 periods, and we have simulated this many times, but imposing a restriction that in certain periods, we're going to have very large monetary policy shocks that are going to cause the capacity constraint to be binding, okay? What we have been able to do is we have estimated positive durations for these periods where the capacity constraint is binding, as you would expect. We have shown that the inverse log likelihood is minimized in the true duration every quarter, and we have estimated multipliers in each of these quarters that are very similar to the actual multipliers that come from the simulation of the actual shocks in the model, okay? So the procedure works well, okay? This is not something that just makes sense a priori, but a posteriori, we have proven that this is a valid way to back out from the data this information about when and by how much and which capacity constraints are binding. Okay, so let me use the last 10 minutes to describe some of the results, okay? So we estimate the model using, again, US data from 1990. Actually, that's not correct. We go all the way until the end of 2023, okay? So we have basically gone and redone everything until the last data available. The observables in this baseline are consumer inflation and expenditure for each of these two sectors, goods and services, industrial production and aggregate nominal GDP, value added per worker in each of the sectors. That will give us some information about the productivity of the sector. We'll also have information on inflation and expenditure for imported final goods and imported intermediate goods. And the measure we use in the baseline of the monetary policy rule is the Wu and Xia shadow rate, okay? Because we want to have a measure that takes into account the fact that the Fed has done much more than just set the Fed funds rate, okay? We have tried to use as observable the Fed funds rate, but incorporate an additional constraint, which, the first constraint for which these things were invented, which is the zero lower bound, okay? And we have found that the results are the same, okay? So it's just it's simpler to have two constraints than to have three constraints. But when we have added a third constraint and we have taken literally the measure of the interest rate to be the Fed funds rate, with the possibility of the ZLB, we get the same numbers, okay? Okay, so I want to talk about the model fit. Then I want to talk about what role do capacity constraints play, so whether capacity constraints are binding or not binding, and when. Third, I want to talk about what role do capacity constraints have played in inflation dynamics. And finally, I want to do a historical decomposition to understand which shocks have caused capacity constraints to bind and have produced inflation, okay? That's the road plan for the next minutes. Okay, so The first thing I want to show you quickly is that the model does a good job in replicating the inflation series that we have seen in the US during this period. The first panel is for aggregate inflation. Then we have for the three of the sectors that we have consumers goods, we have consumer services, and then we have imported intermediate goods. Okay, and you can see that the model does a good job in replicating. So we're going to be working with inflation series that are pretty close to the actual data. Okay, so were capacity constraints, was capacity binding? The answer is yes, it was binding both in the final goods sector and in the foreign intermediate goods sectors. Okay, so you can see that the final goods sector it was initially binding the first quarter in COVID. Okay, then it was not binding, and then it went binding again during 2021. Okay, big time. Capacity was binding during 2022 and started becoming more slack in 23. By the end of 23, it doesn't seem to be binding. Okay. What about foreign constraint? The foreign constraint is even more stark. Not much happened the first part of 2020. Towards the end of 2020, it starts binding, remains binding all the way until mid 2022, and then basically it's not binding anymore. Okay. Okay. So second question: how much or what's the impact of capacity constraints being binding on inflation? Okay. To answer this question, what we do is we run a counterfactual by which we take the estimated shocks and we feed them into our model in a version of the model where there is no capacity constraints. Okay. So in this way, we can simulate what's the impact of the shocks that hit the economy if capacity constraints were not an issue. And the answer is here. Okay. So solid line is the actual data, the inflation in the data. The dashed line in the bottom, this is the inflation that we would have had with the same shocks, but without a binding capacity constraints. Okay? And the answer, is basically capacity constraints explain half of the additional inflation that we had over this period. Okay? These shocks that we have, if there was no capacity constraint binding, we have produced half of the inflation that we have experienced in the US over this period. So this is significant. Okay. Now, now I'm going to separate between goods and services. Okay. And what you can see is that in the goods there is a very significant effect of capacity constraints. That, to some extent, is not surprising because you have a production constraint a constraint in the production of US goods, domestic goods. But there is also a very significant effect on inflation for services, even though we have imposed no constraint in the production of services. Okay? Why is that? Well, this has to do with the transmission. Okay? This has to do with the fact that constraints in the production of goods. So first, you use goods to produce services, both domestic and foreign intermediate goods to produce services. And so anything that happens to goods is going to be affecting services. But second, there is an effect on wages. Okay? And wages are going to be higher when capacity constraint is binding. And that's going to be affecting more services because services are more labor intensive. Okay? Okay. Now let's go to these historical decompositions. Now we're trying to understand which shocks were causing capacity constraints to bind, and therefore which shocks were causing inflation. Okay? This figure may be a bit confusing. It requires some time because we have many shocks here. Okay? In solid, you have the actual inflation. And so what you can see is that initially there was these capacity constraint shocks that were causing inflation in 2020. Okay? So whatever happened in 2020 to a large extent happened directly through capacity constraints. We have a fiscal extension later where we separate these demand shocks between fiscal and non-fiscal shocks, and fiscal also play a significant role in 2020. Okay, that you cannot see it here. But then when you look at 21, which is when inflation started, and 22, the direct effect of the capacity constraint shocks, these are negative shocks that reduce capacity, diminishes, and monetary policy shocks becomes much more important. Okay. Now, if you stare sufficiently at this plot, one thing that you will notice is that if you add up all the lines, they don't add up to the total inflation. Okay. Some periods they don't get anywhere close. Okay. Why is that? Well, this is proof of the importance of the non-linearities of this model, okay? There is significant complementarities between these two shocks, okay? And that's something that, again, because we have a structural model, and because we have a solution method that allows for these nonlinear dynamics, we can study, okay? How do we study? We're going to study by doing the same exercise, but now combining shocks, okay? I would like to understand what happens if I take a monetary policy shock and I evaluate the impact of the monetary policy shock at the estimated level each point in time of capacity, okay? So that's basically combining the capacity shock and the monetary policy shock, okay? And I'm going to do that for all the different shocks. And this is what comes out, okay? Now, what you can see is that the monetary policy shock explains all the, can explain by itself all the increase in inflation in 2021. And it increases to a large extent why inflation persisted and was so high in 2022, and why inflation decreased so much after 2022, okay? So, monetary policy was critical to explain inflation after COVID, both the increase and the decrease, okay? Why is that? Well, let me show you why. So here in solid, you have the Taylor rule, okay? So this is basically the rule component of the monetary policy equation I showed you before, okay? And in dash, you have the shadow rate, okay? This is basically what the Fed was doing, like, effectively, okay? And what you can see is that at the beginning, the Fed was quite contractionary, okay? But around 21, they became extremely expansionary. Look at this, okay? 400 basis points gap between the Taylor rule and what the Fed was doing, okay? Then when the Fed started compressing it in 22, then inflation starts to decrease, okay? So yes, the Fed is to blame, okay? The Fed is to blame. Maybe the ECB was to blame too. We are going to reproduce this for Europe if we manage to compile the data, okay? Okay, so which constraint was more binding? Well, you can do the same analysis separating domestic and foreign constraints. Both were important. Domestic constraints were more relevant than foreign constraints, okay? Okay, so let me just brief in 5 seconds the extensions that we do. We look at energy, both by removing energy from the data and by building models where energy plays a bigger role. It doesn't change anything. It doesn't change the importance of capacity constraints. It doesn't change the importance of monetary policy shocks. We add up markup shocks, and we show that that doesn't affect at all the analysis. We're able to identify separately these multipliers from markup shocks. We enrich significant labor market. I know. We enrich significant labor market by adding labor supply shocks, by adding the possibility that there are constraints in the supply of labor, and we expand the model to allow for a fiscal sector, okay? So let me just conclude because I'm out of time. So what have we done here? We have developed a quantitative framework to study inflation that places capacity constraints at the center stage. Binding constraints introduce a wedge in the Phillips curve in the relation between inflation and marginal cost, real marginal cost. Quantitatively, we find that binding constraints explain half of the increase in inflation during 21 and 22. And the reason why constraints are binding is a combination of demand triggered by monetary policy and negative capacity shocks, okay? Thank you very much.
Thank you so much, Diego, for this excellent first talk. And now I give the floor to Michel Gassibe, who's a researcher at CRI and affiliated professor at Barcelona School of Economics, for his discussion. Please, 15 minutes.
All right. Thanks so much for the opportunity to present at this conference and for the chance to discuss this very, very interesting paper. In which I actually have a lot of private interest. When I was a PhD student 3-4 years ago, and you mentioned that you wanted to work on inflation, people said, come on, it's kind of always stable. It's always about 2%. You should probably treat that as a parameter. And I'm very glad at a private level that it's back in the spotlight. So in these figures, we see that With the COVID recession, inflation went back up, which of course created a lot of issues, including issues for people in this room. But for researchers, it created a lot of opportunities to explore and test theories that could not be tested before. That's a very private, selfish perspective. But I'm glad that this paper addressed a lot of these issues. So what do we have is that in the COVID crisis, inflation went up. Both consumer price inflation and import price inflation, and we need a model that can think about episodes of higher inflation. And the kind of popular narrative that you could hear in a lot of newspapers and TV channels and so on, that what happened is that as kind of demand went back up after the initial lockdowns, you could not recover production very quickly, either domestic production, or you could not quickly import things to satisfy this demand. So firms had to raise their prices to address for that. And this paper provides a very powerful academic assessment of the popular narratives, which is the approach to research I very much agree with. Again, which is why I was very glad to read this paper. And in particular, it kind of develops a model that has all the ingredients that are necessary to think about this question rigorously. So to think about both kind of domestic supply constraints and foreign supply constraints. You need a model with an open economy, so with domestic and foreign firms. You need a lot of sectors to think about sectoral heterogeneity. Of course, you need price rigidities to think about inflation and the role of central bank policy. Of course, you need production networks to think about kind of shocks that originate in specific sectors propagating to the rest of the economy. And of course, to really assess the popular narrative about the role of supply constraints, you actually need to model these supply constraints at the firm level rigorously, which is exactly what this model does, and that's really the main theoretical contribution, embedding the firm level capacity constraints. And then the model is estimated with state-of-the-art techniques, and crucially, it can very well account for the inflation surge that we observed. And then kind of the key finding is that capacity constraints were indeed very important. They account for about 2 percentage points of the increase in inflation that we saw in the episode, so it's kind of economically significant. All right, let me briefly walk through the theoretical and quantitative contribution before offering some comments. So the real theoretical contribution is embedding these firm-level capacity constraints into an otherwise standard multi-sector model. So for some firm omega in sector S, there is a capacity constraint which says that you cannot really produce beyond some level Y bar. And as Diego excellently explained in the presentation, what happens is that if you hit this constraint, you will start adjusting your prices until the point where there's exactly the amount you provide. And these kind of multipliers and the capacity constraints, they need to price to demand, show up in a linear equilibrium as endogenous markup shocks in the Phillips curve. So we have a standard New Keynesian Phillips curve. Inflation is expected inflation, plus real marginal cost, plus this extra term, which usually in the textbook of Jordi Galí would be the exogenous cost push shock, but here's an endogenous cost push shock coming from multipliers on the capacity constraints. And if it's positive, so indeed you're hitting the constraints, that means they need to price to demand. All right, so the markup shock interpretation is a really kind of tractable way to not only think about capacity constraints, but also to distinguish capacity constraints from other sources of the inflation surge, which would work either through derailing expectations or through kind of changes in the real marginal cost. So that's kind of very powerful and a very good way to decompose that. So the first quantitative contribution is the fact that the model actually fits inflation dynamics very well. So when you estimate the model, you see that it can account very well for all the surges in inflation levels, so that's very good. The second one is that you can actually test whether or not these capacity constraints were important. In explaining that, you can see that in the periods of the COVID recession, the capacity constraints were binding, as we can see from the positive multipliers, which indicates that they were indeed important in accounting for the inflation surge. The third quantitative contribution is saying what would happen in the absence of capacity constraints. So we see that if we were to remove the capacity constraints, not only goods inflation would have been substantially lower, that's sort of a direct effect, but also the services inflation would have been lower, which reflects its propagation through input-output linkages, both domestic and foreign. And finally, I think a very interesting, also conceptual point is the role of specific shocks. That when you decompose the surge in inflation within the model into what shocks are driving that, no specific shocks can account for that. So you really need a combination of all the shocks. You need a combination of the supply shocks and the monetary and demand shocks and the capacity constraint shocks together in order to account for the surge. So these kind of nonlinearities, I think, is something we should learn from this paper and think hard about that in future papers, which I'm sure there'll be loads of on this topic. Now, let me offer 2 comments, which I hope will trigger further discussion later, because it's a topic I kind of feel very passionate about. So the first one is something that I believe Isabel actually mentioned in her speech, and I think it's something everyone should be focusing on now. That's the role of the extensive margin of price adjustment, and or the endogenous rise in the frequency of price adjustment that we were seeing in the data. And my kind of main comment is that the model, despite all the richness of it, cannot speak to that at all. So the model relies on Rothenberg price adjustment costs, where all the changes in prices are happening at the intensive margin. So what happens is that firms that hit these capacity constraints, they're simply deciding to adjust by more. So regardless of whether the capacity constraint is binding, there is no extensive margin decisions. All firms are always adjusting. The only difference is that by how much they are adjusting. That's the intensive margin. And here I want to play a little bit of a devil's advocate and try and see what would happen in the kind of diagonal opposite of this model, where everything worked through the extensive margin. So the simplest way to think about that is to take a framework with fixed menu costs and no capacity constraints, an analytically tractable model with fixed menu cost and networks actually, is coming from my recent work with Alessandro Ferrari. And in that paper, we derived something which looks like a New Keynesian-Phillips curve in a static model for now, but with the extensive margin of price adjustment with menu costs. And what we can see is that the New Keynesian-Phillips curve in this world looks like inflation equals the real marginal cost, where the coefficient on the real marginal cost is just like in the Gali textbook. And then we have 2 terms that look exactly like endogenous cost push shock. So you have the extensive margin effect, or the kind of increase in the fraction of firms that are adjusting, which is driving inflation up. And you have the selection effect, or the change in the composition of firms adjusting. So if firms that are adjusting are the ones that are adjusting by more, that acts similarly as an endogenous cost push shock. So crucially, these 2 effects, the extensive margin effect and the selection effect, are once again isomorphic to a markup shock, and this isomorphism with the markup shock holds even in a model without capacity constraints. Now let me push this a little bit further. So the selection effect is something it's very hard to measure in the data directly, but what we can measure in the data directly is the extensive margin effect. We can look at the way in which the frequency of price adjustment changed in the COVID episode. And with that, we can actually evaluate whether or not this endogenous markup shock, which we see in the Phillips curve, was driven largely by the extensive margin. And if it wasn't, that means it must have come from the intensive margin. So here, I'm plotting the data for the US from a paper by Hugh Montag and Daniel Villar. So what they plot is 3 objects. They plot the inflation in the US in the COVID area, in the COVID period, that's the green line. And then they plot the frequency of price adjustment in red, and the average size of price adjustment. So the frequency of price adjustment here is like a measure of the extensive margin effect, which is isomorphic to an endogenous cost markup shock. The average size of price adjustment is like the measure of the intensive margin effect, which is what Diego and his co-authors kind of assigned to endogenous markup shock. So we can see that in the period when inflation surged, we saw a massive increase in the frequency of price adjustment. So we saw a big extensive margin effect, but we did not see a very powerful change in the average size of price adjustment, which is indeed what was driving Diego's endogenous markup shock. So what can we take away from this? Perhaps the model could be enriched to also allow for the extensive margin of price adjustment to ensure that these capacity constraints actually affect firms' desire to adjust or not. In that case, the model could really generate variation in these endogenous markup shocks that is coming from the extensive margin rather than coming from the intensive margin as it currently does in the paper. And that's my real takeaway here, that the extensive margin, which also shows up as an endogenous markup shock, seems to be more important than the intensive margin, which is currently the mechanism that is studied in the paper. So that's the first comment. My second comment is the role of domestic and international production networks. So just to come back to this figure, we've seen that both goods and services inflation would have been lower in the absence of capacity constraints. So for goods, this story is kind of very intuitive. So we know exactly why that happened. That's just a direct effect from the capacity constraints. For services inflation, the idea is that services buy inputs from the goods sectors, either domestically or internationally, which makes the capacity constraint-based inflation propagate to their marginal cost, ultimately forcing them to raise their prices too. So what we're talking about here is that the input-output relationships are crucial for explaining the dynamics of services inflation in particular. And I think this is where the paper, with the richness of the model, could say a lot more. So, I mean, I have three specific questions. So imagine I had a counterfactual economy where I simply had a multi-sector setup, but without production networks. What would have been the counterfactual path of inflation in that world? So with that, we can really quantify the role of the input-output structure as a whole. And that's a non-trivial point, because in a lot of models that we see without sticky prices, networks are kind of irrelevant beyond their effect on sizes of things. So here we can really test for the network irrelevance by conducting these exercises with production networks. The second would be good to see whether specific sectors, that have very high or low centrality, Bonazzi centrality, for example, were responsible for this propagation to services. So we can try and switch off sectors one by one from the network by adjusting the kind of input-output coefficients and see that whether in the absence of specific sectors, the whole dynamics of inflation would have been different. And my third point is about the domestic versus international networks, as well as the effect of reshoring. So the two exercises I have in mind here are the following. So imagine that we only had the domestic network, but we had no international network whatsoever. How would that change the dynamics of inflation in this world? Imagine we had the opposite. The country was somehow outsourcing everything to abroad and was fully reliant on imported intermediate inputs. What would inflation dynamics look in that world? That's something that can be easily quantified in the rich quantitative framework. And then another topic and catchy word of the day is reshoring. So imagine that we decided to restructure the input-output setup such that for certain key industries, which we consider key for political reasons, for example, we for some reason decided to bring that back home and only buy those inputs domestically. So it's like a targeted reorganization of the network. Again, what would the effect of that be on inflation either now or in light of similar shocks in the future? So overall, I think the framework is extremely rich. It can really explore this network dimension much more closely. And I think it will be very useful for both policymakers and academics. So I think with that, I'll have to conclude. So I think it's a very, very timely, very insightful, and a very far-reaching contribution. It's important for both academics and for policymakers, as I'm sure we'll all agree. And I very much, I'm very grateful for the chance to read and discuss this paper. I've learned a lot. Thank you.
Thank you very much, Michel, for this insightful discussion. We can now take a couple of questions from the floor, and then I would give Diego also an opportunity to react to Michel's discussion. So please.
Could I react first?
You want to react first?
Yeah,
okay.
Because I didn't sleep very well last night, and so my memory is very constrained. So first, I want to thank you for your discussion and for looking at the paper with so much care and affection. Yes, I mean, the world is more complicated than our model, okay? We're guilty. But I think that the reality that you describe with that figure is very similar to what we have in mind in our model, okay? Yes, the extensive margin probably is very important, but what I saw in that figure, other than the fact that one was in, very shiny green and the intensive was in very light black that I could barely see, is that both go up, okay? They are in different scales, so if you scale them properly, both are going to move a lot, and I think that the reason why, you want to adjust is because the gap is larger and you want to adjust by more. So I think both margins are important in the data. I think for our story, it really doesn't matter, because basically when you hit the constraint, you are going to adjust prices and you're going to adjust it by a significant margin. We model it in a particular way. We are, especially Rob and I, are not monetary economists. We are not pricing people. So for us, we just want to use a framework that allows us to analyze these things in the simplest way. I'm sure that we can enrich this much more and do it more carefully. But I think that for the analysis and the results of the analysis, I don't think that's critical. And I take the comments on the networks. I mean, I think these are things that we can check. Sorry.
Right. No, thank you. So questions from the floor? Yes, please just wait 1 second for the mic, and if you could please stand up and give your affiliation.
Yeah, Philip Pfeiffer, European Commission. Diego, thank you for a great presentation. My question is whether you've considered some special situation of the pandemic, namely a shift in sectoral preferences of consumption. So you mentioned aggregate demand shocks, such as monetary policy, but it could also be that we have a large shift towards goods that can be consumed at home that might trigger a stronger than expected increase in capacity constraints in these sectors specifically. Thank you.
Yes, we include that in the model. I'm a structural transformations guy, at least for one paper, and so when I look at that figure, the share of expenditure that goes to consumption, how it changed. Basically, it was the closest thing I've seen in my life to an earthquake in economics. Basically, you were going back like 40 years in 1 quarter. I thought, wow, this is huge. So we were like extremely biased to find, mentally to finding like that matters. But there are 2 demand shocks. One is actually we have 3. We have the fiscal shock, the time discount rate, and the sectorial composition shock, the taste shock. The last one is the least important, which is very surprising, but it really doesn't matter much. So this is why we aggregate all demand shocks in one. Sometimes we separate with fiscal, but yeah, it's surprisingly unimportant.
Yeah, Benoit, please. Oh, sorry.
Yes, so you said you estimated the model for a fairly long history, going back, and you presented essentially the recent period, but I was curious whether there were previous instances where capacity constraints did make a difference and were significant.
So we have gone back. So in this exercise I show you, basically we allow capacity constraints to bind starting in 2020, but we have gone back earlier, and we don't find that we have ever been close. So I think that this is the interesting thing about this thing is that this is a one in a lifetime. I don't think that the central banks, okay, just understand whether I blame them before. I have to give them some understanding. This is something that is happened for the first time, and so the next paper we are working on is to try to understand this from a normative perspective, allowing for uncertainty in the beliefs of the central banks.
Thanks. So I have 2 more questions.
Hi, Diego. This is Federico from the Bank of Italy. Thank you very much for the insightful presentation. When thinking about the question you're tackling, I was just simply looking at the Fred data, right? And I saw immediately that capacity constraints. So I went to capacity utilization, and I didn't see that it actually raised too much with respect to the historical levels. On the other hand, then I went to manufacturing orders, and they raised a lot. And so this seems, on one hand, that yes, there were a lot more orders. On the other hand, I didn't really see that capacity utilization went to 100%, for instance, stayed to 80. And so from this, I was just wondering, through the lens of your model, can you point at some sufficient statistic or something from the data that would tell us when the probability of being at this binding constraint becomes very high? Yeah, thank you.
Yeah, there is a long literature criticizing utilization measures from the board and from other, going back to Shapiro, that basically puts them at a very, very low level of trust. So this is one figure from Fred that somebody pointed to me that I think is, first order sign that what we are saying makes sense. if you look at investment in infrastructure in manufacturing, okay, like, you know, buildings and factories, and it was flat always. It was completely flat, okay? And then starting in 22, it more than doubled within the year. It's amazing. Like, you know, you look at the data, flat. And then at the point where you see that, like, you know, with a delay, of course, that capacities are binding, then suddenly people start building new factories and invest massively in infrastructure in the US. That's an incredible figure. Check it in Fred, and it's, to me, it's like, you know, this is something that we didn't try to. I mean, it's something that we learn ex post.
Okay, then Frank, please.
Great paper. At the end, you mentioned that you also look at the labor market,
yes,
which is, of course, one of the other alternative narratives. I was wondering, what did you find?
Yes. So we basically allow for both. So we re-estimate the model matching hours, nominal wage growth, and we allow for shocks to, we introduce wage rigidities, we have a wage Phillips curve, and we allow for shocks to labor supply, and also we introduce an additional constraint on the number of hours that workers can supply, okay? Suppose that you want to supply more, but suppose that on top of it there is a constraint, sorry, you cannot go to the factory, okay? We find that those constraints are important in 2020 for 1 quarter. Okay, like basically when factories close and when you couldn't leave, that quarter they are massive. Okay, after that they are not important basically. And the role of production capacity constraints remains unaltered, and the role of monetary policy remains unaltered. Okay, so I have in my slides the results, so you can, or in the paper it's all there. But basically what the model is, what the analysis says clearly is that it's not about workers having negative shocks to labor supply. That's not the reason why inflation went up. It's not about reallocation between sectors of labor. It's not about constraints on the supply of labor other than in the first quarter of 2020.
Okay, thank you very much. I think we need to move on, but let me thank Diego and Michel for an excellent first part of the session.
Thank you very much.
You can stay here if you want. And so with that, we move to the second paper. It's a pleasure to introduce Maria Sunta Gianetti, who will present a paper also on supply chain shortages, but focusing on the role of market power of large firms. And then we have the discussion by Almut Balea from the RWE Institute. So, please.
So thank you for having me here. It is a pleasure to be at another network that is organized by Philippe. At the beginning of my career, I benefited a lot from a network on financial integration. So it is, I'm very happy to be here again. So I will talk about the supply chain shortages as well, and I will have a very different take because consistent with my co-author expertise, we look at microdata and we will look at the effect of supply chain shortages, how they differ between firms and how they differ between industries. And also, I don't have to convince you that supply chain shortages were important during the pandemic period when they hit the headlines. But actually, if we look at the data, or if we think of events like Japanese earthquake, Thai floods, these events have been affecting some industries around the world before. So we will try to learn from a longer panel. So again, as I mentioned at the beginning, we have a micro approach, and what we are interested in understanding is whether when supply chain shortages occur, some companies' competitive position actually improves relative to others. And of course, if this was the case, supply chain shortages would affect competition, would affect the pricing, and ultimately this shock could be related to inflation. So what do we have in mind? We have a very simple theoretical framework in order to motivate our analysis. So our intuition is that when supply chain shortages occur, suppliers, as they have been shown in many other contexts, they might favor their most important customers. So for instance, Luke has worked on trade credit that provides lots of evidence of this. So this might happen when suppliers have to decide to whom to deliver the inputs. So what happens if the largest companies that I will call superstar consistent with previous literature get relatively more delivery? Well, a supply chain shortages shock will increase differences in cost between firms in an industry. So what if we think of this and the effect on the industry equilibrium? Well, we solve this using a very simple Cournot model. And basically what the model implies is that, well, if the difference in cost between the largest company in an industry and the smaller one increase, the larger companies will be able to increase their market shares and also markup. So this is something that doesn't derive from a poor cost pass-through, but is rather an effect that derives from a decrease in competition, deriving from the fact that now the cost advantage of a superstar company is larger. So basically, at the micro level, what we expect to observe is that supply chain shortages should be related to an increase in market share, markup, and profits of the largest company in an industry. Now let's think of what happens in terms of industry equilibrium. In which industry should this effect that we have in mind be more important? Well, this supplier favoritism should arise to a larger extent in industries in which firm size is more widely distributed and in industries in which there are relatively more large firms coexisting with small firms. So basically, in terms of our simple Cournot model, what this would imply is that when there is an asymmetric shock to the cost of the firm in the industry arising from shortages, industry concentration increases more in industries that are ex-ante more concentrated. Now, this is interesting because it has an effect on markups. Again, if we take literally the Cournot model that we use as a workhorse for illustrative reasons, what we have is that in equilibrium, there is a structural relationship between the HHI in the industry and the aggregate markup in the industry. That is, well, relatively more of the output is provided by the largest company, but the largest companies are the ones that received the inputs that are producing closer to their optimal points and are those for which costs increased to a lower extent. So this is static, is how can we relate this to inflation? Well, in order to relate it to inflation, we think in terms of a change of the equation that you see in the slide. That is, there is a cost shock that in industries that have ex-ante higher concentration leads to a higher increase in concentration that leads to a higher increase in markup. So this is our conceptual framework that motivates the kind of empirical facts that I will go and look at in the data. So in order to tell you where we are going to aim, let me give you a preview of the results. So I'm here because indeed, when we look at the firm level, what we observe is that the results are consistent with the idea that one effect of supply chain shortages is to increase differences in costs between firms. That is, we observe that concentration in industries increased. Star firms have been suffering less from supply chain shortages, and actually their profits increased relative to the smaller competitors and their markup as well. What are the mechanisms behind these results? Well, first of all our story is based on an asymmetric effect of the supply chain shortages on the cost of these companies. And using microdata, we can document that evidence is consistent with that. But the basic story that is behind our idea is that there is this supplier favoritism. Can we show that in the data? Well, we show it in two different ways. Most of our empirical analysis is conducted on an international sample, so the US and Europe are as important. But in order to pin down the mechanism, we purchased data on maritime imports to the US. And from this data, we observe precisely who the supplier is and to whom is shipping. So we can document that indeed, in periods of supply chain shortages, that is not only during the COVID crisis, suppliers tend to ship more, according to many different metrics that I will show you, to their largest customers. That is, star firms obtain the shipment and can produce at their optimal point level. And if we extend this analysis to the international sample for which we don't have the shipment, what we can show is that we have a customer-suppliers link. So we can look a bit, as we are used to do in banking, at the customers of the same firm. So our hypothesis would imply that the larger customers of a given firm should perform relatively better in periods of supply chain shortages. And this is precisely what we are able to show. So based on this micro evidence, we go a bit more aggregate and we try to explain what happened at the industry level. So what do we find? Well, we find that indeed industries that are ex ante more concentrated experience a higher increase in concentration when the supply chain shortages occur, and that industries that are relatively more concentrated when supply chain shortages occur experience higher inflation. So this is, on average, true in a sample period that starts in the beginning of 2000. But of course, the result is much stronger during the COVID pandemics. And just to give you an idea, if I think in terms of cross-sectional differences between industry, we explain about 24% of the variation in realized inflation. So basically, what we provide is a channel and empirical evidence to explain why, in equilibrium, competition might have decreased during the pandemic period, leading to an inflation shock. So the data that, let me jump over the related literature in the sake of time, and let me talk about the data. The data that we use are fairly standard. So when I will talk about firm level data, we actually mostly work with larger listed companies from WorldScope. And I will then in order to construct the production network, for the international sample, I will just use customer supplier links from fact set. So basically what I observe is important customers. But I will also use this data on maritime shipment from Pagiva, and then basically keeping constant these overseas suppliers, I will be able to look exactly at who are they shipping to. What I have to, I want to stress a bit more is how do I capture the presence of supply chain shortages between industries and between different geographical areas. So what we do in the current version of the paper is that we obtain purchase manager indexes from S&P, and we have a measure that varies between broad industries and geographical area. What is this measure capturing? Well, the underlying data that, of course, we don't have from S&P are a survey in which companies are asked whether their suppliers are late in delivering inputs. And basically, the delay is measured relative to the previous quarter. So if you look at this figure, basically, I will base all the presentation on the delivery time. So what you see is how supply chain shortages are becoming stronger over the previous quarter. So this kind of measure is sort of already a change. We plan to measure shortages in future version of the paper, so also constructing an index based on the maritime shipment, but currently we are not yet there. So delivery delays will be our measure for supply chain shortages. So let's look at some empirical evidence. So how do we perform our empirical analysis? So we start from the firm level test. And again, we will relate the firm level performance of a firm that is in a given industry and in a given country in a given year to the measure of supply chain shortages. But crucially, what we are interested in is not much the direct effect of supply chain shortages that may capture many other shocks, but how within the industry different firms are performing. So what I will test is whether star companies tend to perform relatively better. What is a superstar here? Well, we define a superstar as the top 10% of companies in an industry worldwide. So, and then we will saturate the effect, the equation with fixed effects, and all what I will show you today is based on differential performance within a country, industry, and year. So what do we find? We start from market shares and profitability. And what you observe here is that, well, when we increase delivery times by 1 standard deviation, basically the market share and profitability of a superstar firm increase respectively by 10% and 40%. Of course, this is relative to smaller firms in their own industry. But this is basically consistent with the evidence that has been often noted that during the pandemics, firm profitability has actually increased. So could this just be due to cost shocks and differences in markup? And this is what has been widely stressed in existing literature. So our mechanism has a different flavor because it is based on a change in competition that is typically not something that is underlying stories based on pass-through. So how do we try to test for this? We do two types of tests. First, we focus on energy shocks. So why are energy shocks interesting for us? Well, energy is not rationed. Any company that wants to pay the current price can purchase oil and gas. So we wouldn't necessarily expect the same effects arising from supply chain shortages. And therefore, we substitute a measure for energy cost to our proxy for delivery delays. And what you observe is that there is no evidence that superstar firms are less affected by energy shocks. And this is the case also when we consider firms in industries that are more energy dependent. Then we look at a markup in order to microfound our channel. So what is markup here? Well, we use several measures of markup, all inspired by the Locker and co-authors' production approach. And what you observe here is that, again, consistent with our mechanism, what you observe is that star firm markup have increased in period of supply chain shortages, and that the effect is there for the full sample and is there also for the COVID period. In this context, we revisit the mechanism of the cost pass-through. Specifically, we ask, does this effect of delivery delays on higher markup for star company might depend on the fact that star companies have different pass-through? Using company financial statements, we are able to measure cost shock, meaning that we observe the change in the cost of goods sold. So not only we can control for the cost for changes in the cost of goods sold, but I can also allow star firms to have a different pass-through of the effect of the cost of goods sold. And what you observe is that this effect for sure doesn't subsume our mechanism that is based on, that is competition driven. So, and basically these differences in performance between star firms and other firms within the industry in periods of supply chain shortages appear also when we look at the stock returns. So basically what we argue is that realized shocks to supply chains can help explain why large companies have been basically driving the positive market stock market performance that we have been seeing in the last few years. So let's go through the mechanism. Again, our mechanism is based on an asymmetric effect of supply chain shortages on the cost of goods sold. And then we will test also the mechanism based on supply chain favoritism. So here you see that indeed changes in cost of goods sold are different between large firms and other firms. And in particular, in periods of supply chain shortages, the cost of goods sold of superstar firms increases to a lower extent. So, but it's true that this depends on the fact that suppliers favor larger customers in periods of shortages. So we use the data on shipment from Panjiva, and so here, my unit of observation will be the relationship. That is, for each suppliers, I am able to observe the US customers, and therefore, I can fully absorb the supplier's ability to ship goods using supplier and time fixed effects. So what do we observe? What you have here is different measures of flow of goods to a given suppliers to different customers. And we look at this both on the extensive and the intensive margin. So whether we look at whether anything is shipped during a quarter, the number of container, number of shipment, weight, volume, quantity, we continue to find that when delivery times from suppliers to customers in an industry increase, star firms receive more of the input. And the effects are substantial. So for instance, if I try to measure the size of the shipment in terms of number of containers, what I have is that shipment to superstar firms, these very large companies, are 43% larger. I can try to look at this in my larger sample. So what I will have here is that my unit of observation is still the relationship. I can still absorb a supplier level shock using interaction of supplier firm and time fixed effect. And then I look at the measure of performance based on market share and profitability. And basically, the earlier, more micro-founded result is fully supported. So there is another mechanism that I didn't mention yet that can contribute to the competitive advantage of these larger companies. And is basically assortative matching. So this is largely an empirical question. In general, in international trade, what we know is that the largest companies have more global supply chains. And in principle, they could have been relatively more exposed to shocks. But there is an alternative mechanism that might be at work. And the alternative mechanism is that very large companies tend to have very large suppliers. So if a star company has a star suppliers, also the supplier will be less affected by supply chain shortages, sort of amplifying our mechanism. So what we observe is that this mechanism is at work. Star firms are more likely to be associated with star firms, and therefore, also from this assortative matching channel is a selection channel, reinforces our finding. So we consider a possible alternative mechanism in the paper. For instance, our delivery delays and firm size could be capturing exposure to financial constraints. We don't find that controlling for cash holding, access to external financial markets affects our results. Also, we don't find that our results are driven by the fact that this star company have more operational flexibility, for instance, because they have higher inventories. So let's go to the industry level analysis. So far, I've been focusing on firms, but is what happened at the industry level. So again, if controlling for the cost shock, these supply chain shortages have led to higher inflation, what I should observe within my conceptual framework is that industry concentration increases more in industries that are ex ante more concentrated when supply chain shortages occur. So this is what I will go on and test again, for the US and for the advanced economies. So what do we observe here? Well, we observe that consistent with our hypothesis, in ex-ante more concentrated industries, when there are supply chain shortages, we observe a larger increase in the HHI. So then we go to, we consider the effect on inflation, but I will estimate reduced firms. So basically what I'm doing here is that I am relating the supply chain shortages shock to the ex-ante HHI of an industry. So what do we observe? Well, both in the full sample and especially if I focus on the COVID period, what I observe is that in the increase in inflation within an industry in these periods of supply chain shortages has been larger in ex-ante more concentrated industries. And I can control for cost shock experienced by different industries and also for different pass-through. We look at different measures for industry concentration. So for instance, whether industries have superstar firms and what is the proportion of superstar firms. And basically is within this context, what I can show you is that if we increase by 1 standard deviation the measure of proportion of superstar firms sales in an industry, and I look at periods with relatively higher supply chain shortages, we are able to explain some 24% of cross-sectional differences in inflation between industries. And what you see here is that the effects are both qualitatively and quantitatively similar if I split the sample between European Union and the US. So let me wrap up. What I've shown you is that not only cost shock were important, but to some extent, when these supply chain shortages occur, we have to take into account that the effect is not homogeneous between firms in an industry. And since there is overwhelming evidence in firm-level studies that suppliers tend to favor their larger customers in many different ways, it is not very surprising that this favoritism emerges to a large extent also in periods of supply chain shortages. So this mechanism can help explain why, when supply chain shortages occur, competition decreases and why prices can increase at the same time as profit margin. And thank you for your attention.
Thank you so much, Maria Assunta. And then we move to the discussion by Almut. Please, 15 minutes.
Okay, thank you very much for inviting me to discuss this very interesting paper, which touches upon a very important point which we all care about, what drives inflation. And as Maria Assunta already said, what's the point here is really not only to think about how supply shocks themselves drive inflation, but how supply shocks affect something else that is visible in what we call markups and that you can relate to competition, and how that then in turn drives inflation. And obviously you can relate that to a very popular or unpopular narrative of, do we see something like greedflation in the data or not, and how important is it if you think that gaining market share is something we could call greed or not, or at least that's how the paper is written and motivated. So if a paper tries to address this unpopular or popular question, obviously then there will be a lot of pushback on the story. And I think the narrative that the paper tells here is somehow convincing. Or it's easy to believe that narrative. So it works as follows, and you already explained that really well. We have these supply chain shortages. There's a lot of evidence on that, so that's a fact. And then it may be that some firms are exposed differently to these supply chain shortages, which we could think of as cost shocks, than other firms. And if these are particularly large firms, or as the paper calls them, superstar firms, then that basically gives them a better competitive position, and maybe they use that in order to gain market share. And so this lower exposure to supply chain shortages enables firms to gain market power. And if that market power is then used to pass through higher prices to consumers, we would actually see an increase in inflation that we may or may not, if we want to use that term, call greedflation or not. So the narrative depends on these three steps, and all of these three steps basically falling or going together. And what the paper does, it has, and you spent quite some time talking about that, it has a stylized model on the relationship between firm-specific cost or exposure to cost and competition. So basically these first 2 points that I have on the slides here. And then you collect a lot of data from different sources that you call microdata, but it's actually measured at different levels. Sometimes more firm levels, sometimes more sectoral levels, comes from different countries, different time horizon, but that assembles information on supply chain shortages, profitability, markups, and consumer price inflation, both inside and outside the pandemic. So that in itself is already a big contribution, I would say. It's very insightful to see it. And then Maria Sunta and her co-authors use these data to run different empirical exercises, let's say, to convince us that all of these three steps or all of these three parts of the narrative fall in place. So you show in particularly that the profitability of markups decreases less in large firms, or let's call them superstar firms, when supply shocks occur. You show us that large or superstar firms can in fact increase their market shares with whatever measure you use in order to measure that. And then inflation rises more strongly after supply shocks in sectors with higher concentration. That was the last bit. And this last bit is important because that you then use in order to make the point that you said 24% of inflation during the pandemic can be explained by this mechanism. Okay. So what I will do is I will assess the assumption we start with in order to go into this narrative, and the very last step on whether this actually drives inflation or not. So I will tackle your story from the ends, let's say, from the very starting point and the very end. So let's start with the first point. So what we need to believe in order to tell this story is that there is different firm exposure to supply side constraints. So what the paper does is it uses firm level information on finances and suppliers. So you explained this really well. So we know who the customers are, we know who the suppliers are. And then you have information which you didn't talk about in detail from the survey of purchasing managers on these delivery times of inputs and also on supplier backlogs. So this is sectoral information. So what you basically do is you look at the composition of suppliers of a particular firm, you see what sectors they are in, and then you match the information from the purchasing manager index to that. So that means that the measure is more a sectoral measure of exposure to supply shocks than an actual firm measure, unless the sectoral composition of suppliers varies a lot within a sector. So we should think of this as a sectoral level of exposure to supply constraints, where we then see that some firms increase profitability more than others. We should not think of this measure, at least that's my interpretation, as a firm-specific measure of exposure to sectoral shocks. That we don't see, and you don't claim that. We don't see that. So that's obviously one point you can take further. So we don't really actually see differential exposure to these supply shocks. We just see that profitability in these sectors that are generally more exposed is different for some firms than for others. And we don't really know why. So then obviously it matters a lot that your supply shortage measure is something that actually measures changes in costs rather than changes in demand, maybe, which we would also see in differential profitability outcomes. So the measure you focused more on is the delivery time of suppliers, which I think is a really good measure of supply constraints, because that really measures upstream pressure on the supply chain. The backlog measure that you did not talk that much about may not be such a good measure, because that obviously could be downward pressure on demand, which you may not necessarily want to measure here. So you cannot directly test the differential exposure with your data. You can do that if you go to firm-level data. And there is really good firm-level data for many European countries that can actually measure this directly. So let me show you some of that data. This is the German data, but it exists in other European countries as well. It's from the IFO survey, which is a big firm-level survey data for Germany that underlies the business climate index. So it's leading managers answering this survey. It's representative for manufacturing. We can also look at outside and inside the COVID recession. So here we have a question on whether the domestic production is constrained by lack of materials or pre-materials, which is the inputs by suppliers. It's very closely linked to the delivery time question that you have in your purchasing manager index. And here, because we have a firm level data, we can actually look at heterogeneity in these supply constraints. Okay, so this is a plot from that. What we see when we look at this data is that between industry variation accounts for only 3.2% of the total variation. And that means, obviously, in reverse, that there's a lot of within heterogeneity in these firms answering whether they're exposed to supply constraints or not, which is exactly what you need for your story, because you want differential exposure within narrow industries, the same product market, essentially, of differential firms. So that's good. That goes in the favor of your story, that we actually have a variation in exposure. Then the next question is, obviously, which firms are this? So here I took a very crude measure of large or small, which may not exactly link to your superstar definition. And in our data, at least, we do not see a higher likelihood of large firms to be exposed to these material constraints or to these supply chain shortages. It may be, if you do different sample that's more closely linked, you could do this in this data, then you will get a higher likelihood of these firms to actually be exposed to these supply shocks. But that's something you could do in microdata. Okay, then tackling your narrative from the very last point of view. If we then believe that maybe there is differential exposure to supply chains, and you use that in order to gain market share, and I think that is a strong part of the paper, because you have a model that explains how you gain market share if you have differential cost exposures. You have a lot of data assembled that makes this point very convincing. Then obviously the elephant in the room, in order to tell the story about greedflation, is does this then also map into price decisions and into inflation? So here, and you showed this in the end, you run a sectoral regression that shows us that in industries with higher exposure to supply constraints and that are more concentrated, the CPI is higher. But we don't know which of these firms drive inflation in these industries and which do not. Your narrative tells us it should be the firms that are less exposed to the supply shocks because they gain market share and they increase prices. Again, you could look at firm-level data with pricing decisions and directly see whether the firms that actually are exposed or less exposed to these supply shocks, what type of price decisions do they take? Are these actually the firms that increase the prices, or they increase the prices by more and therefore actually drive inflation? So you do not have that direct evidence, but you could do it. And as I said, I think this is the elephant in the room, because obviously most mechanisms that we know in macroeconomic models would tell us if you gain a market share, or in order to gain market share in an industry, what you would do is probably you would decrease prices. If you have a cost advantage as a firm over other firms, what you would do is, first at least, you would decrease prices, and then maybe only eventually, after concentration has changed in your favor, then you would increase prices. So it could be, if we see an increase in inflation in a sector, with high exposure to supply constraint, it could be the small supply constrained firms that increase prices and not necessarily the large, less constrained firms that increase prices, which is not exactly in line with your story or your mechanism. It maybe would call for different policy conclusions. So again, you could look, I think you could directly try and look at firm level data. So here I have some evidence that is, again, not exactly what you would need in order to put the narrative together, but that would give you at least an inkling on that we have to think about this more carefully, I think. So this is a local projection where we look at an expansionary monetary policy shock and distinguish supply constrained and unconstrained firms in this IFO data that I previously showed, and look at their price responses, so firm level price responses. And clearly you see that the predominant message here is that the supply constraint, those firms that actually do face these supply constraints, those increase prices predominantly. That's the red line on the left-hand side. Whereas the firms that are not constrained or they do not face, they're maybe less exposed to these supply constraints, that's the blue line on the left-hand side, they do not increase prices as strongly or as much. This is actually a frequency of price changes. So, in your story, we would think that these unexposed firms, they should be the ones that increase prices. Maybe they don't do that initially, but at least eventually, they should become more and more important. But if this is an important mechanism to understand inflation, we would at least hope that this difference between these two firms is much smaller than what we see here. Again, this is maybe not exactly the sample you would need in order to compare that to the evidence you showed us, but it's something you can do in microdata to make the story more convincing and to go this last mile to also say then, if we think that competition has changed due to supply shock exposure, we would actually also see consequences in inflation because of that. Okay. So the last point I want to make is, and what I was missing from the paper is really a stand on what does this now mean for economic policy? So you're very silent about that, and it's probably also because it's difficult to make, or tricky to make stance on economic policy. But what I think is you show most convincingly in the paper is that there is an effect on competition. Or there is an effect on market shares or concentration. Maybe I shouldn't call it competition. And that would obviously call as a clear message for economic policymakers to monitor at least, or to regulate competition, or to think about how shocks could actually change competition and what we should do about that. This may even be irrespective of inflation, but may also be in order to, to fight adverse effects of shocks transmitting through the economy in a particular way that competition changes, and through that may be affecting inflation. Since it's not entirely clear, at least in my viewpoint, whether and how these gains in market share translate into inflation, we need to think about this a bit harder because of economic policy, because that could mean that maybe this is a result of demand-side policy, monetary policy being too expansionary maybe at some points in time, but that would be a completely different economic policy conclusion than saying we have to, for example, tax profits, as some of the prominent commentators in the greedflation debate have done, in order to fight inflation, which is, I think, not a clear takeaway from your paper, at least just yet. Okay, thanks.
Okay. Thank you very much, Almut. Would you like to react to the discussion first, and then we take a couple of questions?
Thank you. Let me briefly respond, and thanks a lot for the excellent discussion. I would like to push back mostly on 2 points. If I took my data, I didn't consider the effects within an industry. Obviously, I would observe that the price increases are larger in constrained industries, okay? So I have to look within an industry, and I'm not sure what you really look in your graph that seems to be inconsistent with my evidence. I would have to read your paper. But what I want to highlight is, obviously it would be nice to have price level data, And given the approach that we have taken in this particular paper, it would be probably another paper. I would say that we have shown that there is an effect on prices because we do this looking at the markup and the cost shock. So basically, since we are aware that we don't have prices, we look at, we think of an industry as having an homogeneous product and one price. And then if we observe that the markup, that is the profit per unit sold for a company that is large increase, we would think that this is related to a decrease in competition. And obviously it's very important to, so we know that there are shortages in an industry, but it's of course important to measure these firm level exposure. And so the direction in which we are going, that was not yet in the paper, so I apologize, is really going and zooming in with this shipment. But of course, we can look also more at survey data that are probably reserved, right? Or yes, but I will check it. Yeah. So, but I think the shipment is something that we really observe, and we don't have to rely on what companies say. So.
Thank you very much. So we have time for some questions from the audience. Otherwise, Diego also? Okay, please.
Is it okay? Yeah. Just a quick question. I wonder, I find interesting the endogenous effect on the degree of market concentration of HHI. Do you have any sense, or potentially will be something to look at, whether it's persistent? So whether these effects that they may cause, whether they last, because they will of course imply not about an effect, not only about the current level of inflation that it may have, but how it changes also for future shocks that may continue. Yes. And the second point or related question was, you mentioned resilience and you mentioned inventories for resilience. I wonder whether network of alternative suppliers may also play a role. Think of also how many they are engaging with. A bigger company, if I think of the banking literature, multiple relationships, one gets hit, you can easily switch to something else. And if you think the superstar firm may already engage with a multiplicity of alternative suppliers, that may allow them more flexibility. And I wonder if there's something you do about that.
Yeah. So thank you for the question. So on the dynamic effects, I didn't show because we still have very large standard deviation, and I guess that future indexes that are more precise will help us in that direction. But we observe that the effects on market shares are persistent. Probably there are differences in investment but the effects on profitability are not, suggesting that there is some market contestability that makes this effect transient. Okay. So the effect on the question about the resilience is, it is without a doubt that star companies may be more resilient. And what I showed on the assortative matching, to some extent, goes in that direction, in the sense that, well, star firms have suppliers that are more resilient, and we can also look at their supply chain and look whether they are more diversified and so on. And this is, to some extent, also important from the point of view, for the way in which you interpret the analysis. Meaning that greedflation is just, well, is exercise of market power and an increase in profit that perhaps the antitrust authority should address. On the other hand, if some companies are more resilient, this is a part of their intangible asset and their investment that must be remunerated. And to some extent, also for this reason, we were more positive from the point of view of the description of the empirical evidence rather than normative, at least so far in our implications.
Thanks. So I have Frank and then Diego.
My question is related to the question about persistence.
Mm-hmm.
The effect on market concentration, is it mostly through the intensive margin or the extensive margin? I mean, have you looked at exit of firms? And in that case, no, you can have more permanent effects.
So, I mean, this is, again, an excellent question, and it's also important. What I showed you must be considered entirely through the intensive margin, but this is because of the nature of my data, because I am working with listed companies' data. So to some extent, the mechanism that we have in mind is relatively weak in the larger listed companies that we are working with in WorldScope. It is entirely possible that these shortages drive cost to infinity for relatively smaller firms. And what I would expect to observe if I go to a data set like Orbis is that there is also exit. But we didn't go in that direction yet.
So, great paper and great discussion. I mean, lots of very interesting facts, and that I think provide lots of nuisance to the different colors and shapes of capacity constraints, and how that impacts prices of different players. So I like a lot also the discussion facts. Now I have a question regarding the interpretation of your driving variable, which is this delay in shipment. I mean, that could be driven both by direct shocks to capacity, negative shocks to capacity, or to increasing demand. It could be the case that like you are delayed because there's lots of demand. And so this increase in demand could have independent effects on pricing policy, in pricing practices, okay? That could be asymmetric also across these two different types of firms.
Yeah.
So that's my only word of caution about this. But I love the notion that if you find a company that is more resilient, that has a better network than another one, then a negative supply chain shock is going to affect it less, and that's going to affect their pricing and obviously their market share. So I think that's very interesting.
So I completely agree with what you just said. We started from these delivery delays because we thought, well, okay, there is shortages, of course, can derive from supply. There is a port close, or can derive from an increase in demand. Everyone wants to buy a bag, right? And at the beginning, we thought, well, we want to see how these companies are splitting the market. But you are entirely right, and we are equally concerned that a demand shock at the end can be asymmetric between firms, meaning that there are supply chain uncertainty. We want to go to the most reputable suppliers, right? And I think that would affect too much the interpretation of our result for us to be comfortable with it. So this is precisely the reason why we bought this maritime shipment data, because in that case, we would really observe how many relationships are how many customers during a given quarters do not receive a shipment. And for instance, Ale Tisinski at Yale has been developing a supply chain risk, a supply chain shortages index based on those shipment data. That would allow us to get closer to an interpretation based on a supply chain shock. That's of deliveries that don't arrive for exogenous reason. That is, at the end, what we would like to measure. But otherwise, I agree that this alternative explanation ought to be ruled out.
Okay, so thank you very much for this first part of the first session. We're going to have a break now until 12:05. So I invite you to grab a coffee, but also please visit the posters. We will have a poster session, meet the authors, and then looking forward to seeing you again for the third paper. Thank you. So welcome back to the final paper of the first session. I'm very happy to introduce Il-Yang Li from Beijing University of International Business and Economics, who will present a co-authored paper on global supply chain disruptions and their effect on macroeconomic outcomes, so nicely complementing the two papers we saw earlier this morning. And then we will have the discussion by Hilde Bjørnland from the Norwegian Business School. So very happy to have you here, and we'll start with you.
Okay, thank you so much for having me here again. This is actually the second time that we have presented this paper at the ECB. So we presented the same thing last year at the Inflation Drivers and Dynamics Conference. But I promise you, for this time, we bring something new to the floor, which we are really excited to share with you. So this is a co-authored paper, as I said, with Xiwen, Jesus, and Francesco. And the motivation of this paper is actually very straightforward because we have been discussing the health of global supply chain disruptions and their causal effects for a very long time. But this paper actually focuses on the COVID-19 pandemic, but now I think it carries a more wider implication because, for example, the Red Sea crisis that we are currently experiencing, and also this rising geopolitical fragmentation, which I believe also fall into this category of global supply chain disruptions. So for this study, we think, even though most of the focus is on the COVID, but it still bears more stuff to be understood for the wider, thought of global supply chain disruptions. And then now, even though this is a question that we put forward for the paper, but now is actually becoming our agenda, which is what are the causal effects and policy implications of global supply chain disruptions? And then for this very paper, we wanted to break that into three very specific questions. The first one will be how could we actually measure the supply chain disruption shock? And then in this very paper, we have developed a index of global supply chain disruptions based on the satellite data of container ships using machine learning and also very granular data. So in this case, we wanted to compare our index with some of the popular indices online, for example, shipping costs, and also this global supply chain pressure index compiled by the New York Fed. And we will show you that, even though we are not the perfect measure, but we believe on some, fronts, our index could offer better insights into how this global supply chain disruptions have escalated, essentially. And then this is the first specific question. The second one will be something that we want to do with the help of theoretical model. In this sense, we wanted to distinguish what we call a supply chain disruption shock from what we normally see in macro papers, for example, like a demand shock, and also what we call a productive capacity shock. In this sense, you can understand this productive capacity shock as a labor supply shock. So here we wanted to say, okay, now we have these three types of shocks, and then we wanted to see how each of them compares to the others and how different they are in terms of the macroeconomic impacts on some macro variables. So that's the second question we wanted to answer. And then, the last one, which I believe it is also the most important one, is what will be the policy implications coming from, this analysis of global supply chain disruptions. In particular, we wanted to break that into two parts. The first one will be, in facing a supply chain disruption shock, should we actually do a monetary tightening in order to tackle its, stagflationary effects, or should we just, using a whole steady approach? So this is the first question we wanted to talk about. The second one will be, okay, now if we wanted to do the first one, which is, monetary tightening, how aggressive should we be, when we're trying to raise the policy rates? So that is crucial because, we all know that there is a very classic trade-off when using a tightening of monetary policy. That is, you're going to have to sacrifice activities and output to get inflation controlled. But then, just in facing this policy trade-off, should we do not need to care about it too much during global supply chain disruptions, or should we still care about it? I'm going to give you an answer to that just right away. Okay, speaking of our contributions in this very paper, so it's quite long actually, but we try to summarize that into 4 parts. The first one is that we develop a very new spatial clustering algorithm, essentially to transform the satellite data of container ships into a high-frequency index of port congestion that is applicable to all the major ports around the world. So this is a very novel thing, because previously we really rely on macro theories, more macro indices to gauge the health of global supply, global supply chain. But now I'm offering you that with this satellite data and some, very simple machine learning tactics, you can actually go into this question and have a comprehensive coverage of how the global supply chain disruptions have spanned out around the globe. So this is the first thing. And what we get out of this is an index of global supply chain disruptions, which we could directly use in a time series analysis, for example, using SVRs or local projections. And then it comes to the second part of our paper, which is we wanted to use a framework, for example, the SVRs with sign and zero restrictions. But in order to use the sign restrictions, we need to come up with some theoretical foundation for them, because when we wanted to separate, for example, the causal effects of a demand shock from that of a supply chain disruption shock, we impose a positive sign on unemployment. But how, do we have a theoretical foundation for this positive sign? So that's why we develop a very novel and a simple theory that tries to rationalize how we impose these sign restrictions on the macro aggregates in response to each of the 3 shocks that I just mentioned. And it is very simple, because all we need from it are just comparative statics, so we can impose the sign restrictions. I'm going to show you a little bit of this in this presentation, but I'm not going to the technical details. So now I have an index from the first part of the paper. I have now, from the second part, some of the sign restrictions, sign and zero restrictions, the identification restrictions. Now it's ready to put them together into the very standard SVR analysis. So in here, we do a causality analysis and trying to, quantify the causal effects of global supply chain disruptions. In particular, even though the focus of this conference is on Europe, in the paper we focus on the States, and we show that during each different historical episodes, the main drivers behind the elevated inflation in the United States were quite different. And just in a nutshell, in 2021, it was the global supply chain disruptions that really drove inflation in the States higher up. So that's the third bit. And then it comes to the last bit, which is the policy implications. So what we did is that, okay, we still use our index and also still use our very simple model. We try to say, okay, during the global supply chain disruptions, has the trade-off between stabilizing inflation and sacrificing economic activities changed following this? So in terms of the result, we show that, okay, during the global supply chain disruptions, the supply curve has actually steepened a lot, which is consistent with the results from the previous 2 papers. And from that, we have a very simple, policy implication, which is you can be as aggressive as possible. So this is the whole paper. And then for the time's sake, I may not be able to go through some of the related literature, but you can see that the previous 2 papers are in this. So now I would really like to get into this very interesting, in my opinion, part of this paper, which is how we measure global supply chain disruptions. So as I said before, we go into this, we really focus on this containerized trade, which is, the primary mode of transporting goods around the globe. In fact, if you go back to the statistics, you can see that this containerized maritime trade actually accounts for 46% of global trading value. And more importantly, some of the other cargo that were transported over over the seas will be oil, which may not really be something that we wanted to focus on in this paper, but also some of the others could be specialized vessels, roll on, roll off. But here, containerized trade is our focus. And then another reason why we consider this is when you compare the containerized industry with some of the other maritime industries, such as dry bulk or oil, there is a very unique feature of this industry that gives us an advantage. That is, this containerized industry is very rigid in the sense that the routes, speeds of these container ships, they are rarely changed, no matter what happened to demand or other circumstances. But as I will show you a little bit later on, what happened right now in the Red Sea crisis, actually makes this statement a little bit, different from what we're actually arguing in this paper. But still, it's focusing on the global supply chain disruption. And then, as I put here in the presentation slides, just because containerized trade is so important, the roles of seaports in this containerized trade would actually affect a lot of things, because when you imagine a lot of container ships, due to logistic reasons, cannot really load or unload cargo at some ports in Europe, that will create very large problems. Okay, now it speaks to what we really mean by port congestion. We go into the maritime literature by estimating, whether a container ship will first moor in an anchorage before docking at a berth. So these are two jargons, but let me, break them out for you. So the first one is an anchorage, which is a random areas to lower the anchors, and then a berth is a designated spot to load and unload the cargo. So for fun, I just inserted two pictures for you to check. So on the left-hand side panel here, it's essentially a typical berth that we will normally see in the pictures, in the news, in the media. But then on the right-hand side, that is the anchorage, which is essentially some area outside the port where a ship can lower the anchor. So in the maritime literature, it actually is, the definition of how to quantify port congestion is pretty much fixed. So if we see a ship directly go into the berth and start loading and unloading cargo, that essentially means there is no port congestion. But it's really difficult to see these sort of situations in real life, because there is always going to be some port congestion. So you can always see, for example, from the right-hand side, a lot of container ships, they lower the anchors in these random areas, in these anchorages. So now, what we wanted to do, given this definition, could we come up with an index to measure port congestion? The answer is yes, we could do, because now we have access to the automatic identification system data, which is essentially a real-time satellite tracking system installed on these vessels. The beauty of this is that it will give you very high signals, very high information, very high frequency data on, for example, the identity of this ship, the geographical locations, the speed, and even the drought of this vessel, which is essentially, how deep the ship is submerged. So given this, automatic identification system data, along with it, we use machine learning to handle such a big, massive data, because as you can see on the slides, this AIS system actually updates information as frequently as 2 seconds. So here, it is a typical automatic identification system device that you can buy online. So for ours, due to the International Maritime Organization, every ship on the Earth, that is greater than 300 gross tonnage, will be required to install one of these devices. But for some other ships, which is even smaller, it's better to install this as well for security reasons, which essentially, makes the coverage of our sample almost universal. And then, just for the sake of this conference, I changed the picture of my original presentation, but now I'm showing you the first 50,000 AIS observations outside the port of Rotterdam, since the 1st of January 2020. So each of these blue dots represents a spatial temporal data point of a container ship outside the port of Rotterdam. So this is essentially the data we will be looking at. And how do we process that? It's essentially a supervised machine learning spatial clustering algorithm. I'm not going into the details, but essentially it takes into account the different behaviors of these container ships in berths and anchorages, and then use this information to come up with the geographical boundaries of these different locations within the port. And then we, for example, look at some of the very granular information, which I presented in this slide. On the left-hand side, you can see that we take advantage of the headings of those container ships at a berth. For example, when a ship is docking at a berth to load and unload cargo, you can expect that the headings of these container ships will be either aligned or 180 degrees, it's essentially the opposite. But then if you look at those headings of container ships at an anchorage, a random area outside the port, it's difficult for them to make this closely aligned situation, closely aligned circumstance, because the winds and the tides will make the container ships not being able to stay in a particular location for a very long time. So that's why they appear in a ring ship. So we take into account a lot of granular information like this, and then come up with our identification results, which I show here in this figure. So remember, I just showed you the raw data, but here we actually, after using the machine learning algorithm to process the data, we classified those, some of the points as anchorages and some of the other points as berths. So here in the figure, the purple, blue, and red points represent those container ships staying in anchorage. While then for those other colors, the markers of other colors, they represented berths, the berths in the ports of Rotterdam. And in particular, these are the differences between these two locations. So okay, we now have a machine learning algorithm which basically gave us the geographical boundaries of berths and anchorages for all the universe of ports, major ports around the world. So now it's time to use the information we have in the AIS data and these geographical boundaries to tell whether a ship has actually lowered the anchors in an anchorage before docking at a berth, which is essentially our definition of port congestion. So we do this in several steps. So first of all, as I said, we identify the geographical boundaries. And then we count the numbers of ships at each port that first moor in an anchorage before docking at a berth at a monthly frequency. We could do even finer temporal resolution at weekly frequency, depending on the needs. It is also possible, but here we focus on the monthly frequency. And then we calculate the congestion rate for each port by dividing the number of delayed ships by the total number of ship visits. So this is our normalization stage. And then eventually, we do a weighted average of all these congestion rates for the major ports around the world and derive this average congestion rate, which will be our index of global supply chain disruptions. So some fun facts to share with you. First of all, this is a heat map that we created for not all the container ports we consider, but the top 10 ports around the world, plus some of the major container ports that you see in Europe. For example, you can see that for periods in Greece, before the pandemic, there wasn't a very clear increasing pattern for port congestion. But during the pandemic, you can see that this port congestion has escalated, and then towards the end of the sample, it sort of faded away. Even though there were quite a lot of differences between the congestion rates across these ports, in general, you can see that there's an increase in port congestion during the pandemic phase, and that's essentially how we measure global supply chain disruption. As I said, the last step will be aggregation. Now I just show you all the congestion rates for the ports. It's time to group them together. And how does it look like? It looks like what we have in the right-hand side. So before the pandemic, from January 2017 to before the onset of the pandemic, it actually has a declining trend. So we argue in the paper that it is due to the building or improving infrastructure around the world. But just following the onset of the pandemic, you can see this average congestion rate increased a lot to a historical peak of 37%, which essentially means for all the container ships around the world which load and unload cargo at all these major ports, 37% of them would experience some delays during the pandemic. So this is a shocking evidence on how severe the global supply chain disruption was during the pandemic. And then, as I said, we are not really offering a perfect measure, but we do believe this measure has some advantages over the other indices. For example, we are trying to argue that this ACR index is largely independent of changes in demand. And the very reason for this is because of, as I mentioned, the nature of this very industry, because it is quite rigid. But also we have some other advantages. For example, it is because it's coming from the satellite data, so in virtually you don't have any measurement errors. Now it's time to compare how this index looks differently from the other indices. For example, here, which I show you, how this index compares to the Harper-Peterson Time Charter Rates Index, which is essentially a popular measure of shipping costs. You can see that during the pandemic, the rises in these two indices sort of corresponded to each other. But the major difference comes from what happened at the onset of the pandemic. We're arguing that for the shipping cost, because it is an equilibrium object, it is, of course, subject to changes in demand. And it's just because these changes in demand will map into, for example, higher shipping prices. If you use shipping prices in your SVRs, you will lead to some, endogeneity issues. So in this case, we are saying, okay, if you use our ACR, you will get something quite different. And then we're comparing our ACR index to the GSCPI compiled by the New York Fed. And you can see that the difference comes from, also similar to what I've just showed you, what happened during the onset of the pandemic. You can see that GSCPI rose up a lot during the pandemic and then quickly back down. But our index showing that at least at the onset of the pandemic, global supply chain disruptions hasn't really escalated. Okay, this is essentially what we have done in this paper, but following the theme of the conference, I wanted to show you that this is, speaking to some of the previous presentations, the COVID pandemic was not the only global supply chain disruption. In particular, I wanted to highlight several things that we have been studying. For example, here, the first one will be the attacks on commercial ships in the Red Sea. And for that one, I wanted to show you what we have been discovering. So here, I'm showing you, this vessel rerouting path following the Red Sea crisis. You can see that the major consequence of this is that those container ships that used to take the Suez Canal route from Asia to Europe will now start to take the Cape route around the Cape of Good Hope to reach Europe. So that will lead to a massive reduction in maritime supply, considering that those ships have to cover longer miles and also at higher speed. So we managed to quantify this and showing you this figure, the reduction in maritime supply. We call that reduction in ton miles in relation to this very recent Red Sea crisis. Here, we are looking at we're increasing the temporal resolution to a monthly frequency to a weekly frequency. So even though this still needs some refinement, but here, if you're focusing on the end of the sample, which is essentially December 2023 or January 2024, you can see that there's a very sharp increase in the vessel rerouting. And that led to actually the single most largest reduction in maritime supply in history, at least from our sample. So we are saying that, okay, the COVID may have subsided, but here now the Red Sea crisis, and also maybe later on when the geopolitical fragmentation has escalated to a certain level, this global supply chain disruption may come back again. And also we are now looking at some of the other aspects, for example, global climate issues. So in 2023, there was actually a very severe drought at the Panama Canal and also the ensuing El Nino effect. So we're also trying to quantify how much of this has an impact on the congestion rate at the Panama Canal. Following essentially the same method, we actually plot this reduction in maritime supply following for the Panama Canal. And you can see that in 2023 onwards, there's an increase in the reduction of maritime supply just because there was a very severe drought at the Panama Canal. And considering how important the Suez Canal and the Panama Canal are to the global supply chain, we really believe this will go on for some extended period of time. Okay, considering I only have a very short limited time, I would really go through the rest of this paper very quickly. So as I mentioned, now we have an index, the ACR. The next thing is to develop a model in order to use the model implications along with the index into the SVRs. So what we really have in mind is that we need to have a model that links this spare productive capacity and also this scarcity in retail supply. Because from the literature, people have been arguing, okay, this global supply chain disruption stemmed from disruptions in the production networks. But we take a different approach because we really think production, transportation, and consumption, they are three distinct stages. And they are connected in some ways, but they shouldn't be, at least for the transportation stage, they shouldn't be overlooked. So here we are saying, okay, anything happens to the transportation sector will bring about spare productive capacity in the production market, but also scarcity in retail supply in the consumption sector. So this is the first thing that we want to do with a model. And as I mentioned, we also wanted to use the model to come up with identification restrictions. And also that links to the third point here, which we wanted to have a lot of shocks, these three types of shocks in the model. So this is the rationale for the model. And then we have actually three choices. The first one will be a production network model, and also a new Keynesian model with transportation cost, and also maybe a search and matching model with transportation cost. So for the objective of this paper, we believe a search and matching model will be appropriate, and that is because in the search and matching framework, you have this trailing externality coming from this matching function. The beauty of this is that you really don't have to go into so much detail about how this matching frictions have, you don't really need to go into the microfoundation of this, matching friction. But the point is that during the supply chain disruption, it's just because you have matching frictions that makes the allocative rule of prices no longer valid. In the sense that, during global supply chain disruptions, the production may not be in a way that, the production may be reduced in such a way that it cannot really meet the demand in the retail market. In that sense, no matter how high the demand is and how high the prices will be, there will still be some shares of producers and retailers that cannot be matched to each other. And that is essentially the core of this global supply chain disruption that we think we could do in this model. So the key features is we have matching frictions and endogenous separation of producer and retailer matches on transportation cost. But bringing these two features in the model gave us this, this very simple graph, which is basically showing you that we have a supply curve, but more importantly, we have some wedges between what we consider as the theoretical upper bound and this aggregate supply. And that is essentially, as you can see in the slide, spare capacity. So skipping some of the details, I'm just jumping straight to the comparative statics, which we derived from the model. As I mentioned, we have three types of shocks: aggregate demand, productive capacity, and supply chain. So if you focus on our prediction on consumption, price, and spare capacity, you can see that just simply looking at the signs of the impacts on consumption, price, and spare capacity, we'll be able to distinguish the three types of shocks. So now this is essentially what we have from the second part of the paper. Now it's ready to go to the causal effects of global supply chain disruption. So I think the most interesting result comes from the historical decomposition of the US goods inflation, which I show you in this very figure. So as I mentioned, after using the SVR framework, we can see that before the onset of the pandemic, it's actually the improving global supply chain actually bring down inflation. But then following the onset of the pandemic, following the onset of the pandemic, you can see that the sharp drop in inflation was primarily coming from a very sharp drop in demand. But then subsequently, you can see that there is a escalation of global supply chain disruption that drove inflation up. But then that the role has changed because just after the start of the 2022, you can see that this productive capacity shock has actually taken a more important role in driving up inflation. And this is consistent with some other evidence because people have found that at the start of 2022, it is the overheated labor market in the United States that kept inflation elevated. But then at least for the US, you can see after that, there's a drop in inflation. And at the same time, you can see demand has been somehow muted, but then supply chain has recovered. So this is essentially what we find from the historical decomposition of US goods inflation. Okay, coming down to the very last part of this paper, which is to talk about the effectiveness of monetary policy. So as I mentioned, we wanted to study whether this stabilization trade-off between inflation and output has changed. So in the model, we actually have all of these instruments available. For example, if we wanted to consider a contractionary monetary policy shock, we have money supply in the model. And if we consider supply chain disruption, we actually have this scale parameter of the distribution of transportation cost. So now it's time to use the model to tell us some of the predictions that we can have on whether this stabilization trade-off has changed. So the most important result we get from the paper is that when the increase in product market tightness is sufficiently large during supply chain disruption, it will intensify the fall in inflation while dampening the fall in consumption during, that is associated with the contraction monetary policy shock. To see this clearly, I will just show you this figure, for example, on the left-hand side. You can see that when there's a global supply chain disruption, in the model at least, we say that there's going to be a shift of the supply curve from the solid blue line to the dashed blue line in the graph. And then that will change the slope of the supply curve. And why is that? And that is because during the global supply chain disruption, the matching friction would essentially mean no matter how high the prices will be, the number of matches would pretty much be fixed or determined. In that sense, you will really need very high, very large increases in prices to induce an extra number of match between the producer and retailers. In that sense, you may not really have the traditional stabilization bias that we see during the normal times. So given that I'm running out of time, I'm just going to jump straight away to the conclusion. So as I said, we studied the causal effects and the policy implications of global supply chain disruptions, and we have a new index, we have a new model, and we put all of them together into the SVR framework. And the two results we have is that supply chain disruptions generate stagflation, accompanied by an increase in spare capacity. But more importantly, we find that monetary tightening could tame inflation, without really sacrificing output during times of global supply chain disruptions. And I think that's all we have. Thank you so much.
Thank you very much, Ilyang. And then we move to Hilde, please.
Okay, thank you for inviting me here. It's great to be here and at this inaugural conference for ChaMP. Seems to be a really relevant network going forward. And I think the world we are seeing all these kind of crises which we didn't think we were going to experience them, and they seem to be occurring one after another, and we get great research out of that, and papers today at least has been very topical on that sense. And thank you also for allowing me to discuss this really nice paper. I really, really enjoyed the paper, so I was happy to accept immediately. Okay, so briefly, what are they doing? So they're doing three things, which we already heard. They are introducing a novel index to measure global supply chain pressure, so disruptions, based on congestion for container ships at major ports across the world. And they are then using high-frequent maritime satellite data, which were introduced in 2017, and which is a really efficient way to look at this market. And then they are integrating this index into a theory model to get implication for how to identify these shocks and how do they relate to demand and supply shocks, and how will that affect the macroeconomy. And that gives you nice input into the empirical model, the structural VAR model, for how to identify the different shocks. And then they can analyze effect for macro variables like inflation and GDP. And then finally, they analyze the effect or the effectiveness of policy in stabilizing inflation given these types of shocks. We already seen how the index looks like, but here it is again. So this shows the index from 2017 until 2023. And of course, it's striking the rise during the COVID pandemic and beyond is 50% increase. But also, as was noted, the decline in the trend is also something which is an important indication prior to the COVID. So what did I think of the paper? Really nice, as I already said. But the contribution is also quite large, but again in these three different areas. So for me, at least, I think the main contribution is the construction of the index. And I didn't know a lot about this market or the shipping market, but I know a lot about the oil, so I will have most of my comment on that area. But I think the nice thing, in addition to constructing this unique index, is that it's immediate and precise. And I think that's really what policymakers need, to have something which they can observe at least, if not immediately in real time, but very quickly. And the fact that it's also high frequent gives it huge advantages over other indicators. And I think as well, that this is not something we were just going to see during or being studied for the COVID pandemic. This is something we're going to see being useful going forward with a lot of the situation we're going to have in the world economy. But I also like very much the theoretical contribution and in particular how it relates to how they can identify the true global supply shocks. Some of the other indexes which are out there, like the New York Fed Global Supply Chain Index, which I've been using together with somebody from Norges Bank, which I'll come back to in a second. It has a problem that it's a lot of heterogeneity between that index and a lot of other commodity market variables and inflation variables. So it's hard to know what's really the global supply chain, or is it demand and demand inside that indicator. Here we're getting a true global supply chain index. And then policy recommendation, which is really useful for central banks. We heard this morning with Isabel saying that we cannot look through supply shocks. We can definitely not look through the global supply chain shocks. So given that this is a focus of policy, I wanted to say a few more comments on policy before I go to my comments on the paper. So I think that although the authors do a great job in doing the implication from monetary policy, there's a lot of other policy implication from the paper, which they could have gone even further into. And I do, in fact, do dwell on some of that, but maybe some are for future paper. But I think that clearly we're going to see going forward, it's not just the aggregate macro, which is going to be affected by global supply chain shocks, but different sectors. And they're going to be affected differently, depending on where the pressure is going to be. And we see it with like the car industry are lacking some components which are being shipped by cargo bearers, others are lacking stuff due to production issues. So there's going to be sectoral information which is going to be affected, which policy needs to pay attention to. And I also think it's, this study is really about the US. We are looking at different countries, and we are going to see that there are quite similar responses across the countries, but there are also differences, in particular with how responsive the macroeconomy is to policy. So to think about the global nature and also coordination of policy might be much more important going forward. And as economists, we are always reactive. That means that we are responding to the shocks. But this indicator allows you to be even more proactive in the sense of thinking long-term ahead planning, because you can observe these indicators and this congestion before it appears in your inflation data. So I think that's also a lot of the implication which we can take out from this. And for other governments, of course, it's, or for governments in general, or policymaker outside monetary policy. We're going to see much more of these types of indicators being constructed on different kind of issues based on high frequent data you observe by using machine learning techniques. And this, to facilitate these kind of data will be really important for how we can monitor shocks in the market. Okay, so to the more of the paper, comments on the papers. So I have 3 or 4 comments. But again, this is a quite dense paper because it relates both to the modeling of the index or constructing the index and the theory model and the empirical models. So some of the assumptions they have to rely on is the fact that the shipping routes and the speeds are fixed. And I think overall, I think that's not a bad assumption, but is it always plausible? For instance, how might fluctuations in shipping logistics due to sanctions or political unrest affect the model output, or just force majeure, weather, etc.? These are the kind of things which might, at least if you think of climate change and more weather shocks, is going to disturb the market more frequently. And although I don't know a lot about the shipping market, I know a lot about the oil market and the tanking of the oil market, and I know there's a lot of delays pushing cargo days back and forth due to weather. So controlling for this will be important, in particular if you're going to rely more on that index. So how important it will be to disturb the data, I don't know, but I think there is more of an issue than they're assuming. So some sensitivity analysis would be useful here further. And then again, because we're relying on this satellite data, how accurate is it? Do it cover all the ships? It doesn't cover all the ships, but do it cover all the ports equally? So how reliable can we be on the data? So that's going to be crucial for the conclusion. So that's one of the also information I think would be useful to know more about. And in particular, if it would be useful going forward to compare systematically, maybe with some logs of other ports to compare outcomes. The model is applied to the US, but there are country differences. It's an easy thing to say, but I think it's an important thing also to take into account that countries depend differently on goods and commodities. Obviously, we rely on the shipment for the global goods, but some countries rely more on air and road transport, whereas others rely more on shipping. So that's also something which would be important to know going forward for when you do the application, rather not for the construction. And then there's, of course, a lot of other factors. So the world is more complicated than we can put into our models. So we have to do some assumptions. So what's the role of other factors that are missing from here? So you mentioned geopolitical events, but also oil price and other major policy changes could be important factor, which is not really related to supply chain disruption, but will be captured by the index because it's happening something at that time. And maybe it's okay to call it all supply chain disruptions if they have the same effect on the macroeconomy. But if they don't, then it's important to separate more factors. And also the role about inflation expectation. I was missing, or I was expecting maybe a bigger role of inflation expectation in the theory model and also the implication for data. And maybe I was looking even more for that because that's where we have been working the most. So supply chain disruptions are difficult to observe. So how do households and firms observe them? Well, they do it through they will observe inflation picking up and then they will adjust their inflation expectations. So I think that's an important part of the picture. So I will say a few words more about oil and then inflation expectations. But first, so here's a plot, to motivate that, here's a plot taken from a paper we are currently working on, which builds on another paper we have just published as well, where we see that there's a lot of endogeneity between the variables which are relevant. So here on the top you have inflation and inflation expectation in the US, And on the bottom, we have the blue, the oil price, and the red is supply chain pressures, not your index, but the New York Fed index, because that's the one we used in our paper. So we will be very eager to use your index, but we are also having longer data sets, so we couldn't see that. But there's a lot of endogeneity, and the idea would be how to find the underlying shocks for these variables. So for the oil price, you assume oil prices have minimal impact on shipping speeds due to the fixed shipping routes and contractual obligation. But the idea is that fluctuation in oil prices cannot affect operational costs and lead to adjustment in shipping behaviors. I think that is I think it's a strong assumption. I think that you can think of this in two different ways. So in normal times, it might well be so. But when there's high volatility in oil prices, I think that it might there might be a deviation from this. And I know, for instance, that, again, coming back to the oil market in Norway, that when ships are tanking to fill up oil in their shipment, they are playing around with, so they are playing around both with the weather, but also with regard to the tax system in Norway. So they can move shipment and cargoes around for days because the sea prices are trending in one direction or another, and that also is influencing the taxes, how much they will be taxed. So there are some adjustment to the fluctuation in oil prices. Whether it will be important for your case, I don't know. But if oil prices affect shipping behaviors, it will also affect the global supply chain and inflation and other macro indicators in ways that is not accounted by your model. The inflation expectation, I already mentioned it, so I can be very brief, but you mention it, but you don't pay particular attention to it, because in your model, supply chains will affect production costs and capacity directly. But I think there's a big debate about the indirect effect of inflation expectation. But I think that in particular for oil supply, for supply chain disturbances, actual inflation is also affected by the expectations. So I think there's a direct effect, but I think in particular it's an indirect effect. And policymakers aim to anchor inflation expectations, so then understanding the dynamics for inflation expectation in transmitting the global supply chain would be important to also know going forward. So to the data and to this, so here on the left you compare the global supply chain index from the New York Fed, the dotted with your red. And here is the New York Fed for the longer period. This is the one we use in our paper. It's different from yours because we use quarterly data and year. But we see that the trend you talked about is also here. But what's really striking, if you look at this in long-term perspective, is that the very flat pattern before the COVID. So it would be really nice if you could have your data prior to 2017, but I don't think you can have. Final comment, I think you used this graph and you mentioned the importance of demand earlier in the pandemic, and then the blue is, the gray supply chain in picking up inflation. So in our paper, we are using again the global supply chain index, but we would love to have your index if it went further back. So that would be starting from this period here, 2017. We have more shocks because we also pay attention to oil supply shock, red. We had different economic shock, but here is the global supply chain shock from the New York Fed, and we have some domestic shock. And we are making a proper identification to get away the effect of demand on global supply, like you pointed out. And when we do that, we do actually see that we get this demand early in the 2020, as you get with your indicator. And then we get here is where we really want the global supply chain to matter, which you also find in your indicator. So we get related shock. But we also have the role of oil price, the red one, in certain periods. Okay, so conclude, really nice paper, really liked it. And it's important to understand the effect of the global supply chain disturbances, and I think it will go going forward as well for central banks. And I want more, meaning I want more data, more historical data if possible, and more analysis of this. There's huge policy implications, not just for monetary policy, but also for other policymakers. But the main challenge, I think, will be to understand the unobservable nature of this indicator, because you're constructing something we don't see. That's also the interesting part. But then continue to do research to make sure that other disturbances is not captured by this, and that it's robust to other shocks will be important. Thank you.
Thank you very much, Hilde. Ilian, would you like to react?
Yes. So thank you so much, Hilde, for all the excellent suggestions and questions. So I wanted to start with the first, not necessarily the first that you had, but the role of inflation expectations in our model. I recall that we received a very interesting comment from a comment from the other people on marginal resolution, which is basically saying that even though we didn't really see a word team transitory in the paper, but this paper that we have right now actually supports the idea that the inflation in the United States is transitory, was transitory. I guess this also reflects what we have been discussing is what we have found in this paper was that the global supply chain disruption, the shock itself will bring stagflationary risks to the United States, but we didn't really see how long this will be. So in that sense, if we furnish our model with inflation expectations, this may lead to more pronounced and even persistent effects on inflation. So I guess that's something that we could do with the model for some future work. So that's the first thing I wanted to mention. The other one is on, I think you might be very interested in the data. Absolutely, yes. So in terms of the fixed shipping routes and speeds, we have to say that it is the feature of the industry we wanted to take advantage of. But honestly, during this very high, very uncertain periods, for example, from the COVID to the invasion of Russia to of Ukraine, and also to the Red Sea crisis, a lot of things have happened, and shipping companies might react endogenously to all of these events. But we wanted to emphasize that even though there could be some other changes to there could be some changes to these shipping routes and speeds, a lot of them will be transitory. So in that sense, this rigidity of this very industry will still give us the advantage of identifying global supply chain disruptions more clearly. And also another bit, it's on, we were essentially saying there will be virtually no measurement errors using the satellite data. But yes, we do see some gaps in the satellite data. But in the other follow-up project, we are trying to use these gaps as some information, because if you think about this, the frequency of the occurrence of such gaps, and also where would these gaps appear, also carries some information about how the global supply chain disruption have been going on. So thank you so much for this. And yes, but one last thing I wanted to mention is that if in the end, because of, for example, the coverage, because we only have data from 2017 onwards, if you wanted to use, for example, global supply chain pressure index from the New York Fed, or simply the shipping costs, which you have a longer sample, it's very easy to use that in our SVR framework. Because what we are trying to offer in this paper is not only this index itself, it's rather to think what is the micro foundation of global supply chain disruptions. As long as you think maybe the global supply chain pressure index is better, it's very easy to integrate that into this SVR framework. And indeed, in the paper, we show that you get very similar results in the end. Thank you so much.
Okay, so let me open the floor for questions. Let me start here with Diego, and then over there.
Thanks. Very nice paper. I would like to push back against the notion that the ACR is not affected by demand. I mean, clearly, if there is lots of demand for goods, for imports, you're going to put more containers in the ships, and it's going to take longer to unload those ships, and the ships will have to wait until the berth is empty and the next one. So clearly, that can affect it. How do you tell them the two apart, supply versus demand? Well, you look at quantities. What happened to containers shipped to the US? 2020, the number plummeted, okay? So that's consistent with your story. 2020, the increase in the second part, the increase in 2020 in the second part of 2020 in the ACR is driven by supply. 2021, 2022, historical records. You have the number of containers going to the US, going to the roof. The ACR index is pushed by demand. And that's consistent with the notion that oil prices and supply chain measures are moving so strongly because both of them are driven by demand. Okay, so that seems like the obvious omitted variable in that context.
Yeah. Yeah, thank you so much, Diego. This is I guess you also mentioned this in some of the previous conferences. Yes, so we have to say that, we really cannot, so this demand thing is something that we can really not get rid of, because I would say that, it of course going to be affected by demand, because you would imagine, for example, during the pandemic, there was a very large surge in demand for tradable goods in the States. Of course, shipping companies, they will deploy more capacity along these routes. But that's why, essentially, in the paper, we were saying that, okay, it's not a perfect measure, and we have taken all the things that we could do to try to make it as clean as possible. One thing that we have mentioned is that we're looking at a global, port congestion at a global scale. So in this sense, if you have some demand increases, for example, in the States, that led to higher port congestion, in this sense, maybe some of the other places would see a decrease in port congestion. If you combine them together, you may not really see a very large impact from demand. So, but we have tried to make it as clean as possible, but I agree with you, it's gonna be affected by this. Yeah. May I add one more point? Sorry. I think also that leads to the beauty of using SVR, because essentially, the SVR framework would really give you an edge not to be so concerned about the endogeneity of a particular index compared to, for example, some other pseudo, for example, I don't know, maybe natural experiments or event study. So I think in that sense, maybe this framework could still recover some of the patterns of global supply chain disruptions, even though our index itself is subject to demand changes.
Okay, I think we had two further questions over there.
Yeah. Hi, I'm Dimitri from Università Pompeu Fabra. I was actually also going to ask about demand, but then my suggestion was to actually use this geographical heterogeneity and these things like the Panama Canal shock to isolate these supply pressures better, because you might have some local supply shocks. And the second suggestion was to compute the waiting time, which I think you can do with your data to have a better measure of congestion. Yeah, that's it.
Yes, thank you so much.
And I think we had another question over there.
So Sergio Kozhan, researcher, Bank of Slovenia. I was just curious to ask if you make a distinction between export-oriented and import-oriented ports, that could maybe help with isolating the export and supply factors from demand factors.
Thank you.
Okay, thank you very much. Are there further questions, comments? I'm sure there's, okay, we have another one there.
Just very briefly, if you have considered exploiting the variation in different ports, so if I think about global supply chain disruptions, maybe there's some goods that are extremely hard to substitute, say a component in the car industry that you won't necessarily see in container data, but it might have still a quite dramatic effect compared to some delayed container of, I don't know, kids' toys or something. Have you thought about these?
May I respond? Yes, thank you so much for this. Yes, because what for now in the analysis of this paper, we only use the weighted average ACR index for all the causality assessment. But I fully agree with you, no matter whether we could exploit the geographical differences, or if we, for example, as one of the, you mentioned about the export-oriented, import-oriented ports, or even those components that may be only sourced from some particular locations, we could definitely do this. But in the sense that if we wanted to exploit these differences, eventually, at least in this paper, we still have to use that in the SVR framework. Maybe, I mean, if we embed them, we could get a even sharper identification results using this same stuff that we have, but we will try to have a look at them because those actually, these aggregated data, we have them available straight away. Thank you.
Okay, so thank you very much to Il-Yang and Hilde, and also for the other 4 speakers this morning. I think this was a great session and extremely insightful, and I invite you to continue discussions over lunch. We will have a lunch break now, and I think we reconvene at 2 p.m., right? Okay, thank you.
Thank you very much for the great session.
Welcome back to the second session of the first day of the conference. I am Margherita Bottero from the Bank of Italy and one of the coordinators of the network. And I'm very pleased to chair this session on monetary policy transmission through the banking sector, so one of the core channel of transmission of monetary policy, at least in the euro area. And the rules of the game are like this morning. So we're going to have the presenter, the discussant, and then open the floor. We're going to see two papers, stop for a short break, and then resume for the last paper. Let me introduce the first presenter of the day, of the session, Christoph Basten from the University of Zurich, presenting his paper on monetary policy transmission through cross-selling banks.
Yeah, thank you so much to the organizers for giving me the opportunity to present this exciting research at this very exciting conference. It's on monetary policy transmission, fitting with the conference theme, and it's on transmission through cross-selling banks. By cross-selling banks, I mean that the banks sell different products to the same client, and they will take that into account when setting prices. So we've heard this morning that for transmission, it is important to what extent policy rate changes are passed through to depositors. And what we focus on in this paper is how this pass-through depends on the cross-selling strategies. It's joint work with Ragnar Julsrud from the Norwegian Central Bank, and so the usual disclaimer applies. What got us to start on this topic? In the past 2 or so years, major central banks, including the ECB, have raised policy rates. And as we've also heard this morning, deposit rates have been increased much less. This has outraged parts of the public. It has not so much outraged economists, because we know at the latest since Monty Klein that banks, of course, use whatever market power they have to charge a positive deposit spread between policy rates and deposit rates. And I will talk later how we want to define market power. So this was the first step to understand that cross-sectionally banks want to charge a positive deposit spread. The next step in understanding deposit pricing was Drexler, Savov, Schnabel's deposit channel of monetary policy paper, very influential. And they showed reasons why banks might not only want to charge a positive deposit spread, but have the deposit spread increase in policy rates. So there is what they called a positive deposit spread beta. So this already helps us understand a lot about deposit pricing, but to my mind, there were two major gaps. One is neither Monty Klein nor the DSS paper has allowed us to understand why banks would accept a negative deposit spread. And yet, until 2 or so years ago, the euro area and other major currency areas have had negative policy and interbank rates, yet banks would choose non-negative deposit rates, and so the spread was negative. And in Monty Klein or DSS, it's not clear why banks would do that. They could more cheaply refinance their lending through covered bonds or in the interbank market. So when I was working on negative rates earlier, I asked many bankers, so why don't you try negative deposit rates? You don't need all this refinancing. The bankers would tell me, you're right, we don't need this refinancing, but we want to keep the depositors because we want to cross-sell them other products in the future. And this got me to work in the project cited at the bottom with Ragnar Julsrud, and which was accepted by the RFS last year. In this paper, we show empirically that cross-selling to households is important. So we find that if you have deposits with a certain bank, that makes you 20 percentage points more likely to also buy a mortgage from that bank. So this was cross-sectional, and in the next step I started thinking, but how does that incentive vary with the policy rate, and therefore how might it matter for monetary policy transmission? So this is what today's paper is about. I will introduce the hypothesis from a theoretical point of view. Then it's standard. I will introduce data and strategy and then go to the results. So I said earlier in the paper Basten Julsrud 2023, we found that certain demographics are more likely to cross-buy a mortgage from the same bank. And interestingly, these same demographics tend to get lower deposit spread, which is to say they earn higher deposit rates. In particular, what we found, you can see this on the slide, parents and those aged below 30 are more likely to buy a house in the coming years. So they are more likely to bring in mortgage business to the bank, and the banks offer them better deposit rates to attract and keep them in the first place. In fact, as you see at the bottom of the slide, there's two drivers of this difference across demographics in effective deposit spreads. One is supply. So the banks we look at offer higher deposit rates on accounts for which you're only eligible, for example, if you are a university student, if you're young, if you have kids. This is supply. There is also a demand component beyond effective deposit spreads, because the young, for example, are more likely to re-optimize what type of account they have within their bank, or even to switch banks in order to get the best possible deposit rates. Importantly, this cross-selling of loans often happens a few years after someone's onboarded. So someone would finish high school, maybe open a deposit account, they buy their first house 3, 4, 5 or more years later. So when the bank wants to think about how profitable it is to win that client, these benefits of cross-selling to that client a mortgage have to be discounted. Now, what do these findings of last year's paper, what do they imply for the optimal deposit pricing of a bank? At the top here, you see the Monty Klein model of deposit pricing. So this model says the bank sets the deposit rate RD as a spread against the policy rate R, and then clients will choose the deposit volume D as a result of that. And so in that very simplified model, banks want to choose RD so as to maximize this one period deposit profit. What our findings from last year suggest, though, is that it might make sense to add a second term here, which are tomorrow's loan profits. So L is the loan volume, and we showed that this tends to be larger the larger the deposit volume the household already has with that bank. And then you want to multiply that with the loan spread, L of R. And importantly, because the cross-selling happens later, you want to discount it. So what this implies is, first, the bank trades off earning a lower deposit spread today against selling a larger deposit volume today. That's already in Monty Klein. And what is new through our research is against also selling a bigger loan tomorrow. And the resulting incentive for loss leader pricing, as you may call it, the resulting incentive to set a lower deposit spread today is more pronounced the lower our policy rates. Because when policy rates are very low or even negative, as they've been here until recently, the NPV of these cross-selling profits will, ceteris paribus, be larger. And what this implies is, again, a positive deposit spread beta. This is something which DSS have already given us another reason for. So what we want to know empirically is, which of these reasons is it, or is it both? What is their relative importance? And that's what the empirical part of this paper will be about. So here you can see the positive deposit spread beta. So the higher policy rates, the higher on average the effective deposit spread. That's the average. It does differ across banks. So what you see here is the deposit beta. How much does the policy rate vary with the policy rate? And the deposit spread beta, how much does the spread vary with the policy rate, is also very heterogeneous across banks. And that makes us wonder, why is it different? What bank characteristic or choice makes this deposit beta or deposit spread beta differ? So the hypothesis we have is that the deposit spread beta will be increasing in deposit market power. That's DSS, the deposit channel of monetary policy. That's point A here. But what is new to our paper, we say it might differ by deposit market power, but importantly, it will also differ by the conversion from deposits to loans, by the extent to which the banks take into account that once they've onboarded you as a depositor, they can sell you a loan later on. What data do we use? So we use data from Norway, outside the euro area. Why? Because the data quality is amazing there, and I will hopefully explain why this is the case. Namely, we have data on the universe, every household, every bank, every year. We see the volume of deposits and loans, and we see the interest any household receives from any bank for the deposits, and any household pays to any bank for their loans. Then we compute the key measure of interest to us, which we call deposit loan conversion. So we see what is the percentage change from the deposit amount in that bank-household relationship to the loan amount, if there is any borrowing later on. So in contrast to last year's paper, where we stayed entirely at the relationship level, here we then aggregate all outcomes and all variables of interest to the bank municipality year level. So we bunch together all households in the same municipality. I will explain in the next section on the strategy why we do this. Summary statistics for reference if there are questions later on. So I've said the objective of our empirical analysis is to distinguish why is there this positive deposit spread beta. The most obvious thing is lending opportunities. When policy rates are lower, this might increase demand for loans. And if the banks have more lending to refinance, they offer a lower deposit spread, so they make deposits more attractive in order to raise more deposits to refinance that extra lending. Then the second possibility is deposit market concentration. That's the deposit channel of monetary policy. And the third one is this cross-selling potential. Now, how can we differentiate between these three drivers? Drexler, Savov, Schnabel in 2017 faced a similar question. They wanted to differentiate between drivers 1 and 2, lending opportunities and deposit market power. What they did is they compared the deposit pricing of branches of US banks within the same bank year. Why? Because the market concentration is different, or is often different from branch to branch. One branch is in a highly concentrated market, another one is in a less concentrated one. But they make the point that the deposits are then pooled at the bank level. So by making these comparisons within the same bank year, they can keep lending opportunities fixed and therefore cleanly identify the effect on the deposit spread beta of deposit market power. Their strategy has more recently been criticized because other researchers have pointed out that only 15% of US banks set different prices at the branch level. So this does not disprove that at US banks or European or any banks, deposit prices are related to market concentration, but at least the DSS strategy has limited external validity because explicitly they've shown this only for those 15% of banks. Our strategy instead builds on the finding I introduced earlier that cross-selling opportunities and the deposit spread beta differ across demographics. And we exploit this by using the fact that different municipalities in Norway have different demographics. So in downtown Oslo, you have a very different age composition. You have a different number of kids per household than in the countryside. So what we do is we compare the deposit spread beta across municipalities within a bank year, and thereby we seek to also control for lending opportunities or for refinancing needs, as you might want to call it. As a motivational slide, I start here by just relating the change in the deposit spread at the top of columns 1 and 2 to the change in the policy rate in column 1 without, in column 2 with bank fixed effects. And it doesn't make much of a difference. What you see is about 70% of the policy rate increase is passed through, and therefore the other 30% go into the deposit spread. So the pass-through here on average is higher, interestingly, than what we heard this morning, 40%. Of course, this depends a lot on what subsample of observations you use on the time horizon. So this is within the same calendar year, because that's the frequency of our data. But you see, on average, there is a positive relationship between the policy rate and the deposit spread. And as a result, columns 3 and 4, when the policy rate goes up and deposit prices go up, deposit growth goes down. Now, this is not at all causal, because here we just compare across years, and we cannot control for lending opportunities. We can and do this once we're interested not in the average, but on how this differs across banks. So in columns 1 to 4, the outcome is, again, the change in the deposit spread. And in columns 5 to 8, it's the resulting volume, deposit growth. We start without bank year fixed effects. And you see here the coefficient is 0.02. I'll shortly say what that means, actually. But the first thing worth noting is this falls by more than 50% once we add the bank year fixed effect from 0.02 to 0.007. So this shows you that adding these bank year fixed effects really is important. Here we start including only the interaction between the policy rate change and our conversion measure. Then, as a sort of horse race, we include instead the interaction of a policy rate change with the market share of that bank in that municipality. And then we include both. And you can see when we include both, this does not make much of a difference. So what is the relative importance of these two drivers? What you see, I think it's worth the exact coefficient, of course, depends on the scaling. So let us compare the effect on the deposit spread beta of cross-selling versus market concentration by comparing the effect of one standard deviation in each of these two variables. So if we increase conversion by one standard deviation, that's 4.8 units, we find that the deposit spread increases by 4 basis points. If we instead increase the market share by one standard deviation, that's 0.01 units, it increases by 0.47 basis points. So roughly, this is to say the effect on the deposit spread beta of deposit loan conversion has about 10 times as large an effect as the market share. In the paper, we also use the Herfindahl-Hirschman index, so not the share of each bank, but the sum of squared market shares, and the results are very similar. When we look at not the pricing outcome, but at the volume outcome, deposit growth, the difference is even starker. So there, the effect of conversion, the effect of a market share is only about 5% as large as that of conversion. So the first thing this slide shows is that market shares or market concentration within the deposit market does matter. So this is consistent with Drexler-Savov-Schnabel in a different setup with a different identification strategy. But importantly, deposit loan conversion seems to be at least as important or even more important. And I think this is important because Drexler-Savov-Schnabel talk about market power, and they use market concentration as the best possible proxy. But I think what is important here is to show that banks have as much market power or more from this cross-selling opportunity, because households don't like to switch banks a lot. So this is the first of 3 core empirical results. The second one is about better understanding why does conversion drive the deposit spread better. And if we go back to the formula I showed you earlier, in the right term you see that the net present value of tomorrow's cross-selling profits, it varies with the policy rate R because of the discounting. That's clear a priori, right? But it could potentially also vary if the loan spread, the lowercase l, varies with the policy rate. To me, at least, it was not clear a priori what the relationship between the policy rate and the loan spread would be. There's all this literature showing that the deposit spread varies with the policy rate, but how about the loan spread? You can see it to start with graphically here. So in the left graph, you see that when the current policy rate is higher, the current loan spread tends to be lower. For this objective function, what matters, in fact, is not the relationship between the loan spread and the current policy rate, but between the loan spread and the policy rate at onboarding. So what is the relationship between the year in which I want to win someone as a customer and in which I have to set the attractive enough deposit spread, and the loan spread at which I can hope to sell this mortgage to the same client later. And you see over a 5 year, with 5 years in between, the relationship is a bit weaker than the relationship in the same year, but it is still clearly negative. Now let's look at this more formally. So in the first 4 columns, we see how much the propensity, the likelihood to borrow, depends on the policy rate. We relate it to the current policy rate level, current policy rate change, or the onboarding year policy rate level and change. My favorite specification is the third of these 4. And what you see here is when the policy rate level is 100 basis points higher, the propensity to borrow is 0.3 percentage points higher. So this is statistically significant because we have a huge sample, but it is not economically significant, I would think. So it looks like the propensity to borrow is driven by other things, maybe where in the life cycle someone is. Do they have a solid income? Do they have kids? That determines, more importantly, when they buy a house. But importantly, what spread they pay on that loan, that does vary significantly with the policy rate. So to see whether the loan spread or the discounting is more important, what we do is we compute what is the net present value of the first year of the loan on average in our sample. So the average loan volume is 160,000 kroners, about 16,000 euros, divided by 10 more or less. The loan spread on average is 154 basis points. The average policy rate in our sample is 182 basis points, and the average time from bringing your first deposit to making your first, taking your first mortgage is 5 years. So the NPV of the first year of the loan resulting from that is 2,200 kroners, or about 250,000 euros. Now, how does that change when the policy rate changes through these 2 channels? If we change the discount factor from 1.02 to 1.03, this NPV will fall by about 4.7%. If we apply the same policy rate change and the resulting change in the loan spread, so 100 basis points higher policy rate means 13 basis points lower loan spread, and if we apply that, this NPV will fall by 8.4%. So what this is to say is, in this equation, the effect that the policy rate has on your willingness to do loss leader pricing is bigger than the effect of the discounting. But the key is both subchannels matter. Both subchannels make cross-selling strategies important for the positive deposit spread better. Okay, third and final of my 3 empirical findings, what are the implications of all of this for loan growth? So the identification strategy I presented earlier relied on the fact that deposit prices are set for different demographics and therefore for different municipalities, so not the same for all clients across Norway. But I also said for refinancing, the funding is pooled at the bank level. So here, when we relate loan growth to deposit growth, and we add these bank-year fixed effects from column 1 to column 2, the coefficient does not change much. In both cases, we find if deposit growth is 1 percentage point higher, then loan growth is also 2/3 thereof higher. So there is, if you have more deposits, you can lend more, but it's not clear this is causal. What we do, therefore, is we instrument deposit growth with a component that can be explained with deposit market power and with cross-selling market power. So we use basically this equation here, which I've shown, this equation where we relate the deposit spread change to the policy rate change and the relevant interactions. We predict deposit growth, and when we relate loan growth only to what is predicted by banks optimizing behavior in their deposit market, the coefficient falls by about 1/3. But it stays around 50% and is very significant. So for every percentage point extra deposit growth, banks will increase lending by 50% thereof. So what I've just shown you does matter for deposit growth and loan growth, and therefore, presumably, for the real economy and monetary policy transmission. Okay, for reasons of time, I will skip any thoughts on further analysis. Let me instead conclude. So I've made 4 contributions here. The first one was on a theoretical level to show that if onboarding and keeping a depositor today can give you extra cross-selling profits tomorrow, that incentivizes banks to do a loss leader strategy to offer lower deposit spreads. And this is more pronounced the lower current policy rates, and therefore we expect a positive deposit spread beta. That's a theory. The first empirical finding is to confirm this. It is to show that indeed, if there's more deposit loan conversion in a bank's business model, we expect it to have a higher deposit spread beta. And this cross-selling based market power drives the deposit spread beta at least 10 times as much in the setup we study as does deposit market concentration alone. The second empirical finding is this relationship between cross-selling intensity and the deposit spread beta. It's driven at least as much by the relationship between policy rate and loan spread as it is driven by the discounting thing, which is what we thought about first from an a priori perspective. And then the final empirical finding is all of this deposit pricing matters not only for deposit growth, but also for loan growth. So this is to say that really deposit pricing is important for the transmission of monetary policy. That brings me to the end. Thank you so much for your attention, and I'm looking forward to Carmelius and many more interesting questions and comments now or later today and tomorrow. Thank you.
And the discussion will be given by Camelia Minoyu from the Federal Reserve Bank of Atlanta.
Thank you so much for having me and for the opportunity to discuss this super interesting paper. Because I'm with the Fed, I have a disclaimer that these are only my views. And I'm going to try to first bring us down to earth from the stratosphere of this very interesting, thought-provoking paper that I think is in the early stages, but it shows a lot of promise to give us a new perspective on the deposit channel of monetary policy. So this paper argues that monetary policy effectiveness differs across banks through deposit rates as a function of cross-selling opportunities, the business model of banks. Cross-selling financial products and services is actually prevalent across banks, for households and firms. And the paper argues that it affords them market power. With all the empirical estimates together, the thesis in this paper is that cross-selling explains deposit spread betas 10 times more than deposit market alone, which is the Drexler et al. Deposit channel of monetary policy. So this promises to be a very powerful channel. And with this promise, of course, comes a very tall bar. And I'm going to come back, kind of build towards that tall bar as I go through my discussion. But I want to also show you that Citi cross-sells to me. These are screenshots from my Citi app. I've been banking with Citi for 24 years because they had a branch on campus when I went to graduate school. And I am a very captive depositor, very inattentive also, with a bunch of accounts. And as you can see, a couple of checking accounts, I never bothered to close one of them. A couple of deposit CDs, a zero interest, and a high yield savings account that I kind of woke up to after SVB, probably like the rest of the world. And then finally, I have a mortgage loan serviced by another non-bank mortgage servicer. And as you can see, there's always this option to explore more products. So the bank always tries to sell more products to me. And as Christian's previous work shows, there's a 20 percentage point higher probability of a depositor to get a loan from the same bank that their relationship bank than from another bank. And those loans or additional services come at a premium. So the bank makes a lot of money from these captive relationships. Okay. So the organizers of the conference asked me to speak to the relevance of the paper to the current environment. So let me spend a little bit of time on that, and that gives me also background information on how to position this paper in the literature. So in the US, deposits amount to $18 trillion. A lot of savings are stored as deposits. They are a critical source of funding for banks, especially in the last 15 years after the global financial crisis, as banks have increased their reliance on deposits and decreased their reliance on wholesale funding. They are also a key savings tool for households. And the way we typically think about the transmission or the pass-through of the policy rate to the deposit rate is with a measure called the deposit beta. Here on the right-hand side, we have a chart with a historical perspective on the deposit betas of US banks. There are about 4,500 banks in the US, and if we look at the time series for each bank, we see the sensitivity of the total deposit rate is about 0.4, 40 basis points of increase in deposit rate we see for every 100 basis point increase in the policy rate. In the recent tightening cycle since the first quarter of 2022, the deposit betas reached this average, but much faster than in previous tightening episodes, probably because of the very steep pace of policy rate increases. So let's now take a longer-term view of this phenomenon, how deposit rates move with the policy rate, and it's very well known that they lag the federal funds rate. In fact, we see that deposit rates are upward sticky and downwards flexible. With every tightening cycle, you see how they open up, the deposit spread opens up, and this is where the bank makes a lot of money because it's not allowing its cost of fund to increase at the same pace as the policy rate. And so this deposit spread widens during monetary policy tightenings and then very sharply closes during easings. This has also been coined as the deposit franchise of banks, the value of these sticky deposits that affords banks as depositories the freedom of much lower cost of fund than would be implied by the stance of monetary policy. You know, this is intrinsic to banks again. This has been coined as the deposit franchise of banks, and it is valued at a little more than $500 billion per year in the US. This deposit franchise helps maintain constant NIMs because NIMs don't shrink as the policy rate tightens and works as a natural hedge against the falling value of assets on the asset side of fixed rate assets on the asset side of banks as interest rates increase. So in the current environment, the Drexler et al. Deposit channel of monetary policy works very powerfully. What this channel is that monetary policy tightenings increase the deposit spread, as shown in the chart, and reduces the supply of deposits. Deposits flee the banking system, looking for yield elsewhere. And the reason why banks are able to allow this deposit spread to increase is because they exercise market power in supplying deposits. So what this paper shows is that cross-selling is a significant source of market power. And as I approached the paper, I thought that they are perhaps offering a micro foundation for Drexler's channel. But it's actually proposed in the paper that it's a separate channel, okay? Because cross-selling is a significant source of market power. So what is cross-selling? Cross-selling is this idea that either household depositors or corporate clients receive more products from the bank once they already have a relationship with the bank, being a deposit or a loan. Cross-selling is common to households, and again, there's previous work on that, but it's also very widespread and very profitable for firms. In fact, banks that offer loans to firms also cross-sell them other profitable products, such as account and card services, trade finance, supply chain finance, payments processing, foreign exchange services, and leasing, all sorts of information-sensitive products. And so you may have also heard that anecdotally around SVB, we learned that very often when banks offer a credit line to a firm, they also ask that firm to park a share of its cash as deposits with that firm. So again, cross-selling is intrinsic to banking. So I'm going to ask a couple of questions and then offer some suggestions and sort of move gradually from very simple comments. So my first comment is about the profit maximizing problem of the bank. We can think of it as the bank maximizing profits on deposits today and profits from cross-selling tomorrow, which are, of course, discounted. And this is shown as the two terms in this expression. And so here I have a very simple question. My question is whether the bank can offer a new loan rate tomorrow. We see that L of R, which is the loan spread, is a function of the interest rate today. But the bank should be able to adjust the spread or the pricing of its loans to its captive depositors across periods. So I thought that it would be more realistic to allow that loan rate to vary over time, and I wonder what the implications for the model would be. The second comment goes straight to the core intuition, and let me read the core intuition as it's stated in the paper, and then ask a couple of questions. So the core intuition is as follows. When the policy rate increases, the net present value of future cross-selling potential declines because of higher discounted, that's a mechanical effect, and because of lower loan spreads. Let's put a pin in that. I'm not sure I understand, it might be the case empirically, but I'm not sure I understand why necessarily we should have loan spreads compressing with higher interest rates. So as a result, the marginal benefit of increasing deposit rate declines, the pass-through to deposit rate is lower, and hence the deposit spread increases. So as I think through the intuition here, I am a bank, and I want to make a lot of money from my depositors by cross-selling them future profits. I'm going to make money from two margins, the profit margin, the loan spread, which it is claimed compresses with higher interest rates, empirically. There's no theoretical result there. It's just an empirical claim. And quantity. I can do a lot of cross-selling, yeah? And so I have these two margins. I have the profit margin and the quantity. And while the loan spreads may compress, what happens to quantity? Can the bank do more cross-selling so that the quantity effect actually outweighs the profit margin squeeze effect? I think both of these terms, I honestly don't know much about them, or in fact anything about them. I would like to see some solid empirics establishing what happens to profit margins and quantities of cross-selling as interest rates move about. The next comment is more of a suggestion. So I mentioned before that banks cross-sell products to firms, not only to households. And so this cross-selling channel, I think, should apply more broadly to corporate borrowers as well. And I want to offer a suggestion. Maybe for external validity or for boosting the evidence in the paper, perhaps one can use for empirical identification the beautiful policy or regulatory change that happened in the late 90s in the US regarding the repeal of the Glass-Steagall Act. It culminated with the 1999 Gramm-Leach-Bliley Act, which allowed commercial and investment banks to cohabit under the umbrella of commercial banks. Basically, this prompted the rise of universal banking and is a positive shock to cross-selling opportunities. So to be a bit more specific, in 1987, as early as 1987, and we have a lot of variation across time, commercial banks were able to open so-called Section 20 subsidiaries, which offered corporate debt and bond underwriting services. And so that allowed them to engage in cross-selling and realize economies of scope across financial products. There's a beautiful paper by Newman and Saidi that argues that that was before they got it published, and the referees asked them to change the title. It was beautifully titled, "Are Universal Banks Better?" And the answer was yes, because they were engaging in riskier lending to previously financially constrained firms that appeared riskier, but ultimately they ended up being more profitable than other firms. So I think this identification strategy would give us a sense of generality of the channel proposed here. And my last comment is more broad about the effectiveness of monetary policy in the aggregate. So as we know, a lot of the empirical monetary economics literature these days forces us to go into cross-sectional identification because it's so hard to look at time series and make any sort of causal claims with confidence. But ultimately, policymakers care about the effects of monetary policy on the real economy. And here, because we're talking about the banking channel, through banks. And the paper shows some very nice results on how deposit growth spurs loan growth. But deposit growth here is driven by both the Drexler standard deposit channel of deposit market power of banks, as well as the cross-selling channel. So I wish that these two channels were they were split apart, separated, so we can do a horse race and we see which one is more powerful. And in addition, I would like to take these specifications further to the real economy and see if the households benefiting from cross-selling have more durable consumption, more housing consumption, and better real outcomes in general. Finally, if we're going to argue that this is a much stronger channel than DSS, then we need even more. Perhaps some long-term evidence in the time series. Anything that can kind of boost the evidence. And my last point will be about policy implications. So right now, the demographics of the areas where the banks operate are used for identification. The idea is that if you have young people around in a given municipality, their demand for deposits will be high, their demand for housing, mortgages will be high, and so there's a lot of cross-selling opportunities there. But if that is the main source of cross-selling opportunity, then there's not much for us as monetary policymakers to say about how we can influence that. We cannot influence demographics. So how can I translate, my question is, how can I translate the results of the paper into a policy message? What does the paper have to say about, say, comparing two economies with identical banking systems? One is super deregulated, banks can do a lot of cross-selling, and the other one has limited cross-selling opportunities. My intuition so far, based on my reading of the paper, is that the first economy would have stronger monetary policy transmission. But I would like to see all of that spelled out in the paper and kind of coming out stronger with this overall message. So to conclude, super promising and thought-provoking work. I think it's very exciting. My main comments is to maybe develop further the intuition. I wonder if this works for cross-selling to firms as well. Is it a broad general channel, or does it have to do anything with households? And finally, what are the implications for monetary policy effects of this channel in the aggregate? Thank you.
Thank you, Camelia. Maybe, Christoph, you want to quickly reply to Camelia, and then we gather questions from the floor.
Yeah, thank you so much. The intensity of cross-selling will vary by setup, will vary across countries. So it was very interesting to see as a starter that there is also something to that in the US. So Drexler, Savov, Schnabel have always coined the term deposit franchise, and in our value suggests it's deposit and cross-selling franchise, because part of the value of having these depositors are these additional opportunities. One good suggestion you made was to also consider cross-selling to firms. So this is households, this is like half of deposits in Norway. we are at the moment preparing data on firms. It's a bit more complicated because for firms, the timing is different, right? Households start with deposits, will later borrow. Maybe firms start borrowing and will later bring deposits. For firms, also the role of asymmetric information in a relationship might matter more than for household mortgage lending. So we're still thinking about this. But I think it's something we should add at some point. You asked how does the policy rate affect the loan spread, not now, but for the actual loan. So we do link in what I showed the loan spread, the effective loan spread are not in the year of the onboarding, but in the actual loan year. In our earlier paper, we find that after lock-in, banks can charge higher loan spreads. So if you are locked in because you have deposits there, you pay more for your loan than your neighbor who has their deposits elsewhere. So we've looked at the borrowing propensity and at the loan spread, but I'm very grateful for the good suggestion to also look at the loan volume. That's something obvious we should and will do. Also useful to think about this US variation in cross-selling to firms. And to split the effect on loan growth also between the value of the role of the market share and the role of cross-selling. We can do that. That's a good thing. Last thing in terms of policy. So what this suggests is that if there is less cross-selling, if households are less sticky, the DSB is lower and monetary policy pass-through is different. It seems surprisingly difficult for policy to affect cross-selling, to affect the stickiness of depositors. So the EU has tried with all kinds of banking regulation to encourage people to switch banks more. Norway has had different policies and hasn't had much of an effect. Households are surprisingly sticky to their bank, and I'm still trying to understand what makes them so sticky. Thank you.
Thanks. Questions from the floor? I have to remind you that wait for the microphone and stand up and introduce yourself.
Leif Martensal, Federal Reserve Bank of Chicago. So on the last point, so first I think it's a great paper, and I think the Norwegian colleagues actually have a paper showing that firms usually open deposit accounts 2 years before they take out the first loan. Though they seem to have a similar channel, but that brings me from that paper more to the point we should be a little bit careful about the implications, what we can do for customers to switch banks. One reason could be they accumulate information. And it's not clear that we want necessarily, yes, they're locked in, I get this, but then we have to talk about how do you make the information transferable as well. So I would be very careful in the policy implications saying like, oh, we want more switching banks and that's good and that would change the transmission of monetary policy. That may be good, but it may not necessarily be good for consumers if that means that the loans are not as well priced and they may end up paying more.
I agree with that. Also, I mean, it's important to understand what the deposit spread beta is, and if I know that as a central bank, maybe I set higher or lower policy rate changes, but I think for monetary policy transmission, higher or lower DSB might both be fine, and there's cons to making them switch around more,
Hi, thanks for this very interesting paper. It was about time. I really wanted to see a paper about cross-selling. I have just one question, which is related to a companion paper of DSS about maturity transformation, where they stress the importance of deposits that allows banks to actually match the maturity of loans because they're very sticky, and hence they're actually really important in their hedging of interest rate risk. And so I was wondering, how correlated is your measure of conversion with the bank business model of, say, for instance, the loan-to-deposit ratio or deposit-to-total liabilities ratio, because that might matter, right? I might not want to pass through too much of a policy rate decrease if I risk of losing my source of long-term financing if we believe that deposits are sticky and they finance our long-term loans? Thank you.
It's a good question. I haven't looked at this yet, but it's something I can and will look at. It's a good idea. Thank you.
There was a question from Hans.
Okay, Hans de Grijze, KIO Leuven. So I like the idea of cross-selling. So I'm just wondering if you would tell this narrative to bankers, whether they would be convinced of this. Because typically what they would think is, the mortgage, that's the time where you really need to have the client, because, then you have the client for 20 years, and after that you will be able to cross-sell. So I'm just trying to understand, whether suppose you would do the same exercise related to mortgages, and thinking about, let's say, cross-selling opportunities in terms of mutual funds, what have we, whether you would have, let's say, similar type of insights. Thanks.
I mean, what we see in Norway is they start with deposits, and the deposits are enough to make them sticky. And if anything, they would switch banks when refinancing the mortgage. That's also what I see in Switzerland, where I live now. People, for the first mortgage, they are sticky. They only trust advice from the bank they know. When they already have that mortgage, they have that house, 5 or 10 years later, they are more likely to switch. So I would think it will depend a bit on the context. What is the contract duration of the mortgages? Yeah.
Are there other questions? David.
Yeah. Awesome paper. So my question comes from this von Saden-Rajan type of dynamic competition paper. So basically, what I'm thinking about here is, can you separate between the ones that are already locked in to the ones that will be locked in and are going to be super stick, but for some reason, I don't know why, age or something, are not yet locked in. Why? Because I guess that from the intuitions that at least I have from those papers, the pass-through should be totally different. Like if you're a guy that is going to be locked in and you're going to be very sticky, there's all this cross-selling that's going to happen, but there's going to be probably even much higher than one changes of monetary policy rate through your deposit, because I really want to grab you now. Once you are in, that's the end of the game for you. So then maybe on the average, you have much more of these people than of the other. I don't know if it's plausible, you've already done it and I missed it, or something like that.
So since clients are fairly sticky, I think it takes a much bigger loss leader incentive to onboard you and lock you in the first place. The banks also are careful to have negative deposit rates, for example, because they don't want to lose you after lock-in, but that it's easier to keep you than to onboard you in the first place. I guess what I could do is I could compare, for example, households who have deposits with a different bank but have some deposits to households that don't have any deposit account at all yet, for example, when they start university or something. Yeah, that's good.
Okay, so thank you, Christoph and Camelia. And we can move on to the next paper of the session, who is going to be presented by Lara Coulier from the ECB, and asks a very interesting question: are low interest rate firing back interest rate risk in the banking book and bank lending in a rising interest rate environment?
Thank you. So good afternoon, everyone. My name is Lara, and today I will present joint work with Cosimo Pancaro and Alessio Reghezza, both from the European Central Bank. So I also have this disclaimer that the views expressed in this presentation are those of the authors and do not necessarily reflect the views of the ECB. So as said, our paper is titled "Are Low Interest Rates Firing Back? Interest Rate Risk in the Banking Book and Bank Lending in a Rising Interest Rate Environment." Okay, what is the focus of our paper? So we know that the low for long interest rate environment has altered the bank's balance sheets. We will show descriptively that banks have built up the duration of their asset side during this period. However, we will also show that interest rate risk only materialized when the ECB started to increase interest rates unexpectedly fast. We look at the implications of this materialization of interest rate risk for bank lending supply, and we find that banks that are more exposed to interest rate risk contract their lending more compared to their peers. And we also find that these banks reshuffle their portfolio away from long-term and fixed-rate lending, and they do this to reduce their exposure to interest rate risk. Our findings reveal that micro, small, and medium-sized enterprises are mostly affected by this contraction in lending by banks with a large exposure to interest rate risk. And we find that affected firms cannot substitute the contraction in lending by borrowing more from banks with a lower exposure to interest rate risk. So, our paper is related to the literature on bank maturity transformation and monetary policy. For example, the paper by Drexler et al. From 2017, which has also been discussed during the previous presentation. And what this paper finds is that when there's a monetary policy tightening, this triggers an outflow of deposits. And this outflow of deposits also impacts the lending side. And this is an argument, a similar argument that we will use in the paper as well. Our paper is also related to the literature on the bank lending channel, where people study which bank characteristics weaken or amplify the transmission of monetary policy to bank lending. However, to our knowledge, there are only two empirical papers that look at the effect of interest rate risk on the transmission of monetary policy to lending. So the first paper is a paper using bank-level data from Switzerland, and this paper focuses on the duration gap. I will explain this concept in more detail later, but what it captures is it captures the maturity mismatch of the entire maturity structure of a bank's balance sheet. And this paper finds that banks with a larger duration gap reduce lending more when interest rates increase to remain in compliance with their capital requirements. The second paper is a paper using data from the US, both at bank and at bank firm level data. And this paper uses the income gap, which captures the maturity mismatch only up to 1 year, so more like a short-term measure of interest rate risk. And this paper finds that banks with a larger income gap reduce lending less when interest rates increase because of an increased net interest income. Now, you may wonder why there's only two papers that investigate this topic, given that it's highly relevant and also topical. Well, this relates to data constraints. For example, the paper using Swiss data has to use bank-level data, cannot control for credit demand effects, for example. While the second paper only looks at the income gap, capturing a small part of the maturity mismatch, cannot capture the whole picture. And this is where our paper comes in. So we make use of two unique and extensive data sets, the first one being AnaCredit, so the European Credit Registry, the Euro Area Credit Registry, and the second one being a supervisory data set that captures the behavioral maturity mismatch across the whole maturity structure of the entire balance sheet, and it includes information on hedging, such that we can control for hedging against interest rate risk. Last but not least, we make use of the combination of these two detailed data sets and the unique economic setting we're in now, so meaning that there was a monetary policy tightening that followed after a very long period of low interest rates to study the effects of interest rate risk on bank lending. So first I will show you descriptively what happened with banks' balance sheets during the low interest rate environment. So banks build up the duration of their asset side, mostly to compensate for compressed margins during this period of low interest rates. And also customers were interested in this because they wanted to lock in low rates for a very long time. And this we also show in the chart on the left-hand side, where we showed that the outstanding volume and the new business volume of loans with a large maturity has been increasing steadily since the global financial crisis. And this has increased the duration of the asset side of the banks. And on the right-hand side, we also show this increase in duration for fixed-rate loans. At the same time, on the liability side, there was a large inflow of sticky overnight deposits. Sticky meaning that these deposits typically stayed for quite a long time on the balance sheet. Banks use assumptions based on historical customer behavior to estimate how long these type of deposits stay on the balance sheet. So banks took into account this stickiness and modeled the duration of overnight deposits to be actually even longer than the duration of term and redeemable deposits, as we show on the chart on the right-hand side. So this large inflow of liabilities with a large duration increased the duration of the liability side of the banks, counterbalancing the increase in the duration of the asset side of the banks, leading to a stable exposure to interest rate risk in the low interest rate environment. But then, in July 2022, the ECB started to increase interest rates. And since that moment, we see that immediately there has been a material shift from overnight towards term and redeemable deposits. Since these deposits have a shorter duration, this reduced the duration of the bank liability side, leading to a materialization of interest rate risk or net duration risk. And this we also show on this chart. So this chart shows you the average duration gap for euro area banks over time. And you see that between 2019 and the beginning of 2022, this duration gap has remained quite stable over time. However, since July 2022, you see that there was a steep increase in the duration gap. All right, I've now mentioned the term duration gap a few times, but how do we measure this exactly? So this is where we use the bank-level supervisory data that captures information on cash flows for each repricing and maturity bucket of the bank for all instruments on bank's balance sheet. And the duration gap captures the time to receive the cash flows from the asset side minus the time to receive the cash flows from the liability side. When a bank has a positive duration gap, this signals that a bank will lose in terms of economic value of equity when interest rates increase, because assets will lose more value than liabilities because of their larger duration. There are two important features of this data set I want to highlight. So first, I mentioned already that the data set contains information on behavioral assumptions that banks use to model the duration of their balance sheets. So for example, they use assumptions to estimate how long deposits, overnight deposits, will stay on the balance sheet, but also they estimate how many loan prepayments they will be. Second, as also mentioned before, the dataset includes information on derivative positions, such that our duration gap is actually net of hedging. And we can control for the fact that banks also hedge against interest rate risk. Before moving on to our empirical analysis, first we have to answer the question, why should interest rate risk matter for bank lending? And in the paper, we use several arguments for that. The first one is that we know from the literature that banks try to have a stable duration gap over time, and that they want to match the duration of their assets and liabilities to lock in long-term profits with stable funding. Therefore, a sudden reduction in the duration on the liability side might also trigger a reaction on the asset side. Second, we know that net duration risk signals losses in economic value of equity, which entails lower expected profitability and capital accumulation in the medium run. This is also supported by this paper by English, which shows that the positive impact of an increase in interest rates on bank profitability actually fades out and becomes even negative after 1 year. And we also show it in the chart on the right that having a larger duration gap has a negative effect on the projected change in net interest income over 12 months. And then finally, supervisors may ask banks with a large exposure to interest rate risk to hold additional capital to cover for interest rate risk. Banks will want to avoid this supervisory scrutiny and keep their interest rate risk contained and deleverage to do that. To answer our research question, we have to face multiple empirical challenges. The first one is that we want to control for credit amount such that we are sure that the effects we capture are purely driven by the supply side. We do this by using firm time or industry location size time fixed effect as a standard in the literature. Next, we also want to control for the interest rate type, so whether a loan is fixed or floating. Because banks with a high duration gap might especially want to reduce their fixed rate lending and maybe even increase their floating rate lending to keep their duration gap or to lower their duration gap. And we do this by additionally interacting these firm time or industry location size time fixed effects with interest rate type fixed effects. And the result of this combination of fixed effects is that we compare lending to the same firm coming from multiple banks to the same firm with the same interest rate type coming from multiple banks with a different duration gap. Third, we have to control for the fact that the monetary policy tightening also had a positive impact on bank profits in the short run. And we do this by controlling for the heterogeneous impact of net interest income on lending. And in the next slides, it will become more clear how we specifically do that. And then finally, it can be argued that the tightening in monetary policy was not entirely exogenous, that banks expected some kind of tightening to happen. However, the pace and the magnitude of the tightening was not expected. And this we show on the chart here, where we use data from the survey of monetary analysts. And if you look at the yellow line, which shows the expectations on the interest rate path in the month right before the tightening, you see that this path is a lot lower and goes up a lot slower than the red line, which is the actual realized interest rate path. This is our empirical strategy, so we estimate this regression at the bank firm quarter level, where our dependent variable is the change in lending, and our coefficient of interest is this beta, which captures the heterogeneous impact of a change in the policy rate, depending on the level of the duration gap of a bank at time t-1. We include multiple bank-level characteristics that might also have an impact on lending, such as bank size, profitability, the income gap, funding structure, capitalization, liquidity, and non-performing loans. Importantly, we also allow for all these control variables to have a heterogeneous impact of changes in the policy rate. So, and that is this interaction between this X term and the change in the policy rate. And this is how we also control for the fact that some banks might have benefited more from a tightening in monetary policy in terms of profitability and the impact that this has on lending. We use a combination of fixed effects as explained before, and in some specifications we also include country times time fixed effects. Our time frame goes from 2021 Q1 to 2023 Q2, and we have 73 significant institutions in our sample. And now I can move on to showing you our results, starting with the results for the intensive margin, looking at the effects on lending growth. And the 4 columns you see here differ in the aspect that in the second and the fourth column we include the control variables interacted with change in the policy rate. And in the first 2 columns we do not include country times time fixed effects, while we do in the third and the fourth column. As you can see from the coefficients in the red box, we find a negative and statistically significant coefficient for our beta, so our coefficient of interest. To put these results into some more perspective, we find that when interest rates increase by 100 basis points, a bank with a duration gap at the 75th percentile reduces lending by around 90 basis points more than a bank at the 25th percentile. Similarly, we also find that banks with a higher duration gap have a lower probability of issuing a new loan compared to their peers. Together, these results suggest that banks with a higher duration gap deleverage more than their peers when interest rates increase. Second, we want to look at whether there's any portfolio reshuffling coming from these banks with a high duration gap. And the first dimension we look at is loan maturity. So we will compare the effects on short-term lending growth versus long-term lending growth. And as you can see from the coefficients in column 5 to 8, we find a negative and significant effect for long-term lending growth, meaning that banks with a high duration gap especially reduce their long-term lending. And this is intuitive because this long-term lending are the loans driving the high duration gap. So by reducing this lending growth, they will also reduce their duration gap and their exposure to duration risk. On the other hand, we do not find any significant impact on short-term loans. And again, we find also similar results on the probability of issuing a new loan. Before moving on to the next slide, I want to say that the fact that there's a reduction in long-term lending can have important implications for firms, since it exposes firms to more financing risk, which can impair their investment strategies. A second dimension of reshuffling we look at is to the interest rate types. So we want to look at whether there's a differential effect on fixed rate versus floating rate loans. To estimate these regressions, we have to remove the interest rate type fixed effects from our regressions, such that we can use a triple interaction with a dummy, which is 1 when the loan has a floating rate. From the first red box, this which shows you the coefficient that capture the effect on fixed rate lending, we find that banks with a high duration gap especially reduce their fixed rate lending compared to their peers. For the effect on the floating rate loans, which is shown in the second red box and is evaluated using an F-test, we do not find overall a significant effect. Again, this makes sense. These fixed rate loans are the ones driving the higher duration, so reducing them will also reduce their exposure to duration risk and may help the banks in avoiding supervisory scrutiny. And again, we find similar results on the probability of issuing a new loan. Since we find evidence of a lending contraction, we also want to know which type of firms would be more affected by this contraction in lending. And we do this by looking at different firm sizes. So again, we make use of a triple interaction, where the baseline category represents the results for the large firms, and then we have results for medium-sized, small-sized, and micro-sized firms. From the first line, you can see that we do not find that banks with a larger duration gap significantly reduce their lending towards large firms. However, the results become significant and more relevant also in terms of significance and magnitude for mostly the small and micro-sized firms. So again, to put these coefficients into a bit of perspective, we find that when interest rates increase by 100 basis points, a bank with a duration gap at the 75th percentile reduces lending by 90 to 97 basis points more to small firms compared to large firms, while this is between 40 to 56 basis points for micro and medium-sized firms. This could have important implications for the real economy, for financial stability, since it might be harder, more difficult especially for small and micro-sized firms, to get access to alternative funding. They do not have access to market-based funding like the large firms do, and are often also faced with a larger lending discretion when trying to get credit from the banks. Of course, we find this reduction for high duration gap banks, a contraction in credit. There would be no problem if the affected firms can substitute by borrowing more from other banks, for example, the banks with a lower exposure to interest rate risk with a lower duration gap. So we want to also empirically test whether there's an effect in the aggregate for the highly exposed firms. So to do this, we move on to a firm quarter level analysis, where we estimate whether the change in the monetary policy rate had a differential effect for highly exposed firms compared to other firms. And here we define highly exposed firms as firms that borrow for more than 50% from high duration gap banks. And here high duration gap banks are defined as banks in the top quartile of the distribution in the first quarter of our sample. And as you can see, we find that the coefficient of interest is negative and statistically significant, meaning that firms that are highly exposed to banks with a high duration gap exhibit around 75 basis points lower borrowing compared to other firms, and meaning that firms cannot fully substitute the contraction in borrowing coming from banks with a high duration gap. Our results are robust to multiple robustness checks, and for the sake of time, I will only highlight a few of them. So if you could please go to the first results. Yes. So first thing we do is that we include single bank firm relationships into our sample. Why? Because as you can see from the chart there, these relationships can be quite important for multiple countries in the euro area. And the results are shown in the first 4 columns of this table. And as you can see, our coefficient of interest is still negative and statistically significant. A second thing that we do is that we restrict the sample to only include single bank firm relationships. We do this to limit any self-selection that there might still be for firms that have multiple bank relationships, since they could choose to borrow less from banks with a higher duration gap. But also when only focusing on this sample, we still find a negative and statistically significant results. So if you could go back to the slide and show the next results. Thank you. Something else that we do is we use a predetermined duration gap to perform our regressions to limit reverse causality issues, and we have two approaches of doing that. So one would be rather simple, where we fix the level of the duration gap at a level before the tightening, and we see what the regressions tell us. And in the third and the fourth column, you can see that, again, our baseline results are confirmed. Then another approach we take is that we collapse the data in the pre and post event setting, meaning that we look at the change in lending pre and post the monetary policy tightening, and we keep all the independent variables at the level before the tightening. And also in this case, our results are confirmed. And the last thing I wanted to highlight here was, another robustness check we do is that we control for the deposit base of a bank. Why? So we argue in the beginning of the paper that the materialization of interest rate risk was related to the shift from overnight towards term and redeemable deposits. The magnitude of the shift might be related to the deposit base of a bank. For example, if a bank has more deposits to firms than to households, firms are typically more eager to move their deposits around and to find more remunerating alternatives. The shift is larger. So that's what we also witness in the data, where we see that the shift for firms, so the yellow lines, was more pronounced than the shift for households, the blue lines. So we want to control also for this aspect in our regressions, and we include the share of overnight deposits to households in the regressions, and as the other control variables, we also interact this with the change in the policy rate. But even when doing that, we find a negative and statistically significant effect for our coefficient of interest, meaning that banks with a higher duration gap contract lending more when interest rates increase. You can go back. Thank you. Okay, so I won't talk about all the other robustness checks, but then finally let me conclude. So we find that banks with a larger duration gap, they leverage and reduce especially their long-term and fixed-rate lending more compared to their peers when interest rates increase, and they do this to reduce their duration gap and to avoid supervisory scrutiny. We find evidence that small firms are mostly affected by this deleveraging, and we find that affected firms cannot fully substitute the contraction in lending. Our findings have important policy implications. First, we find that the transmission of monetary policy to bank lending is heterogeneous, depending on the level of the duration gap of a bank. And second, we find evidence for a contraction in lending, especially long-term lending, which could exacerbate the economic downturn with most pronounced effects for micro, small, and medium-sized firms. So that was it. Thank you for your attention.
Thank you, Lara. The discussion will be given by David Martinez-Miera from the Universidad Carlos III de Madrid.
Okay. Thanks a lot, everyone, for being here, and especially Philip, Diana, Bjorn, everyone that has organized this, for allowing me to read such an interesting paper that I will be able to remember. I normally don't remember papers. This one, I'm sure. It has a very straight point, and let me just go here. Basically, does bank duration gap affect lending responses to rate increases? Yes, that's it. That's my discussion. So if you have to remember, that's it. It's very clear, super robust, throw out whatever you want, that is happening. So I guess that part of the ChaMP network already has a result. There you have it. Now, all my discussion, if anything, is that little, but why? Could we learn a little bit more of why it is happening? It is happening, I have no doubt about it. Maybe we can learn a little bit more of why it's happening, just in case there's ChaMP 2 or something like that, okay? Good. Well, something if you want to take in mind here is that these are big banks, okay? We're talking here about big banks. Just in case someone thinks about, is this relevant or not? Probably yes. I really don't care. These are the most important banks in Europe. But anyway, those are the big banks, okay? And again, the main evidence is the main evidence. Duration matters for the transmission of monetary policy, or at least rate hikes to lending. Now, the paper is relevant, timely, yes. There's something that even gets someone like me, that I think of myself more of an applied theorist, excited. The data is awesome, so probably I'm going to try to poke her to tell us a bit more about the data, or even poke some of you that know the data over dinner, because there's a couple of things that are very interesting. You have off-balance sheet items, you have some other interesting things happening. I'm going to talk about them later. And yeah, basically what I'm going to say, can I learn more about why is this happening? Okay? Just in case you just arrived here from some outer planet or something, basically monetary policy is back on tracks, low for long has ended, and maybe the consequences of low for long are here. That's something that the paper hints at. I'm going to talk about later. I don't really think the paper is about that, but anyway, I'll come back to that. Now, just a brief reminder, I had to go check some of my class notes on duration. A brief reminders, yeah, we all remind you, if the rates go up, this can affect the value of the assets or the liabilities down. That was okay. What exactly is duration? Well, basically, it's a weighted average of the cash flows. That's not so relevant for today. Probably what's relevant for today, or you already remember, but I didn't remember so much, is that duration is actually capturing how much the value of your asset is going to fall when the rate goes up. Okay, so if the duration is high, if the interest rates go up, the value of that asset is going to go down a lot. Okay? So basically, what do the authors do? They basically go, let's put all the assets and liabilities together. That's where the gap is coming from. And let's subtract the liability part from the asset part. Okay, you have the asset duration, you subtract from the liability duration. The whole bank, this is awesome. They have all this off-balance sheet. That was something that I always wanted to know about. And they put it in, and then you have a measure of how exposed is the bank's value, at least with this measure, to rate hikes. Great, that's what they're doing. Now, does this matter? It looks like it does. Basically, what you're seeing here is the last 2-3 years. Something that caught my eye, and it's not about the paper, but this is one of the first questions I'm going to ask there to see if someone grabs. Look at the yellow line is actually the hedging part, okay? And the blue line, and the blue part is basically the on-balance sheet items. That's sort of what I understand. It's the off-balance sheet to on-balance sheet. And what you see is that the on-balance sheet items are changing its duration, but not the off-balance sheet. Okay, that's not about what this paper is about, but maybe there's some trend there that might be relevant to understand. I'm somehow thinking that maybe hedging is more related to off-balance sheet. It was never clearly stated in the paper. I'm just making it up, okay? So maybe there's something there that might be valuable. Anyway, this is the paper for you, or for me at least. What's the paper? Basically, what we see is that when the policy rate goes up, when you use the cross-section dispersion of banks, you see that those that, I'm going to use Titan, okay? This is a diff in diff, so it's relative everything, but let me use Titan. Titan lending more are the ones that have a higher duration gap, okay, that were more exposed to a decrease in their value because of this rate hike. Okay, this happens in the total amount of loans, this happens on new loans, so extended intensives, and also it happens more for high maturity loans, so there's this reshuffling that Laura was talking about. They cut especially the long-term loans, and if anything, in some of the new loans, which I think was even interesting, they actually increase a bit more the short-term loans. That's actually nice. And this happens more for small firms, okay? So I think that's also relevant. This is not happening for the big firms. Be worried about the small firms of your country. That's where this channel is hitting, okay? Now, here's I'm going to do a very cheap comment here, so sorry for that. So basically, I think we all have this idea that bank finance is not perfectly substitutable. So basically, they find that it is not substitutable, okay? And something I'm sure she has 75 robustness checks, so sorry for us for 76. Just include real effects, it's going to come, I bet. So there's nothing new there, but yes, I guess that's there. Don't worry, I will have some hopefully valuable comment. So probably this. So what is driving the results? So we have the duration gap, okay? And the first thing that strikes me hard is that it's totally unrelated to any bank characteristics. Okay, you have the direction gap. It's not related to the total assets, the cash, the ROA, throw whatever you want on it. It looks like it's not correlated. Maybe I got it wrong, but that's already an interesting fact per se. Okay? Now, actually, is it related to the low rates? Because this relates to the low for long kicking in or not. So maybe you could give some simple evidence that actually duration gaps were related to the low for long, or the longer you are down, the more you get exposure. Because there's a narrative of that, there's some anecdotal evidence, maybe you can link it, because then you can link in, I think, nicer, the low for long to the kicking in and something like that. If not, I'm more skeptical. Now, what would I do? What I would do is I would actually decompose the gap. There's different elements of the gap. You have off-balance sheet or non-balance sheet items. Decompose them. You have asset and liability duration. Decompose them. You will see that I'm going to run for 2 minutes on something that has nothing to do with the paper, that I'm super excited about your paper, and it's definitely not about what you've been talking about, which has to do with the belief structures of people and things like that, okay, or your conversation. But anyway, long story short, I would decompose, see which of the duration is more relevant, because maybe it's that it's coming more from the asset side than from the liability side. You are talking a lot about the liability sort of input, but maybe there's something going there on the asset side. What really, I don't really know. I could talk to you later about some ideas, but I think that this is easy to check. Okay? Now, what I would try to separate is basically at least 4 stories. The most obvious one would be the last one. So I think that's what's happening, but let us go one by one. So part of your narrative is that this is related to the liability, yeah? The household deposits, that they basically can run and change, and this changes the duration gap, and this can lead to contraction. But actually, given, you say you control for it in your real business, but when you see if that's significant, you find that household competition is not actually significant for the transmission of monetary policy. So on that side, it may not be that it's so much about the deposits, the household deposits, driving all of this. It could be, I'm just saying that might be one story that you want to dig deeper. Now, they do something very nice, that they check for actual capital requirements, okay? But what I'm wondering is, could this be about market-imposed capital requirements? Okay, could it be that banks basically have, a la Bernanke, Kiyotaki Moore, all this type of market-imposed capital requirements? I have a duration gap, my future equity or my equity value is going down, then somehow the market's saying, hey, you cannot lend so much, okay, because you abscond or any of these theories. Now, you talk about supervision. Well, why is this happening? Capital, we know it's not an issue there because you control for it, so it's not happening because of that. Maybe it's happening for other issues, like, I don't know, liquidity coverage ratios are getting worse because of this duration gap. Or maybe there's some elements of stress tests that are actually hitting, and this is what's driving it. So I don't know, if you could help us there a little bit, then this would help us. And basically, I think this is as simple as, well, if the marginal income that a bank can make from doing his business goes down, probably the quantity comes down. As simple or as difficult as that. If you can cross some of the dots, then maybe that goes as to say that this is the ending story. Now, related to this, there's something surprising for me, is that basically nearly more than 25% of its sample have negative duration gaps, okay? That means that banks are lending short-term and borrowing long-term, okay? I'm going to repeat this 2 times more in the next 5 minutes, so don't worry, okay? Now, why am I saying that? Well, I would actually try to, get more of that. Decompose the sample into these 2 types of banks. It could be very different for a bank that is actually doing, a positive duration gap, and hence the interest rate hike is actually decreasing its value, than for a bank that has a negative duration gap, in which an increase in the rate is actually increasing its value. To their credit, you do have a dummy there that tries to, but I think you're controlling for a different story here. What I'm telling here is, do you see the same symmetrical effects on the positive gap guys than on the negative gap guys? Why? Well, basically because I think the predictions I have in my head are different. One should tighten constraints, and the other one should loosen. One should lend more, and I know this is undefinitive, so all of this is relative, but looking there, maybe you could be able to disentangle some stories. Well, here comes my comment that is a bit related to your paper and not so much. It has to do with the overnight deposit duration. So I think only this deserves a couple of papers. So let's see if I'm right or not. So basically, overnight deposits have long maturities. I'm sure no one is surprised. I had to read it 3 or 4 times. I actually went to Google to check it. Why? Well, basically, what I thought is that the contractual maturity of an overnight deposit is 1 day, and I think I'm right. Okay? The difference comes from this belief structure that I think is very nice that they have. Basically, we are allowing banks, I'm sure for very good reasons, quote unquote, to tell us how sticky are their deposits. This is what's changing this idea. So then basically overnight deposits actually have high maturity, not because contractually they have low maturity. No, contractually they have short, very extremely short maturity. It's just because banks, through their models, say that even the contractual maturity is 1 day, let me put X, when I don't really know what X is. Okay? Now, this has a fundamental effect on the calculation of the gap, because remember, the gap was the asset side duration or maturity minus the liability side. So any estimation here is going to affect fundamentally your results. Okay? Now, I would really want to see what happens in your results if you run and I'm going to call it contractual duration. Okay? So is it all of this about banks' behavioral models telling us something on their duration? Or is this just, okay, yeah, forget it's not about that part, it's about more standard parts of the duration, okay? Because again, this will lead us to learn more of what's underlying, okay? Basically, my suggestion is just run it again, put one day maturity on those guys, on the overnight deposits, and see what happens, okay? Now, and this is what's not about your paper. I have 2 minutes. I'm going to bore you, but let me say it. So, anyone knows why this is allowed? Anyone knows why we are allowing banks to have overnight deposits that in principle are very flighty to be stated as very sticky? I am not sure this is theoretically sound. Okay? Theoretically, if you receive a shock, new pricing, you are going to react more in all contracts in which you can react, as I'm saying as a household. Okay? So if I have a demandable deposit and suddenly rates hike, probably those are the ones that theoretically I would react to. But I'm not even sure it's only theoretically. I think that that's what DSS and some other people are pointing at. They're saying when households react, they react more on the overnight deposits. You also show that there's this decrease on overnight and increase. So they're not so sticky, I think. Okay? So, probably this, and this is why I say there's more than one paper out of here. Probably this has effects for, the stress test, the LCR ratios, all that assumptions are not only about this paper, are going to have much more impact, okay? And, I would really appreciate if someone could just tell me, because I've been thinking about this nearly as much as about your paper on the last day. So if someone could come to me and explain to me, I would really, really thank you, because I'm just stuck there a little bit. Anyway, it's a very nice paper, easy to remember, important for ChaMP, and my only thing is, could we learn a little bit more of what's the underlying of this? I'm sure we can, so I'm just looking forward to learning more about your paper, and many thanks for any of you that can explain to me why are we having these sticky deposits overnight. Okay? Thank you so much.
Thank you, David. Lara, do you want to react to the discussion?
So thanks a lot for the interesting discussion. So first, I will try to reply in reverse order. So on this contractual and the fact that banks can behaviorally assume so many things about the stickiness of their deposits. So what banks often do is that they have models to estimate the duration of these overnight deposits based on historical customer behavior. And these models are often calibrated based on the previous 10 years. And if you look at the start of, now still, there was the majority of this period was low interest rates, and deposits were very sticky. So that's why it happens. I'm not saying it's correct. It leads to an underestimation of interest rate risk, but I mean that's how it happens. And related to your comment whether looking at the contractual assumptions would matter, I think yes, a lot, because not only would the duration of assets be longer, because if banks don't model loan prepayments, the duration of the loans would be longer, and the duration of the liabilities would be a lot shorter. So it would indeed give a different picture, and it would support this intuition that banks should have a positive duration gap and not a negative one. But since we use behavioral data, but also in the paper we try to give some different intuitions why some of our banks, well, a quarter of our sample more or less, has a negative duration gap, such as the fact that there was TLTRO, which also increased the duration of the liability sides. And also these are often banks with a lot of floating rate loans, which decreases the duration of the asset side. So these are things. And then definitely I agree that we can look a bit more at breakdowns. We have granular information, so we should exploit that definitely. And also, try to also find more empirical support for the channels we propose, like why is this happening? So also an idea of like looking at the derivatives or the hedging part separately would be something we will think about. So thanks a lot for all the suggestions.
If there are some questions from the floor, we can take them now.
It was a perfect paper. Hey, great paper. Frederick Toscani from the IMF. I was wondering, very simple question, if you were to aggregate the heterogeneity a little bit, for example, on the bank side by geography, let's say, and on the firm side by sector or so, is there anything that stands out?
We didn't really do this exercise yet, so it would be interesting to see also where, for example, banks with the high duration gap are more situated, which type of countries. But of course, this is related to having a lot of fixed rate loans, for example. In some countries, this is more pronounced than in others. But to give you now an answer to that, no, I can't.
There was another question there.
Hello. Is this on? Yeah. Tomás Carrera Sousa from the Dutch Central Bank. Thanks for the paper, very interesting one. I have also a simple question about your measure of the duration gap. It relates to David's comment on this assumption of longer duration of overnight deposits. I was wondering if this changed throughout the time of your sample, and if this enters the variable you use in your empirical approach, because in fact overnight deposits prove to be less sticky than they were assumed to be. Thank you.
Thank you for your question. So the data is time varying, so we can take account of variations into these assumptions. What we see, however, is that this is very slow moving. So if you look at the quarter right before the tightening, banks were still modeling the duration of their liabilities, these overnight deposits, based on the low interest rate period. So even in the adjustment since the tightening, we see that some banks are adjusting, but other banks are not adjusting at all. So, but we have this information, yes.
Yeah, Simone Manganelli, ECB. There is a colleague of ours, Peter Hoffman, who has a paper on using EMIR data to check whether banks use interest rate derivatives. And they find that on average, the whole banking sector is hedged, but there is a lot of cross-section heterogeneity. So it would be interesting to see how your results change once you control for the exposure net of this derivative.
Right, yeah. Yeah, thank you for the suggestion. Yeah.
And there was another question over there.
Hi. Yeah, thanks for the great paper. It's actually a follow-up on one of David's point about linking this increasing duration to the low rate environment. Because from the graph you showed, it looked like duration is actually falling in the first part of your sample, but that's already during low for long. And then it's only increasing afterwards. So do you have any idea what changed to make that change in the trend?
So you mean why there's the spike in the...
So it looked like it was first falling, and then later it's spiking, and I wonder why.
Yeah, no, I mean, it's also the COVID period is shown in this chart, so this might have an effect on it. Although, like the drop is a lot smaller than the steep increase we saw since the tightening. So if you would take a line in the period before the tightening, it's relatively stable. The deviations are not that much, but maybe the COVID period could explain part of the drop.
Okay, so I see no other question, and then we are ready to take a coffee break, and we resume at 5:05. Thank you to all of you.
Quick announcement as well. So Margherita, thank you.
It's very formal. I was also shocked. I thought it was.
I expected it to be formal because it's central banks, but it's like a level up.
Exactly.
Really,
I was also a bit shocked.
Gonzalo?
yeah. I don't like formal, in case you're wondering.
Check with Melina later that she comes.
I think it's another
for
job.
the dinner.
Yeah.
You know, all these things, but yeah, that's
Yeah, exactly.
TV presenter, it's different than...
Yeah, it's like an extra thing. But I mean, I will run around and break their rules, so I don't... What will happen?
We survive. It's...
Yeah, exactly. I mean...
Did you submit already the paper? Or?
Yeah, we have an arena even.
Really?
Yeah, so I've been working on the revision for the last month.
So Christina, discussion is just for fun, basically.
Well, I actually, we talked a bit before because we're always in the same program, so I asked her to help a little bit with some, I mean, like, she does what she does, but there were some points which, yeah, I was struggling with in the reports, so, I mean, we'll see. I hope that it helps. And yeah, so it will be actually very useful, I think.
Welcome back to session 2 of the first day of the conference. We are still the monetary policy transmission through the banking sector session with our last paper. This is a very interesting paper with a broader historical perspective. The title is Monetary Policy, Inflation and Crisis, Evidence from History and Administrative Data, and it will be presented by Dmitry Kushinov, Universitat Pompeu Fabra.
All right, so thank you very much for the very nice introduction, and thank you to the organizers for accepting our paper into the program. I'm very excited to be here. I hope I don't let down the standard with so many excellent papers today. And thank you for everyone for sticking it out for the last session. I hope you enjoy it. So the paper is co-authored with Gabriel Jimenez, Jose Luis Pedro, and Bjorn Richter, who are colleagues at UPF, the Bank of Spain, and Imperial College. And in this paper, we'll look at the links between the path of monetary policy rate and the risk of banking crisis. And we do it using mostly historical data and also some administrative data for the recent crisis in Spain. Now, I thought it was interesting to have the presentation before because even though we use a very different data source to Lara, I think our conclusions are actually kind of aligned in that we also find this increased stress in the banking system if you raise rates after you cut them and then kept them low for a long time. So I think these two papers fit each other very nicely. So the reason we started looking at this project in the first place is that for the last few years, we've been in an environment of high inflation and rising monetary policy rates. And obviously, monetary policy makers need to get it right, need to balance various kinds of trade-offs and risk. The one kind of trade-off we know quite a lot about is the trade-off between taming inflation and triggering a recession. But there are also other very important kinds of trade-offs. Maybe the main one of them is that raising rates can trigger a financial crisis, especially if in the previous period, that's why I connect to the previous presentation, you've kept the rates low for a long time. And indeed, over the last couple of years, we saw many kind of financial distress events, both in the banking sector and in different financial markets around the world. And we also saw policymakers and academics getting concerned about raising rates from a low level. But that being said, empirically, we kind of know relatively little, at least less than about these other types of trade-offs, about the links between the path of monetary policy rates and the risk of banking crisis. So when we started looking at this question already more than 2 years ago, we thought that there might be something there. Because if you look at the kind of case studies of important banking crises in the past, you see a quite consistent path of monetary policy rates. So here we have the Barings crisis from 1890 in the UK, the Great Depression, the Scandinavian and Japanese crisis of 1990s, global financial crisis. And in all these crises, you have the same kind of monetary policy rate path. So first you cut rates, then you keep them low for a while, then you raise, and then you get a crisis. So this made us think, OK, let's explore a little bit this relationship between this path of monetary policy and crisis risk. And this is exactly what we do in the paper. So we, first of all, ask a question of, OK, conditional on a crisis, do you observe this U-shaped path that you saw in the case studies? Then, OK, that's the first question. Then the second, conditional on a U-shaped path, so cutting rates, keeping them low, and then raising, are you more likely to observe a crisis? And then if the answer to both of these questions is yes, what are the underlying mechanisms in play? It's an empirical paper, and we use a two-pronged approach in the data. So most of our analysis, our results on the crisis risk and on the mechanisms come from a long-run panel of historical crises, which goes back to 1870 for 17 countries, covering around 80 systemic crisis episodes. And then we also apply our methodology to a case study using detailed credit registry data for Spain around the global financial crisis, which allows us to see what kind of loans, what kind of firms and banks are more effective during this kind of dynamics. Now, the two key variables for our analysis are the crisis and the monetary policy rate. Crisis definition is standard kind of narrative of distress in the banking system. For monetary policy rates, we use the short-term nominal interest rate, either just whatever rate the central bank sets, or the rate residualized to macroeconomic dynamics, GDP and inflation, or this international finance trilemma instrument. So the idea is, for the instrument is that if you are Spain and you peg to Germany, when the Germany raises rates, you have to raise rates just to follow them. That's the idea behind the IB. All right, so that's what we do. What do we find? So first of all, we do find indeed that a U-shaped monetary policy rate path increases crisis risk. Conditional on a crisis, you are very, very likely to observe a U-shaped rate path before. That's the first point. Then the second point, the other way around, if you have a U-shaped path, in particular, if you raise rates after a period where you cut them for a long time, then you are much more likely to get a crisis. If you raise rates not after a period where you've been cutting them over a long period, you are not more likely to get a crisis. So the U-shape is really key. This is different for non-crisis recessions. There we don't observe any of these U-shaped effects. And it's also stronger for a deeper U-shape. So the more you cut rates before and the more you raise them after, the more likely it is that you will get a crisis. Now, in terms of the mechanisms, we link these U-shaped monetary policy rates to a financial boom and bust, and we find that it's the combination of the two that is crucial. So what we find is that, first of all, when you cut rates, you're very likely to have a financial boom. So financial boom, we use a definition from a recent Journal of Finance of Greenwood et al., where you have very high asset price and credit growth at the same time. Okay, so you cut rates, you have a financial boom, and then after a financial boom, you quite often have a crisis, but we show that this only happens if you raise rates in the boom. Right, so if you raise rates in the boom, you have a crisis. If you don't raise in the boom, relatively much less likely to have a crisis. So it's the combination of this U-shaped monetary policy and this financial red zone or financial boom that is crucial. So the key thing is that you cut rates, you enter a boom, then you raise rates, and then you get a crisis. Then we explore some more detail on the mechanisms. In our macro panel data, we show that there is a boom bust in bank performance. So first, banks doing very well, making a lot of profit during the boom. Then when you raise rates, they're suddenly making large losses. The returns on bank equity is very low, and so on. And then we're able to look at micro data. We find similar results, but in micro data, we can test for which banks and for what kind of loans is this distress strongest. And that we find that this distress in the form of loan defaults is higher after U-shaped monetary policy, and it's especially high for ex-ante riskier firms and banks. All right, let me now go through one by one these results of the paper. So starting with the link between the path of monetary policy rates and future crises. So in terms of the data, we're going to need a large historical sample because we want to document facts for an average crisis. So we use the standard data source in literature, which is from the Joda-Taylor database, 17 advanced economies, and of Europe, US, Canada, Australia, Japan, going back 150 years, which gives us about 70 to 80 crises. The crisis is defined based on a narrative of bank runs, defaults, or forced mergers in the banking sector. Again, standard definition. Our results also hold an alternative definition, which is not based on a narrative, but based on sharp declines in bank stock returns on market data. Then the second key variable is the monetary policy rate. So for this, we use the short-term interest rate which is when we have it, the rate set by the central bank, but sometimes in history it's not always clear which rate the central bank sets. So we also use interbank rates and rates on short-term treasury securities. Okay, so now we have this data. We have the short-term rates and we have the crisis defined as in the previous slide. We can see what's the path of monetary policy rates before or around an average crisis. Here we condition on a crisis in period 0, and then we just plot the average level of this monetary policy rate. This is 6% going down to 5% and then raising again over 7 years before and 7 years after a crisis. And we see that this U-shape is not something that just happens in the case studies. It's something that happens before an average crisis. So you see a U-shape for a crisis on average, a stronger U-shape for a deeper crisis, and then a stronger U-shape again after World War II, especially for deep crisis. But then, this is the average path. It could still be very noisy. It could have some large standard errors. So the next thing we do is we're trying to put some confidence band around this path. So what we do for the confidence band is very simple. We just regress the change in monetary policy rates. These are horizon h, t plus h minus horizon t. So from 7 years before to 7 years after the crisis on a dummy, equaling again at year 0 the crisis with some country and decade fixed effects. So it's exactly as before, only now we have a standard error around this path and it's normalized to 0 at the time of the crisis. Again, we see a U-shape for different types of crisis with quite narrow standard errors. So the next thing we did is to think, okay, it's something that happens before a crisis, but does it happen before any kind of bad macroeconomic event? So as well as crisis, we started looking at non-financial recessions. So that's a recession where you don't have a banking crisis in the vicinity. And then we run the same kind of regression, but now the dummy is not for a crisis, but it's for a recession in this time 0 line, and the scale is as on the graph before. So we see two things. So first of all, for a non-financial recession, the movements and rates are much less pronounced. So these things are much more flat relative to previous slide. And the second, most importantly, you do not observe a U-shape. So instead of a decline, low level, and an increase, you just observe some kind of normal level and then a hike before the recession. So it's all about rate hikes, not this U-shape of cutting and then hiking. Now, as a final way of summarizing these things, we can look at the statistical frequency of different monetary policy rate paths before a crisis or a recession. Okay, so what we do here is, first of all, we classify the different paths of monetary policy rate. So first of all, we have a U-shape. What is a U-shape? It's over a period of 8 years, you cut rates for the first 5 years, and then you raise rates for the next 3 years. That's the U-shape. Then you can be raising for all of 8 years. That's the second shape. You can have a lambda where you're first raising and then cutting, or you can be cutting throughout. And then we say, okay, you condition on a banking crisis today, and over the previous 8 years, how likely you are to observe a U-shape. So 55% of crises were preceded by U-shape. Every single deep banking crisis, so deep means economically bad for GDP, so every single deep crisis after World War II was preceded by U-shape in monetary policy rates. And these frequencies are much higher than what you'd observe on average, which is about 25% for each of the 4 shapes. Then we do the same thing for non-financial recessions. And here we see that the frequency of the U-shape is close to 30% and generally not statistically higher than the unconditional frequency. So before a non-financial recession, you're not that much more likely to observe a U-shape than unconditionally. So again, this U-shape is something specific to banking crisis. All right. So the next thing we do is now we start to look forward. This is conditional on crisis or recession looking back. Then we do conditional on shape looking forward. So here again, we have the 4 shapes over an 8-year period. U-shape, raise, cut, cut, cut. And then we say, okay, after these 8 years, you observe a shape. What is the crisis probability in the next 3 years? After a U-shape over the next 3 years, there's roughly 20% probability of having a systemic banking crisis. It's also there for deep crisis, for after World War II crisis, and so on. It's much higher than the unconditional probability, roughly double. And it's much higher than the probability of the other shapes, and they are statistically different. Right? So basically, after a U-shape, you're much more likely to observe a banking crisis than other monetary policy shapes. It's robust to different crisis definitions, windows, and things like this. Now, the next thing we want to do is we want to put this kind of shape specification in regression and put some controls and see, if it really holds in a more kind of strict econometric setting. So this is what we do. We put things into regression, and then one thing we need for the regression is an instrument to look at relatively more exogenous changes in monetary policy rate. So it's a fairly standard by now instrument in this kind of historical literature, especially, is based on the trilemma of monetary policy. And the idea is that if you have a fixed exchange rate regime, you are forced to follow, under open capital markets, the country that you peg into. Going back to Mandel. And the way we implement it is, similar to these other papers which have done this kind of specification before, is we say, okay, suppose you're Spain, peg into Germany, then you have the rate in Germany, residualized to economic conditions in Germany. You have to be pegged to Germany and have open capital markets, and then you can use this residualized German rate as an instrument for the interest rate changes in Spain. So let's see what happens once we put these things into a regression. Okay. So the way we do this is that we have on the left a crisis dummy. So it's a dummy which takes variable 1 if there's a crisis in the next 3 years. On the right, we have the percentage point change in rates. So that's kind of the last leg of the U, the raises. Then we have the cut over years t-8 to t-3. That's the first leg of the U, the cut in rates. And the interaction, which is really the U shape. So the interaction tells us if you raise rates after cutting, it's much worse for crisis risk. What do we get? In the full sample of crisis, we have that, first of all, that increasing rates increases crisis risk. That's kind of in line with previous studies. But then once we put all of the three terms, we can see this the interaction of the cut dummy for cutting rates before and then increasing rates that is important for the risk of crisis. So for example, focusing on this IV column 4, we see that on their own, increasing rates without previous cuts do not really predict crisis. But then if you cut rates before, every single percentage points of higher rates brings up crisis probability by 7 percentage points, which is quite large given that the average probability is like 10 percentage points. So yeah, we have these large combined effects, and what matters is the U shape, this interaction in raising rates after you've cut them previously. Similar results, a little bit stronger after World War II, when monetary policy was perhaps a little bit more active in managing the macroeconomy. Again, these results are robust to various checks, like a different crisis definition, excluding global financial crisis, running different kinds of specifications and models. So now we have shown that when you raise rates after cutting them, it increases the risk of banking crisis. The next thing we want to do is to see if we again observe the same for non-financial recessions. So on this slide, you have the same regression, but on the left, instead of a dummy for crisis, you have a dummy for a non-financial recession, so a recession which is not also a crisis, or a recession which is a deep recession, but is not also a crisis. Okay, we know that raising rates makes a recession more likely. This is what we knew before, the top row. But you do not observe these interaction terms. So raising rates after cutting them does not make a recession more likely than raising rates after raising them. There are no U-shape effects. The last thing we do in this section on U-shapes and crisis risk before we go to the mechanism is to try and see, do different kinds of U-shapes lead to different types of crisis probabilities. So what we do, we look at two ways of looking at whether this U-shape is kind of deep or strong. The first way is just look at larger cuts in raises. So we see, okay, the more you cut rates and then the more you raise them, just in percentage point terms, the more likely you are to have a crisis. It's kind of what you would expect, but it's also interesting that there are kind of there's a continuous nature to this result. The second thing is that does cutting and then raising rates too much increase crisis risk? Okay, too much relative to what? What we do is we look at whether you cut more than your normal monetary policy rate reaction function to GDP growth and inflation. And we estimate this reaction function by country and time period, referring to different monetary policy regimes. And we try and see, if you cut rates by more than you normally would as a central bank, given observed GDP growth and inflation, and then you raise them by more than you normally would, given observed GDP and inflation, are you more likely to have a crisis? And the short answer to that question is yes. So here is again a frequency table, and here we split the U-shapes into two parts. The first one we call a strong U, where you cut rates by more than you normally would, given observed GDP and inflation. And then the second one, when you raise by more than you normally would. And you have a 30 percentage points, 30% crisis probability after this strong U shape. Now, if you instead cut and raise rates more or less in line with your normal reaction function, the crisis probability is not that high, kind of fairly similar to the other shapes or to the unconditional probability. So this cutting rates and then raising them by more seems to really matter for crisis risk. Now, we have shown that U-shaped monetary policy increases the risk of banking crisis, and this becomes stronger the stronger the U-shape. And it's something specific to banking crisis. So the next thing we do is we look at the mechanisms. So what are the mechanisms? Okay, it's something related to banking crisis. We have a very large literature on mechanisms of banking crisis, typically talking about financial booms. So the idea here is that, okay, how can this monetary policy U-shape be tied to these financial vulnerabilities? And the idea is that, okay, when you first cut rates, you can create financial vulnerabilities. And then afterwards, when you raise rates, when the vulnerabilities are there, you will trigger a crisis. Now we define financial vulnerabilities. We don't define it ourselves. We just want to take an off-the-shelf definition. We take one of the more recent papers, which is well published, is Greenwood, Hansen, Schleifer, and Sorensen, and they define these vulnerabilities as the red zone. So when you observe a very high credit growth, top quintile, and a top tercile of asset price growth together, then you are in a so-called red zone. Right? So that's when you have a financial boom, large growth in credit and asset prices. So then the first thing we do is we say, okay, does cutting rates make a financial boom, this red zone, more likely? The answer is yes. So what we do here is we have the next 3 years, this red zone indicator on the left-hand side. On the right-hand side, we have the change in rate. So this is, for every percentage points of cut, you're 2 percentage points more likely to end up in the red zone. 5 percentage points for the IV. This is a cut dummy. Again, when you cut rates as a dummy, you're more likely to end up in the red zone. And also, if you cut rates by a lot, again, financial boom is more likely. Now, in kind of the last few months, we're also trying to understand a little bit more like what exactly is going on in the boom. And what we observe in this boom are kind of the following things. We observe low credit spreads, high valuations of bank equities, and then at the same time of these low spreads and high valuations, predictably worse outcomes. So predictably worse credit outcomes, predictably low future bank stock returns, which suggests there might be these channels of increasing credit supply and over-optimism in play, in line with some previous studies of credit booms. So, and these are connected indeed to this loose monetary policy. So then, okay, the next step, so say you've cut rates, you've created a financial boom, or there is a financial boom after cutting rates. And then what happens when you raise rates in a boom? Okay, so here, this table shows that when you raise rates in this red zone, you're much more likely to have a crisis. So the dependent variable on the left is again a crisis dummy. And on the right, we again have increasing rates, and then this financial boom, red zone indicator, and the interaction. So the interaction will tell us if raising rates in the boom is especially bad for crisis. So we have the previous result from many previous studies that these financial booms are associated with higher crisis risk. But then we show that, okay, once you look at raises in a boom, then only if you raise in the boom, when you have this interaction, only then you truly get the higher risk of crisis. So it's really a financial boom without raising doesn't give you that much higher crisis risk. And it's especially true for these residual raises when you raise more than you normally would, given your normal reaction function to GDP and inflation. Interestingly, we only observe this kind of interaction of raising rates in the boom predicting crisis for those red zones where you cut rates before. So if you were raising rates before entering the boom, the red zone, then it doesn't seem to predict crisis very well. So from this, we conclude preliminarily that the interaction of this U-shaped monetary policy and this red zone, financial boom, is really crucial for crisis. And then I think we have quite a nice way of showing that this interaction is crucial through, again, the following frequency table. Now, again, this is the frequency of crisis over the next 3 years. So it's the same as before, but now we don't sort things by shape. We sort them by combinations of U-shaped monetary policy and red zone. Okay, so the combination is when you observe both U-shaped monetary policy and red zone over the previous 8 years. Then you can have U-shaped monetary policy without red zone without U-shaped monetary policy, or neither. And then we can see that the crisis observations are really concentrated in this top category. So this is the crisis frequency, and this is the number of observations where we have both U-shaped monetary policy and red zone and number of crises. And we see that the crisis frequency is almost 40%. And then when you have either just a red zone or just U-shaped monetary policy is much lower. So it's really the combination of these two things that matters. For example, after World War II, we had 71 red zones, 71 financial booms. Only one of them ended up in crisis. So these are red zones, so 71 red zones without U-shaped monetary policy, right? We had only 33 red zones where you also had U-shaped monetary policy, but then 10 crises. So it's really the combination of the two that is key. And then the last thing we do in this mechanism section is we try to understand, okay, well, the combination seems to be key. It's kind of different to the previous literature on crisis, which just looked at the credit booms. So why is it that the combination is so important? And we look at two things. So the first idea is that, okay, when you raise rates in the boom, it somehow reverses these vulnerabilities that built up during the low rate period. So what we do is we see, okay, let's see, for example, let's just look at how much was the past increase in house prices last few years. And then, okay, does raising rates when house prices increase by a lot, does it trigger an especially large decline in house prices? That's the first thing we do. And the second thing is that, okay, there might be, like in the previous presentation by Lara, some vulnerabilities in the banking system during this low rate period. So then we see, okay, does raising rates, does it have some kind of, does it lead to some bad outcomes for the banking sector? So let me show you briefly both of these things. So the first one is this vulnerability. Okay, so what this shows, we run this regression. So Y is, let's just look at this. I think it's easier to explain with house prices. So Y is just the change in house prices, and then we have some country and decade fixed effects, and then this one is the standard thing. Okay, you raise rates, you normally get lower house prices. This we know. Then this is just an indicator for high house price growth over the past 3 years. RZ is the red zone threshold, so it's like the top quintile of the top tercile of house price growth. Okay, when you have past house price growth, you might also observe some mean reversion later. And here is the interaction. Does raising rates when past house price growth was already high trigger an especially strong decline in house prices? And we see indeed this is the case. So this is the interaction coefficient. When you raise rates, given a high previous vulnerability, you trigger an especially strong reversal in this vulnerability. It's also true for household credit, business credit, stock prices, also true when we do this with an instrument instead of the raw changes in rates. So that's the first thing. Raising rates triggers the reversal in vulnerabilities. The second thing is these effects on the banking sector. So here we run the same regression almost that we were running for crisis. Right? We had the change in rates, then the cut rate dummy for like the first leg of the U-shape, and this U-shape interaction, right? Which is like when you raise rates, after cutting them, something bad happens, more or less. Now, the bad thing happening now is not a crisis dummy, but are variables related to profitability of the banking sector. So we have the return on equity, the change in the NPLs relative to loans, and then the market return on bank equity. And indeed, we see these U-shaped effects that when you increase rates, after cutting them, this leads to this kind of bad outcome, declines in ROE, increases in NPLs, and declines in market returns on bank stocks. So the last thing we do is we say, right, we observe some negative effects of this U-shaped monetary policy on the banking sector, and in general, some effects on crisis. And now we want to drill down in a bit more detail what's going on at the loan level. Because in the macro data, we cannot really look at heterogeneities, but different types of loans, different types of firms, and so on. So what we do is we go to the credit register in Spain around the global financial crisis, and then we say, okay, we try and kind of reproduce something that is close to the regression that we had before in the macro data. So now the variable on the left, instead of the crisis indicator, is a loan level variable for the loan defaulting. Then on the right-hand side, we have the change in interest rates over 3 years, the dummy, whether the rates were previously cut, the interaction of the two. That's what we had before in the macro data. But then what we can do in macro data, we can interact them with firm and bank characteristics. So we can see if these effects, if loan defaults increase more, after U-shaped monetary policy. That's the interaction. If they increase more for some types loans to some types of firm, to some type of bank. We think it's kind of a nice laboratory to study this question because Spain during this period had a relatively exogenous monetary policy set in Frankfurt, targeting more the euro area countries. It was not really the case after 2008 with the Spanish sovereign debt crisis and so on. That's why we cut our sample there. And then this regression allows us to say what types of loans default more after U-shaped monetary policy for the case of the global financial crisis in Spain. Okay, so it's a big table. I hope you can see it from the back row because now we have the micro data, we have 1 million observations, and we can throw in all kinds of fixed effects and things like this. So the first 3 rows are just replicating what I showed you before in the macro data. So when you cut rates and then you raise them, you observe especially high defaults on an average loan. And then these interaction terms, they show you that these defaults are higher for ex-ante riskier firms, which, for the real estate boom in Spain, it was definitely the real estate firms, also firms which find it costly to get credit, and for relatively ex-ante riskier banks. So, for example, banks with higher non-performing loan ratios, and this quadruple interaction for ex-ante riskier banks lending to ex-ante riskier firms here. The effects are kind of reasonably large, so doubling maybe of loan default rates after a U-shape, and then another kind of 50% or 30% increase for some of these categories. All right, so let me in the last minute conclude what we have done. So I've shown you that a U-shaped monetary policy rate path increases crisis risk, and in particular, raising rates increases crisis risk, but only if rates were previously cut over a long period. This link is something unique to banking crisis. It's not there for non-crisis recessions, and it's stronger the deeper this U-shape in monetary policy rates. Then when we look at the mechanisms, is this combination of a U-shape in monetary policy rates and this red zone, the financial boom, that's crucial. So what you really need is kind of 3 things to happen. You need to observe a cut in rates, then a financial boom, and then a hike during the boom, and then you're very likely to have a crisis. And we show that the banking sector seems to be affected by this, seems to be important to the transmission. Moreover, when we go in microdata for the Spanish case study, we observe stronger effects for ex-ante worse firms in banks. Now we think, okay, I'm almost out of time, but just last 15 seconds, I think it's interesting to think about policy implications. So first of all, I guess when central banks change interest rates, the effects on financial stability might depend on the previous decisions in interest rate, previous monetary policy. And then, sometimes central banks need to raise rates, like over the last couple of years, clearly to target inflation. So, can we learn something? I think we can learn a few things. So first of all, maybe if you have an opportunity to raise rates before entering the financial boom, or while not a financial boom, this is much less dangerous for financial stability. Also, perhaps raising rates, but not raising them by more than you normally would, seems to also alleviate some of the crisis risk. Or perhaps if you really have to raise rates quickly and by a lot, then you could look into using other policies like macroprudential policy to alleviate the financial stability concerns. Thanks very much for listening. I very much look forward to your comments and discussion by Christina.
Thank you, Dimitri. And the discussion will be given by Cristina Manea from the Bank of International Settlement.
Thank you very much to the organizers for giving me the opportunity to discuss this paper, which I think will certainly remain a reference in the empirical literature on monetary policy and financial stability. And thank you, Dimitri, and also to your co-authors for engaging in such a policy-relevant project. So this is an empirical paper where the authors, they point out that the U-shaped path of monetary policy creates financial instability. And to make this point, they use both macroeconomic data as well as micro data. Regarding the macro data, they use the Jordan, Schularic, and Taylor macro history databases, and they show that that crises, they tend to be preceded by this U-shaped path of monetary policy. So this very long, very low interest rate, which stay long for a long period of time, and then they abruptly increase. And in the paper, they point out that these systematic patterns, despite being observed for nominal interest rates, they are not observed for inflation or real interest rates. And then they look into the mechanisms, and they point out that these low interest rates, they make more likely that the economy enters a financial fragile zone, like the red zone, where asset prices and credit are high, and that tightening on the heels of that boom will crystallize financial fragilities and will increase even more the probability of a crisis. And then from the micro data, they go to the case of Spain before the great financial crisis in 2008, and they point out that the loans that they were given after a long period of low interest rates, they were more likely to default, and especially for risky firms or for risky banks, and that even more so if the tightening occurred. So I think I like a lot the paper. It's also because together with my co-authors, Frédéric Boisset from the Bank for International Settlements, Fabrice Collard from Toulouse School of Economics, and Jordi Gari from the Research Center for International Economics in Barcelona, we have a theoretical framework where all these empirical facts, they can be rationalized. So what I will do today, I will try to tell a story of these empirical facts through the lens of this theoretical model on monetary policy and endogenous financial crisis. So in particular, I will first talk about the origin of this U-shape and also about the way monetary policy nourishes financial instability. And I will point out that this U-shape of monetary policy can be triggered by monetary policy by itself. So what we know, too low for too long, so unexpected, John Taylor's great deviation hypothesis. So it is because monetary policy stays too loose for a long period of time and then tightens abruptly. So this is one instance where this U-shape can occur. But I will also talk about another case where this U-shape appears because of a systematic response of monetary policy to business cycle shocks, and in particular to positive supply shocks. So you have a supply boom, and because of this supply expansion, you will have these disinflationary pressures, and the central bank comes and is going to cut rates to respond to disinflation. And by doing so, it will implicitly nourish financial instability. And then once this technological boom recedes, there will be a pickup in inflation, and then a central bank will tighten, and then we will observe the other part of the U-shape. So I will point out that the contribution of monetary policy on this U-shape can be both discretionary, so this too low for too long, but it also can be systematic, like a response, endogenous response to these supply-driven booms. And these two types of U-shapes, they will explain why, even though before crisis we have the systematic patterns of U-shape for nominal policy rates, we do not observe the same thing for real rates and inflation. So that is going to be the first part of my presentation. And then I will also talk about the normative implications of their results through the lens of our theoretical model. And in the end, I will just discuss how one could use this model to think about financial stability risks at the current juncture in the euro area. So this U-shape can be what we are used to think of, this too low for too long pattern. So monetary policy stays unexpectedly low for a long period of time, and like John Taylor's great deviation hypothesis, and because of that, it's going to feed a boom. And and then when it tightens, it will just crystallize this financial instability and will drive the economy into a crisis. We observed that before the GFC, for instance. And we also can, in our model, we get exactly the same thing. So by simulating the model of endogenous financial crisis, we can see that monetary policy can by itself trigger a crisis just by keeping the policy rate unexpectedly low for a long period of time, so like negative monetary policy shocks, and then by tightening abruptly unexpectedly, so positive technology shocks. So we have that also in the model, as also in line with their empirical results from the micro side. It is because at the end of these booms, marginal productivity in the economy, so after the too low for too long, is very low. So agents, they tend to search for yield, And because of these agency frictions, which become more severe, credit markets, they may collapse. So yeah, this is also in line with their. What is interesting about this U-shape is that too low for too long, so unexpectedly loose monetary policy, if this is the case, so this type of U-shape, we should necessarily observe it with inflation. Because unexpectedly low for too long monetary policy, it means that it's expansionary monetary policy, so it creates a demand boom. So if this is the case, we should observe that this U-shape, it's accompanied with inflation, so above target inflation. And this is the case for a lot of crises in their historical data set, and for instance, also for what happened in Spain. So for Spain, before the GFC, we observed that the policy rate, you have the U-shape in the nominal interest rate, and you observe that inflation was above target. So monetary policy at that time, it was expansionary. And again, the real rates, they are negative. So one example of this U-shape, like a too low for too long, it's Spain, or if you look at a lot of countries, Ireland, but a lot of them, before the GFC, they were like this. So it was like monetary policy creating financial instability because of loose monetary policy. So if this is the case, this is something to remember. If it's too low for too long, then you observe nominal interest rate, U-shape, but with inflation. And if we look at the case of the US, it's exactly the same thing. A bit of deflation, but again, the U-shape, it is with inflation. So the John Taylor Grace deviation hypothesis implying that in the US also monetary policy contributed to the boom. So this is one type of U-shape, but there is also, so in this way, monetary policy affects financial stability by this discretionary contribution. But there is another possible systematic way through which monetary policy can affect the probability of a crisis via this U-shaped pattern. And it happens also for a lot of countries, if we look country by country, because of a technological boom. So sometimes, a lot of these crises in the past, the booms, they were supply driven. So you observe a high TFP growth before, and because of that, we have deflation, the central bank responds to deflation. Interest rates are very low, the boom recedes, the central inflation type picks up, the central bank responds. So this is another way with which monetary policy this way affects the probability of a crisis via the U-shape, but in a systematic way. And in order to identify this type of U-shape, the distinguishing feature is that it appears with deflation. So for instance, one example is the Japanese crisis, which there is an empirical, there is evidence that before this Japanese slump, there was a boom, technological boom driven by electronics, like GVC and Sony. So, and also if you look at TFP before the crisis, you have an increase in TFP. So in this case, we observed the policy rate was low, but we observed it with deflation. So this is one case where it was the systematic part. The U-shape was a response to a systematic response of monetary policy. And a distinguishing feature of this type of U-shape is that it appears with deflation. And when they look in the post-World War II sample, they can see that a lot of crises, it's also U-shaped for deflation. So a lot of crises, apart from the GFC, in the post-World War II, they were driven by these supply factors. And this is also why this also explains why even if we have this U-shaped pattern for policy rate, we do not observe the same thing for real rates or inflation, because the demand one, the U-shape in demand comes with inflation above target. The U-shape with the systematic part, with the supply boom, it comes with deflation. So it depends on the sample. So there are these two types of, and also the real rate is the same. For the monetary one, real rates are negative and they're low. For the supply driven, because you have high productivity, real rates are high. So this explains why you can, this is one way to rationalize why you can have a U-shape for nominal interest rate, but not for real rates and inflation. And just now to point out some normative implications, in the paper, they argue that one policy implication is that you need to have preemptive action. It's also what you see through the lens of our model, that you should try to systematically tame the boom before, to curb the boom just from the beginning, but in a systematic way, such that you don't get into R zone, or you get less frequently in the R zone. And we have this augmented-Taylor rule, where you also respond to this index of financial fragility, which is doing exactly that. It's taming the boom, and then it declines the probability of a financial crisis and also improves welfare. But there is another way, which is a direct way, also coming from the theoretical analysis, an implication is that monetary policy, we saw that can by itself create a crisis by keeping policy rates unexpectedly low and then rising them. So one direct implication is that the central bank could just avoid, if it's possible, to conduct these too low for too long patterns. And yeah, it's true that there are pegs, or if in a euro area, if they can't do so, they should think that they should come with other policy tools to correct imbalances. And just to talk about how can we use this paper to think about financial stability risks today. So what they show is that by keeping, you have these U-shaped patterns, you boost credit and asset prices, you put the economy in the R zone, and then you tighten. So the implication is that today we are in a tightening cycle, so for sure, while raising steeply the monetary policy rates, central banks, they increase financial stability. But an important factor in their analysis for this risk, it's the boom before. So in order to assess the risks today, it's important to look whether there was a boom. So whether the economies, the euro area economies and the individual members, they were in an R zone before the crisis. And one thing which is very specific about this U-shape, which happened in the euro area today, is that the low for long, part of it was a low for long at the zero bound coming from the euro area debt crisis. So that could be also like tight monetary policy. So they were at the zero bound for a long period of time because of the debt crisis. And then there was another part of this too low for too long coming from the backstop, which happened in the face of COVID. So yeah, and then you had the tightening. So the low for long period, it was special this time. It was low for long at the zero bound after the debt crisis, and then it was a further loosening because of the COVID. So when they loosened even more in order to backstop financial markets and to avoid the crisis. Now, if we look just at the level of the euro area, we can see that before, so the first part of the low for long, there was no boom in credit to GDP. But this is at the level of the euro area. So it doesn't, just looking at graphs, there was no boom. There was just an increase in credit because of this low for long, because of the backstop. So at the level of the euro area, as a whole was not in an R zone. So only the tightening part poses risk to financial stability. But it's important to look at now at the individual euro area members. And I was discussing with someone in Ireland who were saying that they had the credit boom before. So it would be interesting and now to look at each euro area member and to assess whether it was in a red zone before, and in order to assess financial stability risks at the individual level, individual country level, because we saw after the GFC that even if the things, they look well at the level of the Eurozone, if members, they may behave in a different way, and this can have spillover effects afterwards. Yeah, thank you.
Dimitri, do you prefer to react to Christina's now?
I mean, yeah, just briefly, I mean, to say thank you very much for a very nice discussion, and, you know, I take on board all the points. Just wanted to say that, you know, indeed, I think Christina's theoretical paper is a great fit and a way for me to understand better our empirical results. You know, I had to skip the literature slide on for this presentation, but, you know, it is there. And we'll, you know, strengthen the links in a new version of the paper. And then, you know, it's very nice for understanding this optimal policy conduct, you know, raising before or not cutting too much and things like that. And thanks again for the comments on inflation and real rates. It's true that we don't observe this U-shape in inflation or real rates, at least not a stable one, which, you know, has puzzled us for a while. So I didn't really talk about it much today because we're still not sure if it's just measurement error or something else, but it looks like there could be some economics there. So we will definitely think about this more and do some more analysis. And yeah, I mean, in terms of policymakers. I mean, I'd be interested to hear people's views, because when we originally wrote the paper, we thought it looked quite dramatic, you know, in terms of this U-shape and crisis risk. But then we do have this very important interaction with the red zone. So in a way, if you have a U-shape but no red zone, it doesn't seem to be so bad for financial stability. And so far, perhaps, in the euro area and globally, we have observed some small bank failures and some distress in individual markets, but not kind of a big systemic crisis. So yeah, I'm kind of hopeful, but yeah, I'll be interested to see what other people in the room think.
Yes, let's open the floor for some questions. Over there.
Yeah, my name is Doreen Rookmaker. I'm a member of the Econ Committee from the European Parliament. And I would like to invite the two of you to the Econ Committee and the next mandate. Because in the Econ Committee, I think 99% of the members are thinking that banking are the biggest source of financial risk and are the source for the financial crisis and banking crisis. And as you explained so eloquently, monetary policy is a big factor too. And after the financial or banking crisis of 2008, banking got a lot of rules and regulations. We are busy with it every day in the Econ Committee. But the central banks, who are also a big factor, as you explained so eloquently, don't have any regulation whatsoever. And I think it's important for my colleagues in the Econ Committee to at least understand that this is that it is a factor.
Thanks for the invitation. I mean, I would say that the banking sector is really key. You know, it's if you don't have a boom in this kind of financial markets, the banking sector, then it doesn't matter too much what the central bank does. And then, in a sense, the banking crisis, you know, is happening at the bank level. So if you do make the banking sector more resilient, then, you know, regardless of these monetary policy actions, you might not, you will presumably be less likely to observe a crisis. Let's take some more questions, perhaps.
Yeah.
Okay, my question is more prosaic. And Christina's great discussion kind of touched on I was wondering a little bit more what's behind the U. Just for example, you could have autocorrelation in crisis, right? So every time you have a crisis, then you have to cut, and then you again. Christina, you mentioned the kind of TFP thing. I mean, if I'm thinking more small open economy, maybe commodity, which might well be reflected in TFP in some sort of measurement. But then it's maybe the exchange rate. It would maybe be interesting to plot something about the exchange rate as well. Then maybe your sample is not really small open commodity exporters, but I guess understanding a little bit more, and the theory paper does a lot of that, you know, this is all endogenous, right? What exactly is this U? That's kind of where I'm trying to get at. Thanks.
Thanks. So it's not autocorrelation. So we actually checked if it's driven by these things where you have a crisis and then you cut. So the gaps between crises are a bit too long for this. They're like 15 years, and then for us it's really like the last 8. So it's not the autocorrelation. I will fight back against the endogeneity point. So, you know, in a way we residualize on macroeconomic conditions. We do have the IV, and we do find that this extra part is important. So, you know, this U above and beyond macroeconomic observables. And for example, when you respond to another country which you are pegged to raising rates, it do seem to be very important for the results.
Certainly, my understanding, my interpretation of the crisis in Spain and in the US is that the increase in inflation was not causal with regards to the banking crisis. This was a consequence of the fact that there was a bubble that was exploding. At some point, aggregate demand triggered inflation. The Fed responded to that, and you know the bubble exploded regardless of what happened to monetary policy. I think monetary policy was quite irrelevant for the story in Spain and the US in those two cases. Certainly, it's important to have controls over banks, but central banks should be independent.
I'm sorry, if you don't have the mic, we don't
yes.
hear.
So I think it's very important to keep the independence of central banks. That has been proven, has been understood. Yes, sometimes they make mistakes, but those mistakes are based on a mandate. They have some rules, okay? The rules are the mandate, and they follow those rules. If one thing we agree on probably in this room is that it's very important, the independence of central banks, and that politicians, both in Europe and in the US, for sure, should stay away from central banks.
So I agree that the independence of central banks is very important, and I would trust the central banks to, take our findings and judge them and implement policy much more than other parties.
And there is
we could talk about technical stuff as well if you want, but just to support the independence.
There are two questions over there.
Yes. So just to advertise. One analysis that we did recently at the BIS in the quarterly review that came out in December, where basically that's in the conclusion that you presented, the role of other policies, and we show that the macroprudential policies reduce the likelihood that when you increase interest rates, it would be followed by a financial crisis. So I think that there's been a learning from the great financial crisis, and having more instruments in place, help the authorities to rely on the Tinbergen principle, and so lower the chances that this increase in interest rate, which may be warranted for the price stability objective, would trigger, or at least reduce the likelihood that it may trigger this financial cycle. But I think you wanted the microphone.
Yes, I wanted the microphone because I do not want to do anything about the independency of the central banks, but I do want central banks to learn from crisis, and I do want people in the Econ Committee to understand the system, because the people in the Econ Committee in the European Parliament are deciding about rules and regulations that do have an impact on financial stability and financial risk. And if they do not understand the system well, then they probably make the wrong decisions. This is why I asked him to come and the lady to come, not because I want to influence the central banks. That is something I want to correct.
There is a final question over there. Vas, if you want to take it. Okay.
No, and thanks for this point about macro-pro. I think indeed it's kind of interesting. I mean, maybe you have the data. It will be interesting to see kind of the macro-pro responses in this hiking cycle versus some others, and to understand better how it's related to the financial stability stress, because my sense is that it's an important factor. But unfortunately for me, in the historical data, we simply do not have good enough data for this sample of macro-pro tools. But perhaps, reading your reports will inform me about the more recent ones.
Okay, so if there are no additional questions, I'd like to thank Christina, Dimitri, the presenters and the discussant from earlier session, and the audience. With this paper, the first day of the conference is closed, so thank you all, and we'll see you tomorrow.